I request CA Manjunath Hallu, Vice Chairperson of Bangalore branch, to escort the speaker and with the floor. Speaker of the session is C. Sneha Havana, and it's my pleasure to introduce the speaker. C. Sneha Havana is a fellow member of the Institute of Chartered Accountants of India. She has pursued the DIIT from ICAI. She is practicing in Bangalore with over 7 years of experience. Previously, she has worked as a visiting faculty for CPT Accounting at K2 Learning Resources Private Limited. She holds a BCom and Diploma in General Business Management from Jain University. Over the years, she has served a wide spectrum of clients, providing services in statutory tax audits, GST compliances, income tax compliances, RBI concurrent audits, and other advisory services. Her expertise includes providing industry-specific advisory services for travel agents and trusts. She is a dedicated learner and an excellent speaker, committed to developing talented professionals. Her hobbies include painting, reading, cooking, and traveling. Her success mantra is success doesn't come from what you do occasionally, but rather what you do consistently. With this brief introduction, I give the floor to the speaker. Welcome, ma'am.
Good evening, everyone. So the topic today is salary. Easiest topic, right? So we always ignore this topic whenever we are trying to revisit our income tax because it's the most easiest. And you start off this topic considering this was done in CA intern, forget finals. So way long back memories. So let us revisit to ignite our memories and what is salary today versus what we already know about. Starting with section 15 to 17, what does this section says to you? Section 15 to 17. Anyone here? Let us not make this a boring after lunch section. We can speak, it's okay. I don't mind. Section 15 to 17. Anyone knows what it speaks about? Chargeability of salary. It defines the various components for which the salary would be taxable. Starting off, I want to discuss various provisions of salary. That is, which sections tax the various components of a salary income. Starting with allowances, we have taxable, non-taxable, exempt allowances, deductions, perquisites, and fringe benefits. So these form the various components in a salary. Then moving on towards the most important point for today's discussion would be whether a salaried individual should choose old tax regime or new tax regime. I think from my experience, April, I've received highest number of calls from my clients asking me, I have to fill up my declaration form. Now tell me, what should I select? Should I select old regime? Should I select new regime? Assist me. So how do you assist them? So that's what we're going to see today. Then moving on to the FAQs. What are the sections that talk about salary? Section 224 of Income Tax Act defines income. So under that section, we see clause 3 to clause 4A was talking about the various components of salary which would be included as income under the head salary. It is the first head of income. It is something where you have an employee-employer relationship under which the employee will be compensated for income for the service that he has provided during his employment. So section 15 stipulates incomes that are chargeable to income tax under the head salary. 16 is giving deductions and 17 is defining the section salary. Now what was section 15 saying? Section 15 talks about whether you are receiving salary or due to receive or you have already received. All come under the head salary. Say suppose you have taken any advance of salary or there is some arrears of previous year's salary received in the current year. Everything would be taxed here. In case I have something which is not in form of cash, say my employer is providing me ESOPs, very famous word for today's startup world. Where do you think it should be taxable? It's shares. The moment you think you have shares, should you tax it under salary or should you tax it under capital gains? Salary. So when you receive it, you tax it under salary, you're right. But when you sell it, you tax it under capital gains. Let us look in detail how it would be taxed in further slides. Coming back to section 17(1), definition of salary. It defines the various components that needs to be included under this head. Starting with wages, perquisites, advance salary, leave encashment, any amount which is contributed by the employer towards employees' superannuation fund, annuity fund, or the latest one, any contribution made under section 80 CCD, which is the NPS. All this would be taxed under the head salary. Further, say if an employee has moved from one job to another job, obviously he will not move without any joining bonus. Am I right? So I have still not joined my organization, but the future organization is giving me money. There is no employee-employer contract yet. But what do you call that? Joining bonus. Where do you tax it? Salary. Under what head? Section 17(3) clearly provides for profit in lieu of salary. So the joining bonus would fall under that head. Any commission, or I can also say when any settlement is happening with any employee at the time of voluntary retirement or severance pay, would again fall under PLOS. All that again falls under salary. I mentioned to you, allowances has 3 types, and that is based on the income taxation. So when I say taxable allowance, non-taxable allowance, or partially taxable, how do we know which is taxable? The rules for salary section is provided for each head of allowance as to how you determine or compute the taxable allowance. And wherever it is very specifically provided that it would be exempt, unless specifically provided, the remaining goes as fully taxable allowances. What are allowance? It is something beyond your basic salary, what an employee would get every month. It could be uniform, it could be meal allowance, it could be my house rental allowance, it could be transport allowance. So these are monetary benefits or non-monetary benefits which is beyond my basic salary. Starting with fully taxable. The first one is dearness allowance. What is dearness allowance? An allowance which is paid for the rise of prices in India, or inflation as we call it. Entertainment allowance. So entertainment allowance comes with an asterisk, terms and conditions. Exempt only for government employees, subject to certain limits, and that we will be seeing in section 16. Other than government employees, for all other employees, this entertainment allowance is going to be fully taxable. Medical allowance. Earlier, before AY 1920, we used to get 15,000 rupees as a benefit for medical allowance. Now, after which they started with a standard deduction, removing the medical allowance benefits, where the employer used to face a problem, or I can say crisis, with fake medical receipts. So in order to get medical allowance, employees had to submit some documentation where high frauds, forgery. To avoid this unnecessary, undue process, government came up with standard deduction. Medical allowances, when it is provided, if the employer has his own hospital, or if it is in a case where it is authorized by a central government, state government, in case where there is a prescribed illness. So under the definition prescribed illness, the ailments what are mentioned, if medically allowance are provided by the employer, then in that case it would be exempt. Also, we all are aware, 2019 on COVID, many reliefs were sought from employer for COVID relief. Even that falls under this exemption. Plus, if an employer is taking a medical health insurance on his own employees, that will also not be a taxable salary income. Overtime and shift allowance.
In this case, critical illness is there, no?
Yes.
So, for critical illness only for employee or employee family also?
Only employees.
Only employees.
Yes. Moving further, overtime and shift allowance. So, of late, because of onset of MNCs, we have seen working in US shift, UK shift, so a lot of shifts. So, when you go to the shift allowance, it is fully taxable. However, in CA, we don't see any overtime payments. So, this is over and above the CA practice area. We can see only in our clients Form 16. I am sure none of us pay for September overtime. Next, city compensatory allowance. When an employee moves to a new city, to meet his higher cost of expenses for moving into a new city would be under the city compensatory allowance. Again, fully taxable. Then, transport allowance. When I am talking about transport allowance, if it is for a fully official purpose, during your office hours, reimbursed by your employer, not taxable. But if it is for commutation from your office and home, that would form your transport allowance, which is taxable. Again, this is a facility which is varying from one organization to other organizations. There is a specific exemption here if you have a specially abled, or if you have any deaf and dumb or any handicapped employee. You can still provide an allowance for them, which would be exempt per month 3,200 rupees. So these are the gist of what are fully taxable allowances. Any questions here? Okay. Partially taxable allowances. The most common allowance what we see and what employees seem to claim. I'm sure you would have seen too many reels, too many what I call YouTube Gyanis giving you how to claim HRA. So they all say, yes, you're staying with your parents, still you can claim. Staying with your sister and brother, you can still claim. Is it possible? Can I still claim HRA? You can, provided you should have all the documents in place. There is a case law which has given certain guidelines. Starting with section 1013A prescribes rules, computation method for computing the house rent allowance. It provides that minimum of what actually the employer gives you as a house rent allowance, or what actual rent you have paid less 10% of your salary. When I say salary here, it is basic plus your dearness allowance. Then the third one is 40% or 50% of your salary. Why 40 or 50%? 40% for non-metro cities, 50% for metro cities. Kolkata, Delhi, Mumbai. Why Bangalore is not there is still question on my mind. I don't know why they feel that Bangalore is cheaper to live. This is something which is brought up to the government again and again, and still it is under consideration. They have not moved Bangalore to a metro city. So we still continue to pay only 40% of our salary here. Then, the least of this would be your house rental allowance, which is tax exempt. What if I have received 10 lakhs and my exemption comes to 6.5? You end up paying the tax on the remaining amount. What are the documentations that I was speaking that staying in my parents' house I can still claim HRA? Number one, you should have a valid rental agreement. You should have a valid and genuine rental receipts where you are paying them. Showing agreement, showing receipt is not enough. Your payment to your parents should be from your bank account. That is mandatory. When you have all these documents in place, definitely you can claim HRA. Also, you should not be the owner of the house. That is, employee cannot own a house and claim HRA. In case if your HRA allowance, what you are claiming is more than 1 lakh, please quote the PAN of the owner. If it is more than 2 lakhs, rental agreement is mandatory. Of late, many companies have adopted to provide mandatory rental agreement, also provide rental receipts. Right? Rental receipts very easy. You have format online, print, sign, you only do the owner sign, submit. Actually that is done. When you go to proof verification of all these documents before the year end, say Feb or March when this is happening, when we say to the employee, March month you have not submitted, they'll say 5 minutes, I'll bring it and give you. 5 minutes Yelahanka and the owner is somewhere in Whitefield, how will you get the signatures? So it is obvious that the employee is sitting, getting the printouts, signing and submitting to us. But are you capable or do you have the resources enough to identify such frauds? Of course no. It is not with us. That is why we take a declaration from the employee that all the proofs submitted by you are genuine and the onus is on you to prove the genuinity of this transaction and it is not of the employer. So to avoid all these frauds, many companies have initiated mandatory requirement of rental agreement so that they have another document in place to prove for the exemption. Moving further. Few other partially taxable allowances. There are lists of partially taxable allowances. I have given you just few examples. Children education allowance, 100 per child. I have told many of my clients, ask your HR to include this in your salary CTC component, you will get another 1200 per annum exempted. You have children, you have allowance, you get another 1200. But yes, does company do that for you? No. They have a fixed CTC components. You take it or leave it. Why? They cannot sit and validate or take proofs for each and everything. So to reduce their process or burden, I can say that they have a very fixed CTC components. Here, they say maximum 2 children. So I have a special case for you. The first child, what I have is a single child. Second time, I have twins. Now where do I leave the third child? All 3 are my kids. Do I still get exemption? Yes. What if my first time I have twins and the second time it's single child? You don't get second time. Unfortunately, even though it is your child, you cannot claim exemption. That is your own burden. Then, hostel allowance, 300 per child. Special compensatory allowance, this is specifically location based. This is for hilly areas. 300 to 7,000 per month can be given by the employer, provided based on the location and the conditions. Meal allowance, so coffee, tea, biscuit provided by employer is also taxable now. What to do? It is not that way. This is during the office hours. If any meal vouchers are given to you from your employer, up to 50 rupees per meal would be exempt. Say I am going to Taj and saying this is my meal expense. You cannot claim that as your meal allowance. There are few other allowances as I mentioned to you. Tribal allowance, hilly area allowance, then cross-border allowance, you have city compensatory allowances. Each of them have limits as I have mentioned to the other allowances here, but we are not discussing here. Reason being, those are very specific and dealt case to case. We don't deal with it in Bangalore generally, so not applicable in general. Yes? By the pics, anyone can guess what is this allowance or the next topic I'm going to discuss on? Sorry?
Leave travel.
Leave travel allowance. There is another pic. Any guesses? What is the next allowance that we are going to discuss? The first one was rightly mentioned, leave travel allowance. So what is this allowance? I am going on a paid leave on a holiday and my employer is kind enough to give me reimbursement of all the expenses for my leave. Is that so? No. Then what is the amount that he will reimburse and which is not taxable for me? Only the journeys. Your stay, your hotel, your tickets, what you purchase there to visit all the monuments, that is not included. The journey is what we are talking about here. And when often can you claim this? Section 10 subsection 5 says, in a block of 4 years, I can claim 2 times for 2 journeys. And what is the exemption limit? They specify that if you are traveling by airways, first class economy is the limit with the shortest route. When you are talking about train, it is again first class air conditioned rail fare fee for the shortest route. In absence of these both, any deluxe for bus journey or any mode of transportation available in that place. So now what is the current calendar year or current block what we are talking about? What is the current block? 20 to 25. So current block of calendar year what the employees can claim for 2 journeys is 20 to 25. If you have not claimed before 22-23 calendar year, I'm talking calendar year, please remember this is not financial year. Though we are taxing for, the idea is prepared for a financial year, here the block, what we are speaking is calendar year. So 22-23 is not claimed, we still have a chance, 24-25, both the years the employees can continue to claim the LTA allowance. And that would be exempt from taxation under section 10(5). So rule 2B specifies all the amounts, the way it has to be computed, how to arrive at exempt LTA. The next one which none of you guessed, the most important and currently loved, work from home allowance. We all like work from home, no? Where you are working from home, working from park, working from cafe, working from restaurant. I see many parents when I take my son to swimming pool, they are all walking with laptops. I ask them what they are doing, work from home today. So they are all attending their meetings everywhere. You see kids with classes, parents walking around with laptops. So that is all work from home. So what allowance an employer is giving in this situation? Why did this start? Prior to 2019, we didn't have this specifically. COVID onset and many started to have options to work from home 100% or have a hybrid model where you go 3 days to office and 2 days you can work from home, which is making convenient to the larger population. Also the organizations. Why? They don't have to hire the huge rental offices anymore because they are still getting the job done without having to have a place of work for their employees. To provide this facility, the organizations come up with work from home policies. They must have a written policy document if these allowances are to be claimed and fully exempt. They can provide for reimbursement of the infrastructure what they require to put in place at their home. It could be the chairs, tables, I need monitors, I need internet, I need laptop. All this would be fully reimbursed from the employer. When I talk about fully reimbursed, you have to provide tax proof. Tax invoices are mandatory. Tax invoice means GST invoice. Many organizations make it mandatory that don't bring any tax invoice, don't bring any invoice. We need GST registered invoices only. Few organizations have also gone to the extent where they say from prescribed vendors only you should buy. Only then we are giving you the full reimbursement. Few companies have set a limit, so it is depending from company to company, and they have a prescribed timeline within which they should be able to claim this expense. Say you join a new company, in that organization within 30 days of joining, you can claim this work from home facility reimbursement where you reclaim or reimburse the amount what you have spent for your new company's expenditure. It could be ergonomic chairs, it could be the new table what you have got. All that would be reimbursed. Air conditioners. This is also something that I need summer. This summer was terrible. I could not sit in the office. So I bought an air conditioner. Can I claim this under work from home allowance? Can we claim it? No. Because this falls into the category of furnished accommodation. It would be a taxable perquisite, and Rule 37 Subclause 7 provides that you can tax it at 10% of cost or the higher charges, whichever is lower. Minus if employee has further paid some amount from his end, the remaining would be the perquisite amount in your salary. Section 16, I mentioned to you, deductions are given. What is allowance? What is deduction? Allowance is something which forms part of your gross taxable salary. Deduction is the one which you reduce from your gross taxable salary. Section 16 provides three limits. First one, standard deduction up to 50,000. My income itself is less than 50. Can I go ahead and claim refund for the remaining amount? No. It limits up to 50,000 or your actual taxable salary, whichever is less. Next, entertainment allowance only for government employees here. Exempt lower of actual amount received 20% of salary or 5,000, whichever is less. Professional tax. Not every state has professional tax. Please remember, Karnataka, Maharashtra are one of the states which has professional tax. Not all the states in India have professional tax. So only to the extent of tax paid, it would be exempt or deducted here. The next one, the most important or today's topic I can say, perquisites and taxation of perquisites. Lot of questions come here. Salary is actually very easy. When a salaried individual comes and gives you, find my return. Okay, there are people who are filing for 100, 500 rupees also. Where is the CA expertise there? You give form 16, upload file. Online systems are doing. Why do you need CAs to assist? Perquisites. How to tax a perquisite. How to plan your salary income using your perquisites is very important. Perquisites are benefits which are given to the employee based on his position over and above the salary income. They can be taxable perquisites, they can be non-taxable perquisites depending on their nature. Section 17 will give you the list what various perquisites are taxable, and this list is an exhaustive brief list. When I am telling exhaustive, you can see the list, right? 1, 2, 3, 4, 5, 6, 7. After which there is a residuary clause 8, which I have not put here. It says any amenity or benefits given by the employer to the employee. So anything not falling under above 7, it will fall under 8. They make sure everything you get from employer is taxable. Nothing comes free in life. Henceforth. So starting with the first one, rent-free accommodation. How many of you see Canara Bank houses, Canara Bank housing facilities? I see very often. They have very good accommodation facilities. Is that free? Not again. So let's understand how it is taxed in form of salary or a perquisite for the employee. Second one is accommodation at concessional rate. How is this different from rent free? Because accommodation at concessional rate is where an employee will be getting accommodation facilities at a very nominal price. Outside rent is 25,000, 1,200 square feet fully furnished. Employer is giving me for 5,000 because of my position. That is accommodation at concessional rate. Benefits of amenity by company. I am the director of company. I am drawing a salary of 85 lakhs. I get free car, I get a chauffeur, I get servant, I get gas, electricity bills. That is other benefits or amenities by the company. Sweat equity shares, my favorite. Every startup who does not have money, they have come up with an idea to compensate employees. How? I'll give you shares, you stay in my company. Right now I don't have money to give you salary. But you please work for me. You grow my company, then you can become shareholder. So they have come up with ESOP, RSU, ESPP, you name it, different names. But that is something which has been adopted of late. Any organization which does not have heavy cash flow to compensate its employees, but they don't have an option, they have to retain their employees. How do you still compensate them? Sweat equity shares. The next one, sum paid by employer through fund for life insurance or contract for annuity. As mentioned before, if my employee is paying for my life insurance, then in that case that would be a perquisite which is taxable. Obligation paid on behalf of employee. I have car loan, my company is paying it. I have to pay for my maid, my company is paying it. The servants, the gas, electricity, it is my obligation, company pays it. My income tax, company pays it. All those are obligations of employee but paid by the employer. Any contribution from the employee, you all must be aware, should have mandatory PF, ESI if you have more than 20 employees. But every amount contributed as an employer towards such PF fund is taxable as a perquisite. Any interest that is accruing under that fund will again be taxable as a perquisite. And in some cases it differs, we will discuss in detail next.
Yes. Some paid through fund, serial number 5.
Yes.
What is this through fund? I did not understand. Some paid by employer through fund.
Yeah, so there is an employee fund what they create to have an effect on insurance. Some companies to retain the employees, what they do, they create a fund. They say, if you are staying with us, say for 10 years, your life insurance, education of your kids will be taken care through this fund. So you directly pay LIC or you make a trust through which you are taking care of all the employee expenses, through which it affects the life insurance of the employee, will also be called as perquisite. Yeah, this is one of the ways through which they want to retain the employees. You have to keep your employees happy or they'll say tomorrow, bye, I'm going, I've got a better option. Yes. Form 16 we have all seen. This is Form 12BA, part or annexure of Form 16, where in detail you can see the various perquisites which would be taxable, non-taxable given by the employer. So he will provide this Form 12BA along with your Form 16 to understand what are the various perquisites that is part of your CTC. You can decide your CTC, right? You have basic, you have allowances, you have other allowances, then they say LTA and HRE, that's it. What comes in other allowances, you don't know. So that explanation you can find from Form 12BA. The first one is accommodation, which we spoke, rent-free accommodation. Cars, automotive, sweeper, gardener, watchman. So here you see 3 columns. The first one is value of perquisite. So what is the amount given by the employer to employee? Second is if I have reimbursed him anything. Say he has paid for my expense and I have paid him back 50% of that money. That would come in the column 4. And amount of perquisite which would be taxable is the last column. Here you can see I have included Form 12BA, where the 15th row, value of any other benefit or amenity or service or privilege. I was talking about work from home facility. Here there was an employee, this is from my client. So there was an employee who claimed for the work from home reimbursement. And this work from home, he claimed for the table, furniture, 2 monitors, laptop, mouse, whatever he can get. Employer said this is the limit, he has exhausted that limit. So to the extent he has been reimbursed is reflecting in the column 3, 52,650. And you see he has not recovered anything from the employee as such. Entire amount is a taxable perquisite in our situation. So the total value of taxable perquisite stands to 52,000 in our case. So Form 12BA is a gist of all the perquisites he would be getting. Now how much rent-free accommodation allowance is taxable for me? There was an amendment which is latest. Anyone aware? 23-24 financial year onwards. All these years they have not bothered to understand what limits, computation methods they have been giving is from an age-old act. Our Income Tax Act is 1961. So of late budget 2023 they realized this has to be aligned as per the inflation of the country, and that is what they brought in here. That is the amendment. That amendment is applicable only for non-government employees. When you have a Supreme Court judge, High Court judge, everything is free for them. So even rent-free accommodation is free. You say furnished, non-furnished, everything is free. Of course, the Honorable High Court judges, Supreme Court judges. Yes? Next, central and state government employees. How do we tax for the government employees? There is a license fee which is prescribed by the government itself. So that would become the amount which is taxable for them. But what if I am giving AC and other furnitures along with that accommodation, which makes it furnished accommodation? In that case they say 10% of what you are giving, 10% of your cost, or if you have hired those furnitures. Very easy now to hire the furnitures rather than getting it built. Many facilities are there, many online options are there. So they say the higher charges. Along with the license fees, my higher charges will also become my taxable perquisite in this case. Moving to the latest amendment, Notification number 65, Corrigendum 72 of 2023 provides that in case of other employees for both furnished and unfurnished accommodation, we have a change in the rates of taxable perquisites. Earlier it was 15%, 10%. Now it is 5%, 7.5% and 10%. Why did this change and how? They have taken the basis of the census 2011 onwards for financial year 23-24. Earlier they used to rely on the census 2010. So then now they moved to 2011 census. In case if accommodation is owned by the employer himself and it is unfurnished, they say that if this census according to which it is less than 40 lakhs or more than 40 lakhs is the population limit, then you have to accordingly choose the percentage of salary on which your taxable perquisite will be. If it is more than 40 lakhs, 10%, less than 40 lakhs, 7.5%, rural areas, 5% of your salary. Same limits apply to the furnished accommodation, adding to which will be your higher charges or again 10% cost of your whatever furniture has been hired for you. In case accommodation itself is taken on rent, in that case the rent actually paid by your employer will be a taxable perquisite or 10% of your salary. If the furniture is also provided along with it, you add the rental charges to your perquisite. What if I'm staying in a hotel? What happens if I'm staying in a hotel? Can you see there is no accommodation for unfurnished? Do you see any hotel with unfurnished? Not possible. So there is only one option, furnished accommodation. And the limits for which is 24% of salary or the room rent or the hotel rent, whatever you pay. There is a situation, my employer is shifting from Delhi to Bangalore. I have asked him to stay in a hotel for next 15 days till he settles down, searches for a new house in Bangalore. So I will be paying all his room rent, I will be paying for his transportation. Taxable, not taxable. Up to 15 days not taxable. Anything over and above 15 days for the hotel stay is taxable. Rightly mentioned. This is the notification which I mentioned earlier, section number 65 of 2023, dated 18th August. So the new rule 3.1 has replaced the old rule 3.1, where it still continues to be percentage of salary, but the percentage rates have been changed to rationalize the valuation in respect of employer-owned accommodation, and this is done so that you match it with the inflation level of the country. Simple. No change for government employees, applies for other than government employees. One more small tweak here. What is it? They don't end with percentage. They say first year to your employee, Mr. Manoj, you have valued your perquisite. Now second year also for Manoj you are giving the same perquisite. So will I follow the same rules? There is a change from 23-24. With this notification they provide that perquisite valuation for second year will be based on what you are giving for the first year. So amount calculated for the first year into what is the cost inflation index for the tax year for which you are giving the perquisite, divided by the CII for the tax year in which accommodation was initially given. Let me make it simple and break it for you. 22-23 I have given RFA. You have already valued it to be 75,000. 75,000 into 23-24's cost inflation index divided by 22-23's cost inflation index will give you the perquisite for year 2. Why did they bring it this way? When you are giving for the same employee over and over again, why do you want to revalue your perquisite? The objective to bring this amendment is to keep it in line with the inflation. If you have to keep it in line with inflation, what is the factor you should consider? The cost inflation index. Simple. So first year, follow the formula or the rates what they have given. Second year, use the cost inflation index to bring it to valuation of the second year's valuation of taxable perquisite. Next, motor car given by company to the employee. If it is used fully for official purpose, it is free. Everyone knows it here, nothing new. But should I maintain anything for that? Yes, you should have a logbook. You should maintain a register where you have travelled, what is the purpose, how much fuel you have spent, how much is for the expenses. Only when the register is maintained with the details of kilometer travelled, you will be able to claim this fully as non-taxable perquisite. What happens? I am a director, I don't have time for all that. Please pay taxes, fully taxable. Yes? Plus, you should get a certificate from your employer saying it has been used for official purposes. Then, what if I am using the car what is given to me to drop my kid to the school? I am going out with the same car, personal purpose. What happens? Fully taxable. I have been given 2 cars, so one I can use, one my spouse can use. It makes our life easy. So what happens to the first car I am using for office? What happens to the second car? The first car, fully used for official purpose, is not taxable, while the second car is deemed to be taxable perquisite. Now I am using partly for office, partly for personal. Very obvious. very obvious and a practical situation. I don't use that car only to come to office. On the way I need something, I don't get down, don't do my personal work. That is not happening. So what happens in that case? If I am given even the maintenance expenses and the fuel expenses, then in that case my reimburse would be based on the car. If it is beyond 1600 cc or less than 1600 cc, per month I will be given 1800 or 2400 accordingly. I have a driver along with it, add another 900 per month for the chauffeur expenses. What if the employer himself is taking care of all the maintenance of the vehicle, fuel of the vehicle? In that case, 600 per month, 900 per month, again based on whether the vehicle is 1600 cc or more. So this is how the motor car perquisite is actually taxable. ESOP, RSU and ESPP. As I mentioned to you, the various names through which the sweat equity shares are given to the employees. So section 17.2 has clearly provided 17.2.5 sweat equity shares are taxable and it is included in the perquisite. Now there are situations when you cannot include it under perquisite and you bring it under IFOS. When is that and why? And I've used many names. I say ESOP, I say RSU, I say ESPP. Any difference? ESOP stands for Employee Stock Option Plan. RSU stands for Restricted Stock Units. ESPP stands for Employee Share Purchase Plan. Employee Stock Purchase Plan. So, what are the difference? The primary difference lies in the conditions with which the shares are allotted to the employees. If I give you shares and say that you can't sell this share next 10 years, you have to keep it with you, you have to stay with me. That is RSU, where I am giving you the shares, but you are not supposed to sell, you are supposed to keep it. When I say that my share price in the market is 1000 today and I give you an option where down the lane you can buy this for 1000 rupees in the next 3 years. Your share price may go to 2000, 5000, you don't know. But you are offering it to employees saying today's market value I am ready to offer you right away. So that predetermined price at which you are giving an option for the employee to buy down the lane of 3 years is ESOP. Why do I give such options? I make it a condition for my employee to stay with me. It is a way of compensating employees so that they don't leave my company. They have been working in my company, they know the rules, they know the work, and they are very valued employees. So I want them to continue to stay here. The only way to hold them back, to reduce the turnover of employees, is through ESOP. So in that situation, ESOP is given. Taxability of RSUs, ESOPs, employee stock purchase price. So I said everything on receipt taxable as perquisite. Very clear. Now I told there is a difference between ESOP, RSU, ESPP. How do we calculate in each scenario? Number one, when it is RSU, there is zero cash outflow from you as an employee. You don't pay anything from your pocket. It is given free from employer to you. So zero cash outflow. Employee will love it. But how do I value that free thing? It is not given to me in cash. How do I value it? How should I say this is my perquisite and I am supposed to show it, right? Taxable salary. I have not paid anything from my money. Nothing is going out from my CTC. This is something over and beyond. So what to do now? The valuation method says that the market value of the shares, the fair market price on the date of exercise or on the date of vesting, you can say, would be your taxable income as perquisite. When we talk about ESOP, I said you, I am getting at a price which is not in line with the market value. So it is simple. What price I am getting minus what is there in the market, that difference of benefit what I would be getting is my perquisite. Same applies to ESPP. I would be getting shares at discounted price, but here the difference in ESPP and ESOP is you are buying the shares from your own money. Only benefit is I am not buying at the current market value, I am getting a discounted or predetermined price on the vesting date. And the company makes sure that you have not granted all the shares in one tranche. It would be in 2 to 3 tranches minimum. They say first year eligible for 500 shares, second year after the completion of 2 years you are again eligible for another 500 shares, and after completion of 3 years you are again eligible for the last 500 shares, and totally you would be giving 1500 shares, through which it motivates an employee to stay for the next 3 years. But the benefit is, if I am getting the first 500 shares, I can go and sell it. I don't have to wait. I can quit the company. I am happy with 500 shares. I can quit. So, what happens in RSU? If you quit, you are not going to get the benefit. They have a restriction where you have to stay in the company for the conditioned period. That is RSU. How does ESOP works? There are shares offered at a fixed price to the employee on the vesting period. Once the entire period or wait period, what we call, is completed, the employees can exercise their ESOPs. Through the company's trust fund, it would be allotted to the employees. So as an employer, you should have lot of precautions, because legal expenses, trust expenses, trustees, and monitoring of TDS on this perquisite is also tedious. So from an employer point of view, the cost should be considered before going for an ESOP. And whenever ESOP is adopted, it is very easy for employer, where he can sell the shares and move on. Then, when shares are sold, what happens? When I am vesting, it is perquisite. When I am selling, capital gains. So if it is less than 1 year, more than 1 year, short term, long term will come into picture. If it is a listed company, 1 year is the time limit. If it is an unlisted company, 24 months. Any share which is sold less than 24 months in an unlisted company will become short term, taxed again at the rates. Then long term, taxed at 20%. Short term will be taxed at 15%. So what happens with a listed share? Listed share. If I am having a listed share and it is a long term, what is the rate? 10%. Only for unlisted it is 20%. So that is the taxation rate difference here. RSU tax treatment. I am an employee of Infosys. Infosys gives me shares, but very smart, not Indian Infosys, Infosys US, which is RSU. So suddenly in my salary, which was all income from India, there is a new component, foreign income. What happens when you have a foreign income? Anyone can specify?
It will be treated as unlisted.
Sorry, come again.
It will be treated as unlisted, and the capital gain will be 10% of the 20% of the.
Perfect. It will be treated as unlisted, and the capital gains will be accordingly charged. You are right. Other than that, we have disclosures to make foreign assets. Any time you forget this, or employee feels that I have done nothing with that share, it's lying. Employee has given, I have done nothing with it, and it was already taxed in my Form 16. I have seen it is done. Many of them have this tendency, we are very smart, online everything can be done, save money from CA. So they will not disclose foreign assets, and there are penal consequences for non-disclosure of foreign assets. You have to disclose the number of shares, the company details from which you have been received, the fair market value of such shares in the foreign country. You have to also disclose any direct tax treaty tax rates if applicable for such shares, or income received from such shares. Many employees don't even realize they will be receiving foreign income in the form of dividend on such RSUs, and that is definitely taxable as income from other sources, not perquisites. But you have to disclose it. Dividend income is taxable, and it is foreign dividends. What happens when dividend is received or when I sell those RSUs? When I am selling those RSUs or if there is foreign dividend, there will definitely be taxation. So when tax in foreign country is paid, are you asking the Indian employee or who is earning salary in India to pay taxes again in India? No. So you don't want double taxation, of course. So we refer to the tax treaty benefits. We file a form called Form 67 where you claim what taxes you have paid in the foreign country here in India and pay, if any, remaining tax liability. So how do we calculate that remaining tax liability? Here can you see Form 12BA disclosure where the point 16 talks about stock benefits. So the perquisite on the exercise date taxed by employer as perquisite will reflect here. So I know what is the perquisite value from here, I am taking it for my ITR. Now how will I know what is the dividend valuation, or how will I know for RSUs what you should do? If you are treating RSU as a perquisite income in India, in that case, the number of shares allotted to you would be after TDS. And how will that be? TDS is not some amount which is recovered from you in form of cash. The shares would be deducted. Say you have 1000 shares allotted, 30% tax. So remaining 700 are the shares what you have to consider to disclose in your foreign assets. So when you are talking about foreign asset disclosure, only 700 shares comes into picture. On that 700 shares, what is the fair market value on your exercise date? Which would be like from a certified merchant banker, or if it is a listed company, you get the document very clearly. So based on that, the value of perquisite can be derived. When you are getting that perquisite value, it is in US dollars. So I have to convert it into rupees. What date I will choose and from where I will choose the exchange rate? From where I will choose the exchange rate?
RBI exchange rate.
RBI's. So from RBI you will take the exchange rate, and based on that you will arrive at the Indian taxable perquisite income for RSU. Say you are assigned foreign shares, like I said, Infosys US. What are the things you should have? Disclosure in ITR, good. Form 67, already spoken. But disclosure of income, which is dividend. Dividend I have received on 4 quarters differently. In US it is calendar financial year, in India it is April to March. Now how do I take December quarter's income in India? How do I take that? It is still not generated, or it falls to the previous year, correct? You will take the income as per Indian income tax financial year, and the documents what you will require would be the dividend what is given by the foreign company. The employer will not give document, it would be assigned to a third party company. And that each day when the dividend is allotted, the USD conversion rate would be as per the date of dividend declared. And that would form your income from other sources. Foreign income will go to IFOS, foreign asset will come under foreign asset declaration. In spite whether you have a transaction previous year or not, if you are holding any RSUs, you should declare it. So every year you are just keeping it, still you should declare foreign asset declaration. Can I use ITR 1? I have income less than 50 lakhs. Can I use ITR 1? Having foreign assets. You don't have a foreign asset schedule in ITR 1, so you cannot use. Simple. ITR 2 is what we have to use for in case of foreign asset declaration. So what details comes in foreign asset schedule? I'll quickly run through this. Country, name, code, the type of asset what you have. Is it shares? Is it bank account what you're having, any movable property, nature of interest, whether you are a direct owner or you are a beneficial owner, date of acquisition and other details like address. Yes. Now how is my remote work taxed? I am an employee who is in India but I am working for US company, full-time remote option. So how am I taxed? My employer is not registered in India, he is not paying from Indian account, he has a foreign bank account and he is paying from his foreign bank account. He does not have PE in India. PE is permanent establishment. So how will that be taxed for me in India? There are many rules based on which the remote work can be taxed. Sometimes it is resident-based taxation, source-based taxation, or hybrid model. When we talk about residence-based taxation, employees pay taxes based on their residency regardless where they are getting income. Global income is taxable for all Indian residents. Am I right? Now when I am taking source-based taxation, employees pay taxes where work is performed. So section 5, read with section 9. If you are working in India, salary accrues in India, deemed to derived in India, accrued in India, taxable fully in India. So the foreign company should obtain and deduct TDS and then pay the employee. Yeah, so he has to do the TAN registration, he has to go through this, and treaty has to be referred for any double taxation arrangements. Hybrid model, which is combination of both. Country may exempt a portion of income which is earned remotely because you are working abroad. What is the responsibility of an employer in case employee renders service in India? So firstly, identify who is your real employer. Are you on the Indian payroll company or are you on the foreign payroll company? In which payroll are you on? Then, what is the PE exposure of that foreign entity in India? Do they have a PE here? Are you being reimbursed? Whether according to the DTO, which is tax treaty, is it falling under FTS? After examining these aspects is when you can tax such income as a salary. When it comes to expat taxation, if employee is deputed to India to render service, like you have seen Nama Metro, right? Many of the managers or the technicians, they're all not Indians. They're foreigners, foreign experts, technician experts. They are the expat taxation, what we are talking about now. Salary, either it would be fully paid by Indian entity or it would be fully paid by foreign entity. Or say there is an arrangement where partially Indian entity bears the cost, partially foreign entity bears the cost. Now I am an Indian entity, I am paying 15 lakhs, I will deduct TDS on 15 lakhs and pay to that employee. Is this correct? Is it correct? Remaining 15 lakhs is paid by the foreign entity. Is it my concern? I am not paying 15 lakhs. The foreign company, say Japan company, they are paying 15 lakhs and Indian company is paying 15 lakhs. What is going from my end is expense for me, which is 15 lakhs. I am paying 15 lakhs, I will deduct only on 15 lakhs, right? Wrong. What do you think? There is a High Court judgment which says that, Supreme Court judgment which says that because his salary is accruing in India, he is working in India, the employer is required to deduct combining both foreign income and Indian income and deduct the TDS on salary. So you will have to disclose here while filing your ITR entire income. If any refund based on the DTA, you can claim an exemption.
But ma'am, if the employee does not disclose that income,
The employer will be deducting TDS, so he will eventually get a notice.
how the employer will be known that he is working with other company as a...
No, he is expat, so you will have a holding subsidiary relationship. So I'm talking about that. When you have two different employees, yes, of course, I understand. The employer will not be able to do anything. So that is a situation where you are working with one employer and you move to another employer, and the other employer will not have any information of previous ownership. So when I'm talking about previous employee, how many of you believe it is important that an employee should disclose previous employment details? Yes, perfect. Right? What is the consequence if I don't disclose? Come on, I am working right now in Infosys. I don't want to come and tell next in my new company that I was drawing this salary in Infosys. I have negotiated for a better pay. So I don't want to give details. Why should my employer know my previous details?
The slab rate, because up to 10 lakh, above 10 lakh, 30%.
Yes. So say that I have joined my new company only in the month of Feb 2024. I will be working only for Feb and March. And my CTC boils down to say only for those 2 months, I am paid 1,50,000 per month, which is 3 lakhs. Do you think 3 lakhs is taxable? employer has any obligation to deduct TDS? No. Previously I was earning 18 lakhs. Which slab do you think you are falling in? 30% slab. When I am having 18 lakhs, 30% slab, when I add this new employer's salary of 3 lakhs, I will end up paying that remaining 30% with interest and late fees. Why interest? No advance tax paid. So employee had to disclose the previous employment details. That is the most important tax planning which any employee who is shifting jobs should remember.
What is
Always.
the late fee? What is the late fee?
Interest, it means interest on late payment of advance tax. So you have non-payment of tax, 234A, B and C, and again late payment of advance tax for the late payment of quarterly installments. So if employee has failed doing that, yes, the payout will be very high. I had a personal experience. I had an employee who had failed to disclose his previous employment to his new company, and in that situation, he had to pay taxes of 1,75,000 additionally from his pocket, which was unplanned. After I sent him the computation tax payable, he was shocked. He could not afford from his take home. He had to eventually pay with his credit card. So that would be the consequences when it goes so unplanned. So always make sure that either you pay advance tax if you don't want to disclose, or you disclose to the previous employer details in your new organization. Retirement benefits. So this would be what employees will be interested. How much is my company paying for me? My take home is hardly anything. When I negotiated, I thought I will get 2 lakhs to my account. Now I am getting only 1,25,000. Where did the remaining go? PT, ESI, PF, VPF, NPS, health insurance, income tax, TDS, everything gone. Hardly I am receiving. So he will be interested where is his money. On proper tax planning, he can get a better take home if he devises which tax regime is good for him, which allowances, perquisites he should choose from. If that is well planned, he can definitely see to that he has very acceptable take home salary. How do you do that? Understanding or taking expert advice of what are the components in your salary CTC and how you can negotiate with your employer. Provident fund. So it is a retirement benefit what is given to the employees for their social security. You have 4 types. Statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. So when I am talking about 4 different funds, there would be 4 different ways the income from which you receive from such funds contributed towards each fund will be taxable. Starting with, when I say recognized provident fund, it means it is recognized by the income tax officer. PPF, Public Provident Fund. The fund is available for public to invest in it up to 1,50,000. Minimum amount is 500 rupees. Statutory Provident Fund, recognized by any government funds, or it should be recognized under central government organization or state government backed up funds. Unrecognized provident fund is very clear, not approved by the officer. Employee contribution towards provident fund, we all know section 80C, it is exempt. What about employer contribution? When I am talking about recognized provident fund, up to 12% of my salary, it is exempt. If my employer wants to contribute over and above that 12% to the RPF, then that is taxable provident fund. When it is PPF, it is not taxable, and statutory provident fund, anything which is employee contributed or employer contributed, you have a benefit to claim under 80C for employee contribution, while for employer contribution not taxable. The interesting part is when I have to withdraw. Now, which are the funds which is more beneficial? Of course I will withdraw, I am not leaving my fund there. So what is going to be more helpful for me? When I talk about Statutory provident fund, it is always called exempt fund. Interest is exempt, my principal what I contribute is exempt, and what is my employer contribution is exempt. When I withdraw, the lump sum is also exempt. When it is recognized provident fund, exempt based on certain conditions. What is the condition? On completion of 5 years of service. If I withdraw the fund, it is not taxable. So I want to leave company, I have completed 5 years, can I withdraw and I am joining new company in 10 days? Will this condition still hold good? I have completed 5 years in previous company, can I withdraw? Before joining the new company, you should have 2 months gap. You should be unemployed for 2 months to have this exemption. Then, when it comes to unrecognized provident fund, the employer contributions and the interest earned on such unrecognized provident fund will be taxable under income from other sources. When it is from employee contribution, the interest is taxable and employee contribution and employee interest income would be under income from other sources. The employer contribution would fall under salary. Gratuity. So there is an amendment here. Earlier the limits and what is the minimum limit today is different. Now the limit under section 1010 gives the basic limit as 20 lakhs. It was 10 lakhs before. I think prior to 2018 it was 10 lakhs. From 2018, based on a notification, it has been updated to 20 lakhs. Anything received during employment, fully taxable. Gratuity is meant to be retirement benefit. So retirement benefit received after retirement for a government employee, fully exempt. For a non-government employee, you have restrictions and the computation is based on whether your gratuity fund is covered under Payment of Gratuity Act, not covered under Payment of Gratuity Act. So the exemption limits also vary. Anybody only who is covering under Payment of Gratuity Act will have 20 lakh basic limit. If you are having an uncovered one, it is 10 lakhs. So that is the difference. And are all the retirement benefits taxable? When I talk about leave encashment, it could be gratuity, it could be pension, it could be PF. How does that work? For government employees, yes, all are exempt. When it is non-government employee, then the gratuity PF, you have limits for computation. To summarize, if RPF received after 5 years of completion, again exempt. No exemption is available from financial year 23-24 onwards, 22-23 onwards. In case of any interest which is accrued for RPF and statutory provident fund for the contribution which is made by the employees, which is beyond rupees 2,50,000 rupees. So it was 5 lakhs in case if my employer is not making any contribution and only as an employee I am making all the contribution, I am earning interest on that. Government says 5 lakhs will be your limit. But if both employee, employer are making contributions to that fund, then it would be 2,50,000. So the CBDT has given this notification via 95/2021 dated 31st August 21. And Rule 90 prescribes the computation of the limits there. Old tax regime versus new tax regime. Very interesting option. Which should I choose? Whether should I go for old regime or new regime? And why is the new regime better or the old regime better? Simple rule, you have more deductions and you have higher salary slab rate or your CTC is higher, the more the deductions, the old scheme becomes more useful. If you have less deductions, go for new scheme because the slab rates in the new scheme are less or which is very minimal tax rates. Can you see this comparison? Tax under section 115 BAC under new scheme and old scheme. So say my income tax is 1 crore 20 lakhs. Then under new scheme, I will not be allowed for deductions for professional tax, interest loss from house property, any of the chapter 6A deductions. So my income which is taxable under the new scheme is higher. Also please note that the employee is having a surcharge here. So his slab rate is high. when your claims, deductions are higher, the old scheme proves to be tax effective. So as a tax planning tool, you can opt for old scheme compared to the new scheme. Here, the tax savings made is 71,494 rupees. So definitely this is a huge amount when you have to go. And what is the default scheme from the financial year 23-24? It is new scheme. In case the old scheme has to be opted by a salaried individual and he has by mistake selected the new scheme, or he has not gone to his employer, mentioned that please tax me at the old scheme, he can do the changes at the time of ITR filing. So what are the exemptions that I cannot avail in case I am opting for new tax regime? The leave travel concession under section 10(5) HRA is not allowed. Any exemptions like professional tax, entertainment, perquisites of meal vouchers. So most of the deductions like ATD, ATG will not be allowed here. ATE, ATTTA. So all those benefits will be lost when you are looking for the new tax regime. Any questions so far before I move into the FAQs? Yes.
Employer contribution to NPS is allowed under new.
NPS is allowed, employee contribution, you're right.
Employer contribution and employee
See,
contribution.
tier 1, tier 2, I think it would be the employer contribution. And when you're going for tier 1, 50,000 voluntary payment, ATCCD 1, that is not allowed. ATCCD 2 is allowed. Yeah?
My RSU taxation, out of my, suppose I'm allotted 7,000 shares and 300 shares are taxed as my TDS and I get credit of 700 shares. So my purpose would still be 1,000 shares per market value, right? And not 700 shares.
Yes. Your purpose remains same. But what assets you are holding, declaration will be 700 shares.
So then my declaration will be for 700 and the difference of 300 I can still claim it as my TDS credit.
TDS credit you cannot claim because you are not paying tax. They will deduct the 300 shares on account. It is credited only 700 shares.
Correct, but the benefit of 300 I am taxing 1,000 shares.
Correct.
So the benefit of 300 I would still be able to claim it as my TDS.
In form 67, yes.
Yes, so I don't have, it will not be a DD, it will not be a double taxation.
Double taxation,
I
yes,
have
yes.
paid there as well and here also.
Correct, correct. It will not be doubly taxed. So say suppose average rate works out to be 18% what you have paid there, and here your tax rate is falling to 34%. The remaining amount would be only taxable here. Through form 67, FTC can be claimed here for the remaining amount. So whatever 18% you have paid in the foreign country, claim that taxes through form 67 and pay only the differential tax here. And that disclosure should again be given what is taxable in the foreign country, what is taxable in India, and what is taxable as per the tax treaty in the foreign asset disclosure. It should match with your income tax computation. Yes.
When you do your exchange conversions, do you do on vesting as well as on sale or only on the sale?
See, on vesting you do for perquisite, on sale you do for capital gains. On both you have to do.
Correct. So vesting will anyways come as purpose. The employer is calculated.
Calculating, correct.
When you are doing capital gain calculation, so let's say ESPP I got on an every month on month basis.
Correct.
Then I will have my purchase value.
Yes.
So then we calculate month on month.
Month on
exchange
month.
And then
Yes,
total.
yes, it is not average rate. It is month on month. Each day you have to consider. It is not average rate.
What about the TDS on the dividend which gets reinvested?
Yes, that is what you have to declare under income from other sources. What dividend you get reinvested, you will have to show as income from other sources. That might add as additional shares to your existing number of shares, but that will also be again subject to TDS or tax in the foreign country. And that again you will file and claim it under Form 67.
So even though I don't get the dividend as money, I
Correct.
will declare it as other source
Yes.
and file form 67.
Correct. Yes.
And what about
So now your new number of shares is what you will have to declare in the foreign asset declaration schedule, including the new dividend added shares.
yeah, so at one point we will sell all these shares, right? So what will
Yes.
become the cost of acquisition for this dividend?
Fair market value.
I thought we don't need to show, we just declare the number of shares, dividend reinvested. We just declare as a number of shares.
No, see, when it is adding to your shares, it is not given by employer, agreed. But it is an income which is still earned globally. Being a resident, global income is taxable for you. Going by that rule, you will have to declare the foreign income dividend receipt also. And any taxes paid in the foreign.
We're converting it, the dividend is not even
Yeah, whether it is in cash or kind, it is an income. So that's why you will take the fair market value. Dividend amount is again valued. When you see the document, they clearly give you what is the cash component or cash conversion of that dividend component, which they are converting it into shares. So that cash component is what you will consider, convert it to INR for dividend calculations. So, and you will also claim the Form 67. Why you will do this? Because they would have filed their tax deduction forms in the foreign country, and you will end up showing a higher number of shares in your foreign asset declaration compared to previous year. Previous year was 700, now it is 725. So you will have to explain somewhere in your computation where did the 25 come from, right? So that would form income. And again, when you are selling, you will take the fair market value. Yes.
How can we correct if this foreign asset was never declared in the past?
You start declaring now.
So we will
Before you
say
get a
foreign
notice.
asset-
See, it has happened with many of the employees where they are unaware that they have something called RSUs. They have always kept quiet that it has come in my Form 16 and it is done. They don't know the concept of foreign asset declaration. They don't know the concept that dividends are accruing. All they remember is I was receipt of something and it is lying. I have not done anything with it. But we are the advisors where we come. We do the additional part of advising our clients that in case if you have RSUs, please disclose us all the details relating to that so that at least from the current year you start declaring. You cannot previously go and say why you have not declared. That is damage done. But currently you can start declaring, and yes, ignorance of law is not considered by the department.
So we will take the entire amount as additions instead of foreign.
Sorry?
So in a case where the foreign assets were never declared.
Yeah.
And we want to start declaring from this year.
Yeah, so you will declare, see, perquisites was already dealt in the previous Form 16. Now you will just disclose that in the foreign asset disclosures, that's it. You will start declaring the number of shares and to what value or the market value it is there today. That is what is required. So you will continue to just disclose it. Nothing will happen in your computation. It's a additional disclosure criteria. Yes. Anything else?
Whether we should disclose only the vested RSU or even the unvested ones.
Vested RSUs. So unvested will not be allowed for you to sell, right? You don't have the condition is you cannot sell it. So it is not currently your income.
Let's take the ESOPs. Granted, ESOPs are granted.
Correct.
Vested.
Yeah.
You cannot excise the option.
Correct.
So the option itself is asset.
Yes, yes. You have not excised, right?
Not excised, but will you declare that also?
No, it is not, no perquisite, right? No asset.
No, the option is asset. I'm telling in normal parlance,
Okay.
that's a right.
Yeah, that is a right to exercise. Only when you exercise it becomes valid. I have not exercised my right. I have foregone my right. So you don't have to do
No,
that.
it is not. It is not lapsed.
Oh,
I
it
have a
is not.
vesting period of 4
Okay.
years,
Huh.
where I have the vesting period of not vesting.
So the day you exercise the shares is the day when you declare it as perquisites. Until then, you don't bring it as taxable
Perquisites is
perquisite. Okay.
Disclosure under foreign assets.
So you have not exercised. It has not come to the credit of your foreign demat account.
Shares have not come to the grade of my.
Correct.
That's understood. The options part,
Yes.
which only when I pay the token amount, whatever,
Yes.
will become share.
Correct.
In the meantime, I have the option
Hmm.
to buy it at that lower price, which I
Correct.
have not yet exercised. But
Yes.
that right still remains with me.
Correct.
That do you recommend? That do you recommend?
No, not necessary. You don't hold anything in your name in the foreign land, you don't have to disclose. Unless you have anything which can be valued monetarily, you cannot bring it in. That is something which is a non-monetary aspect. I have a facility to exercise the right. That cannot be taxed unless you exercise it. Yes.
Generally for FTC on dividends, we will, because in foreign countries it is calendar year,
Correct.
get TDS of 9 months. We will get to know.
Correct.
But generally for Jan to March, we will not
You will not get
get
it.
to know. So how to
Pro rata basis.
By me.
Pro rata basis.
Yes. See, you will not be getting the TDS certificate for Jan to March. You will be getting only for the 9 calendar months
Correct.
where tax is deducted. For the remaining 3 months, they would have still not gone ahead. You can claim only what is paid. You cannot claim what will be paid.
Sometimes we will not get to know the bifurcation of how much is for what amount.
See, whatever is paid through the document, it is available. The challan or the document which says this is the tax amount or the TDS on those dividend will be available, and which is relevant for the 12 months. That is from previous year's Jan to March, which is for the previous year, which is not relevant for our financial year. You have to remove that on pro rata basis. Consider only the period for which it is relevant to us.
Do we
So-
have any case law reference? for
Case law, I can come up with it. Sure, I can come up with it.
Can we not go by the broker statement? Like you said,
Broker statement, that's what it is, calendar year in US.
correct. So in the calendar quarterly statement when you generate for any broker,
Hmm.
when they pay the dividend, they also withhold the 25% FTC.
Yes.
So you will get the amount right there.
So what he's saying is, in a situation where you don't have a document which can give you the clarification of entire period for the year, calendar year is given. You don't have the detail which is for the quarter 1, quarter 2, quarter 3, quarter 4.
Like you're talking about 1042X.
Yes.
In case of US.
Yes.
I'm not talking about that. So that is a annual statement.
Yeah.
Like a TDS certificate.
Correct. What you're saying, quarterly statements we
From
can
broker,
get
broker.
from the broker. It is available, but not every employee is able to provide.
In that
There is,
case, you
yes,
will
in that
provide.
case you can take on a pro rata basis.
But if you have it,
Yeah, definitely. Go by only the quarterly statements. Consider Form 67 only for the 3
so
quarters.
in the form 67 where you have to do the attachment,
Yes.
it's recommended that because we are relying on that particular document.
Particular document, it is also better you annex the 1042S along with it. Along with the broker statement. Correct. To match your workings or your claim in Form 16, you can take that consolidated quarterly statements plus 1042S is recommended. Anything else? So FAQs, does leave travel allowance cover food and stay expenses as an exemption? So obviously no, it is not. But still my employer pays me. What happens then? Taxable allowance, fully taxed. So there is a case law which provides that only the travel expenses is something that can be exempted. Club membership to employees, again fully taxable perquisite. Pension income, whether it is taxable as salary or should it be IFOS. Because I am receiving this after my retirement, I don't have any more existing employee, right? Should I still tax it under salary head or income from other sources? Salary, why? Past employment, this is coming as PLOS. Say that is profit in lieu of salary, this is from the employer-employee relationship existence itself. And this is part of my CTC component. That is what, from where I am getting my pension income. However, pension received from United Nations organization is fully exempt. Is family pension taxable as salary? No, it is taxable under the head income from other sources. And is leave encashment taxable as salary? I have for a year, say 30 leaves. I have used only 15. For the remaining 15, I am paid from my employer. So, am I fully taxed for that 15 or how is it? So, section 10AA provides for exemption if it is received by the family after the death. Otherwise, fully taxable if you receive during your service. But if it is received on retirement, there is a computation where they provide you take the least of the following amounts. In that, I think up to last year, the amount was 3 lakhs. And from current year, it is 25 lakhs. I have a notification for your reference. Okay, it is not opening here. Okay, we'll move on. And if I have not sold any foreign shares, I am holding what previously I received, as I mentioned before. ITR 1 cannot be fined, you will have to still disclose under foreign assets. What is Form 12BB? I show you many times Form 12BA, Form 12BA. What is BB? What is Form 12BB? It is the declaration given by employee to the employer regarding his other income, housing loan, the deductions he wants to claim. Say ATC, ATD, ATG, I have interest on vehicle loan, I have interest on education loan. So he can claim all those and provide the details under Form 12BB. Based on that declaration, at the start of April, I've seen many companies have the process set where in the month of April, for the entire year, they take a declaration from the employee asking all their deductions and the type of regime they want to choose for taxability based on which the TDS would be computed. Will there be a chance for employer to recompute this? Yes, when? In the time of proof verification, or what they say, generally all the documents submitted during Jan, Feb, December period. So final declaration is taken by employer along with the original proofs and documents. Based on verification, what final TDS would be deducted. The employer will assess if any short deduction, it would be recovered from the future months. When can relief under 18(9) section be claimed? So if there are salary from arrears, family, pension income, gratuity which is more than the exemption amount specified under section 10(10), again specified conditions for the same. Any compensation that has been received on termination of employment or cessation of the employment. Commuted pension which is more than the exemption limit specified under section 10(10)(a), again rule specified for claiming such exemption under rule 21(a)(5). So the rule is very clear about to what extent you can claim with what conditions. So I'll finally end it with a summary. So we have gone through the various salary components, which is allowances, fully taxable, partially taxable and exempt allowances, perquisites, the major one being the sweat equity shares, rental free accommodation, car perquisite. So the others were the retirement benefits, which could be the provident fund. We have looked into the leave encashment, we have looked into the gratuity. There are many other complex components which can still be brought. I've just touched upon the cross-border taxation. I've not gone into depth when it comes to the remote tax work or when it comes to the expat. That is again a detailed discussion which will be dealt when they are talking about the TDS on salary, whereby foreign employer, when the employer has to do even for the expats. Then moving, we have also seen whether new tax regime or old tax regime is beneficial and how you have to choose one. It is specific case to case basis. You cannot advise a standard template saying to them, you choose new regime, that is useful. If they have salary income only up to 7 lakhs, no point in looking at deductions. You can straight away go for the new tax regime. If they have anything which is in the say 20 lakhs, 30 lakhs, definitely it makes sense to understand what are the investments and savings done by the employee, and then you recommend whether you have to go for the old tax regime or the new tax regime. And disclosure of previous employer is very important. That's what we have looked for. What professional opportunities as practicing professionals we have in this?
Before this,
Yeah.
changing a rule, that new regime to old regime.
Old regime.
Old regime. So one time I can modify, right?
Correct.
So second time I cannot modify.
That is different for salaried employees.
For salaried employees only. I'm
You
not-
can claim every time at the time of filing, every year.
Every year I can change.
Yes, what you're speaking is for the business employees where only once they can revert. For salaried employees, every year you can change.
Every year you can change.
Yes. So what professional opportunities do we have? Most important, practicing professionals, we have to understand what we have in it for us. First thing, payroll services. You can provide the payroll services that includes designing the structure of CTC components, where you see the cost to the company and the tax planning for the employees are done in a very agreeable manner to both the parties. When you are seeing only cost to the company and if it is not in the benefit of employees, definitely employees will not be happy with it. Then TDS for the employees. So it is a monthly compliance what we do, TDS deduction and TDS payment. quarterly TDS filing. Form 24Q, which requires a detailed annual return filing. So that is another avenue what you can look for. And currently there are more opportunities for work from home options where you have tax advisory, where you have to look at both Indian tax laws and the foreign country tax laws and then go on advising. So that is also untapped. Then NRI or expat salary taxation, where you have to look into the FTC tax claim forms. So again, DTA is part of it. Proof verification services is another way. One where you examine the documents before you provide for exemption of HRA or the LTA, medical allowances, or any allowances which they are actually claiming the actual reimbursement of expenses to the company. So that could be another avenue what we can explore. So thank you all. Anything, anybody who have a query, we can definitely take up now. We have a lot of time. Yes. Yeah. So thank you everyone for your patient listening. I know it is a lot to sit to us, to continuously listen to the speaker without taking a nap. So that is the biggest challenge. And thank you RCI for giving me this opportunity to take up this session. Thank you everyone. Any questions, anyone? Did they want to take yes to go to forward? And filing time we can shift to forward.
It is not covered in Form 16.
That is fine, that is fine. At the time of filing, you can change. And this year, many employees by default, because it was new tax regime, they have forgotten to go and opt for the old tax regime. So many of them now unwillingly they have to continue. Unless you change it during your proof verification time, or you can change it at the time of filing. You will have to have the proofs. You get it, definitely you will be your right in getting a deduction, but you will have to have the proofs.
I request Geeta Amy, CA Geeta Amy Madam, Chairperson, SARC, present moment to the speaker. We'll break for tea and reassemble at 6:30 for the next session. Thank you. Welcome back members to the next session. Speaker of the session is CA Vaishya. I welcome him to the dais. It's my privilege to introduce the speaker. CA Varshit has cleared his chartered accountancy in first attempt in 2016 and has post-qualification experience of 8 years in the field of taxation. He is an all-India rank holder in CA CPT, IPCC and CA's executive examinations. He was previously working with EY and has worked on conceptualization and development of investment and operational structures for various international clients through setup of AIFs in India. He has engaged in devising various tax efficient alternatives to structures, entry or exit of foreign investors in Indian companies and handled engagements involving tax and regulatory aspects related to various business combinations such as acquisition, mergers, and sale. He is currently working as manager taxation as part of HNI taxation division of Suresh & Co. Chartered Accountants, wherein he works exclusively with many high net worth individuals and family offices and assists them with advisory, structuring, compliance and litigation, the legal tax and regulatory matters on various transactions. With this brief introduction, I hand over the floor to the speaker.
Thank you, sir, for a lovely introduction. And good evening, everyone. Hope everyone is doing well. We had a session in the afternoon relating to section 15 to 17, which talks about predominantly on the tax implications of section 15 to 17, which relating to salaried individuals or the income from salaries, perquisites, etc. So in this regard, as we have clearly understood the analysis and implications of the tax provisions under section 15 to 17, it is also equally important to us to understand how the tax planning works with respect to those sections. For example, we would have learned about, let me quickly jump into certain provisions of house rent allowance. We would have learned about house rent allowance because that is a common salary component with respect to any salary individual. But what is the tax planning that we can do? As such, under Income Tax Act, we have an exemption under section 10, which provides us that there is a certain criteria, least of the three, that is actual HRA received, whether it is 40% or 50% of the basic, and the rent, actual rent paid minus 10% of basic. These are the three conditions subject to which an exemption is allowed under Income Tax Act against the HRA received. This is predominantly when we are actually living in a rental accommodation where we are paying rent for the house that we are staying in. But when we talk about tax planning, I am talking about scenario where there are employees who are actually staying in the accommodation of their parents, or they are staying in accommodation with their spouse where the property is owned by the spouse, but they stay together, but there is no rental expenditure incurred by the employee. In that case, what sort of tax planning can be generally adopted, or what is the structure that can be created so that there is some kind of tax saving that can be taken care of? In this regard, what I would like to present here is a special tax planning case in case of HRA. This we would have already seen in course of our practice where some of our clients might be adopting. Let's say the employee is staying with a parent, or is staying in a relative's house, or in staying with in a property which is owned by the spouse. The employee can still pay rent to the spouse or the parents or the relatives and can still claim HRA exemption. There is nothing in the Income Tax Act that prohibits the employee from not claiming the HRA exemption, because as such the relative is against a separate assessee assessed under the Income Tax Act. And the same way, even the employee is also incurring the rental expenditure against the HRA allowance received from the employee. So for this, there is a case law which actually is against the assessee, but there is a learning that we can take from the case law. So just to give a brief introduction of the case law, Ms. Meena Vaswani, she is also a chartered accountant. She has paid rent to her mother and claimed HRA exemption. In fact, the exemption was disallowed by the income tax department, saying that she is not eligible for claiming the HRA exemption. But if we keenly look into the details of the case law on what grounds the HRA exemption has been disallowed, she claimed that there is no rental agreement as such. She has been paying rent in cash. There is no proof of payment for rent, and the mother has not been filing any income tax returns. So all these have been keenly identified by the Mumbai Tribunal and said the HRA exemption is not allowed. But in the same case law, the Tribunal has also made an observation that it is not barred in the Income Tax Act that you can't pay rent to a relative and claim HRA exemption. The only thing is there should be a genuine documentation proving the substance of the transaction. Only when HRA exemption can be claimed. So considering this or drawing the views based on the views of the Mumbai Tribunal, what we can understand is that even if it is owned by a spouse or even if it is owned by the parents, if there is a proper rental agreement put in place with the spouse or parents or relatives, and the rent should be paid in the market norms to the particular relative, and there should be a proof of payment, like there should be a proper bank channel transfer of the rent to the particular relative or assessee or the spouse, and if there is TDS applicability, for example, let's say the rent is more than 50,000, then the assessee should sufficiently deduct TDS at the rate of 5% on the rent paid. So if all the proper documentation is put in place, all the compliance is taken care, and the corresponding rent should also be offered to tax in the hands of the recipient of the relative, whether it is a spouse or a parents, then this HRA exemption can still be claimed. There is no bar in the Income Tax Act that HRA exemption cannot be claimed just because you are paying to your relative, because relative as such is a separate assessee under the Income Tax Act. There is another case law which is slightly unique with respect to same facts, because one, now we have established that even if it is a spouse or relative or parents, as long as there is proper documentation, proper proof of receipt and proper claim of exemption in the assessee's hands as well as disclosure of the income in the recipient hands, the HRA exemption cannot be denied by the Income Tax Act. But there is a case law which is slightly unique with its facts. One such case law is the Delhi High Court judgment in case of Abhay Kumar Mittal versus GCIT. So in this case what has happened is, I'll just give you a brief of the facts of what happened. The assessee has purchased the house in the name of his spouse and both of them are staying together. In the rent, assessee has claimed that he has been paying rent to his spouse and claimed HRA exemption. The income tax officer allowed the HRA exemption, but in fact clubbed the rental income of the spouse in the hands of the assessee and said, this house is purchased by you in the name of your spouse. So there is an inadequate consideration. So the income from the asset should be clubbed back in the hands of the transferor. However, the assessee defended saying that it is a fact that assessee has purchased the house in the hands of spouse, but the same amount has been created as an unsecured loan in the books, which means the house is purchased based, in fact by spouse, but by way of an unsecured loan from the husband, and hence the rent paid by the assessee to the spouse should not be clubbed because the loan has been consistently repaid and the assessee was able to show the proof of payment from the wife. And one more important point to note here is the assessee's spouse is also a earning individual, whereby she has some income to repay the loan over a period of time. It may not be immediate, but it's over a period of time. Based on these facts, Delhi Tribunal has ruled in the favor of the assessee, saying it is justifying two aspects here. One, the HRA exemption is allowed, even the assessee has purchased the house in the name of his spouse, but since there is an actual rental payment and rental agreement and the rental income is also offered to tax in the spouse, the HRA exemption is allowed. On the second front, they are also saying that the income cannot be clubbed because the house is purchased based on a loan between husband and wife, and the loan between husband and wife is also treated as par with a normal loan even if there is no interest bearing, and there should be a proof of repayment of such loan. As long as there is always a documentation and genuineness when we prove a transaction, what we call like substance over form, when we are able to prove the substance, this kind of tax planning can be adopted in case of employees who are actually receiving HRA but are not actually incurring a house rental expenditure, But this house rental expenditure can be structured through the relatives, whereby the exemption can be availed in the hands of the employee, and also the rental income should be offered to tax in the hands of recipient. For this purpose, one important thing is that the other person who is receiving a rental income, it is essential that we should ensure that the rental income is taxed at a lower tax slab than what the assessee is claiming exemption. Because if the other relative is also an earning member, where the income is, or the additional rental income that we are going to offer is also going to be taxed at 30%, and the assessee himself is also offered to tax at 30%, then there is no tax planning here. This tax planning will work better in case of employees like who are staying in the parents' house, where the parents are not earning any rent, income as such. The assessee is the only salaried employee. However, if the assessee is able to establish the house, the rental paid to the parent, and the parent is offering it to tax in his tax returns, then the parent will effectively not pay any tax on the rental income, but at the same time the assessee would be able to claim exemption on the rental expenditure. This is one kind of rental related tax planning that we can adopt or suggest to some of our clients depending upon case to case basis, because this is again is not any grey area. This is a black and white concept, because as long as there is a proper documentation, there is proper rental agreement to be in place, there should be month-on-month rental payment should be in place. As long as we maintain the documents clean and right, there is the income tax authorities cannot deny the HRA exemption to pay to the rent relatives. One more tax planning alternative with respect to perquisites. So generally what we have observed, or what I have observed in my experience is, there are different types of perquisites rolled out by the employees these days, especially to retain the new age employees. One which I have observed in the startup economy is relating to ESOPs. Like we have already learned in the previous session also, that there are different types of ESOPs that are being rolled out. One is ESOP, RSUs, employee share purchase plan, stock appreciation rights. Like just to give a brief overview of stock appreciation right is that stock appreciation right is similar to ESOP, but in case of ESOP, if you exercise the option, you will get the stocks. But in case of stock appreciation right, you will only get the appreciation amount in cash. So how does it work is, if as of today you are given a one stock appreciation right, where the market price of the share is 1000 rupees, and you are given a vesting period of 3 years. At the end of 3 years, if the 1000 rupees stock price becomes 10,000, you will be eligible to receive that difference in the market price, that is 9,000, as a cash consideration. You are not getting any stake in the company, but you are able to monetize the appreciation value in the employer's stocks price. So that is how stock appreciation rights work. So all these ESOPs or stock appreciation rights are now being given by the startups, because at the earlier stage, generally startups will not be able to offer high packages as compared to the other companies in the market. So what they would try to do is, they would try to give a compensation which is both fixed plus stock component. So there will be a certain amount which is in salary component, there will be a certain amount which is in part of ESOP or stock appreciation rights. That way they will be able to retain the employees for a fixed period of time, let's say 3 years, 5 years, 7 years, till the startup makes it big. Even the employee, if he believes in the company's growth potential, he will also be accepting to the plan where he gets both salary as well as stock appreciation, because that is inherently for him is growing in the company for which he is working for. So he will put in more efforts to make the company big. So there have been different kinds of stock related perquisites that are offered by the companies. But when we actually dig deep into those scenarios where the startups sometimes get acquired by bigger companies than them, or when there is a private investor coming and investing into the startups, there might be a chance of coming into certain unique scenarios whereby we can adopt certain tax planning measures that I am trying to adopt here. For example, let's say there is a company, a good startup which has obtained a very high amount of valuation, and a private equity investor is ready to invest into the startup. Now the private equity investor will place a conditions that now you have given ESOPs to previous employees who have left the organization, but they have completed the vesting period. So the vested options are there with them, and they have a right to exercise at any point of time. Now if a private equity investor wants to put his stake into the company, sometimes he wants the cap table to be clear. He doesn't want any ex-employees to be there on the cap table for any decision making purposes. So he will put a condition to the startup saying, you buy back all the stock options that you have had in the company, whether it is current employees or past employees. If there are any stock options which are vested but unexercised, where there is an option of exercise by the employees, he wants the company to buy back all those options. In that scenario, generally what happens is the startup will value those ESOPs, vested ESOPs, in the similar line with the acquisition price. Let's say the private equity investor has determined a price for acquisition. They will also value the vested ESOPs also at the same price, and they will roll out an offer of buying back or surrendering or cancelling the rights that they have, saying that this is an option available or open for a certain period. All your vested options, this is the last opportunity for you to exercise or surrender to us for an amount of cash consideration. That cash consideration will be equivalent to the price at which the private equity investor is willing to invest in the company. And let's say ESOPs are not generally very liquid instruments as such, because unless you have a share in hand, as such unlisted equity share itself is an illiquid, and the right to exercise an unlisted equity is more illiquid that way. So all the employees will actually be willing or tempted to get their stock options monetized in this offer. So what happens is when this offer comes up, they will accept the offer and willing to surrender all the rights that they have in the vested options, and they will get a cash consideration. Now, this cash consideration, what should we call in the hands of employees? The general answer would be salary, because at the first place I have got these ESOPs only because of my past employment in the company. So even the company will also take the same stand, saying that these ESOPs have been given to the employees only because of their past employment. So on this ESOP, on the cash consideration that I am paying to you, on this buyback or surrender or cancellation, I will deduct TDS under section 192 at the maximum rate 30% plus surcharges, and the balance amount will be distributed to them. But employee, should he still show this as a salary income, or can he adopt a different stand in this respect? Because if it is a salary income, there is no much tax planning that I can avail. The only way I can show this or I can make any tax planning with respect to this income is capital gains. But how do I present this particular income as capital gains? One, if it has to be a capital gains, there should be a capital asset, then there should be a transfer of capital asset, only then there will be a capital gains income. But how is a buyback of ESOPs or a surrender of ESOPs can be qualified as a capital gains? So for which there are some case laws which says that one is this Bangalore Tribunal in case of NR Ravikrishnan and ACIT. There they have been occasion to examine the taxability of ESOPs when they are bought back or surrendered or cancelled. So there, when they are analyzing in detail, they are saying if we have to go back to the capital asset definition, it says property of any kind, and property as such includes shares. Shares is directly included in the definition of property. But what I have as part of ESOP is right to get a share. So any right to in a property is also covered as a capital asset. So that way, if I am holding a vested ESOP where I have a right to exercise and get a share at any point of time, that technically qualifies as a capital asset. And this is an observation made by the Bangalore Tribunal, based on which we can take a stand that, or there is a positive view that ESOP, vested ESOP will qualify as a capital asset. Then whether this surrender or cancel of ESOPs, whether it will qualify as a transfer. Now transfer definition, if we go back and look at section 247, relinquishment and extinguishment of rights is also covered under transfer. So going by these two things, one, it qualifies as a capital asset. Second, there is a relinquishment or extinguishment because of the transaction, based on which this consideration which I received because of cancellation or surrender of my rights in the vested ESOPs can be offered as a capital gains in the hands of assessee. It cannot be, I would say this is not a black and white, this is a grey, because department will come back and say how can you offer an income which is taxed at a higher tax rate as a capital gains. But we do have technical merits based on different case laws where it is established that if it is an exercise of ESOP then it is a perquisite. If it is a cancellation of ESOP, then it should be a capital gain. So there's a thin line, and it depends upon how the documents are framed, how the offer letter and how my acceptance is given. Based on that, there should be a detailed case-to-case analysis to be made. If we have to take a stand whether the cancellation or surrender of ESOPs is a capital gain as against perquisite, it is a litigative stand, but we should always think on the technical merits rather than being conservative at some point of time if you have to give a tax planning advice to our clients. So once we conclude that this is a capital gain, that surrender of ESOPs or cancellation of ESOPs is a capital gain event, and whatever the consideration that I received is a capital gains income to be charged, then should it be long term or short term? So that depends on the holding period. So what is the holding period that I should consider here? Is it from the date I have completed the vesting period, or is it the date on which I have received the ESOP? Is it the grant date or is it the vesting period completion date? Yeah, there can be arguments in both favor, because vesting only upon completion of vesting period you will get the right to exercise. But however, there is another argument also saying from the grant date I have the right, but I can exercise the right only when the vesting period is complete. So there are arguments in favor of both grant and vesting period, but there is a tribunal judgment in this regard also. One is the same tribunal, Bangalore tribunal has also analyzed this also, and there are a couple more, Hyderabad and Delhi tribunal also, where it is established that it is from the grant date as such, not from the vesting period completion date. In fact, it is kind of favored in the SSC, because sometimes the vesting period itself will be like 3 years, minimum 3 years or so. So if we complete the vesting period itself, whatever the surrender of options, that will become a long-term capital gains event rather than short-term, so that it will be taxed at 20% plus surcharges as against 30%. Especially in the recent times, we would have heard about Razorpay, Flipkart, PhonePe, Cred. All of them have given the ESOPs, and they have started buying back all the ESOPs, or asking the employees to cancel their rights in the ESOPs. So in all those cases, the company will always take a safer stand. They will deduct TDS at the highest rate possible, so that they don't want to get into the litigative battle or the short deduction of TDS. But it is up to the employee to consult with his tax advisor and get the review of all the documents presented, and see if there is a technical merit that he can take a chance, so that it can be taxed as long-term capital gains as against the salary income. An additional benefit by going under long-term capital gains is that if I am taking it as salary income, I have to pay tax at highest rate. But if I am going under long-term capital gains rate, there is section 54F, which we are all aware of, against any long-term capital gains other than residential house. If I am purchasing one residential house, I can claim exemption under section 54F against long-term capital gains, and the cap recently is modified to 10 CR. So up to 10 CR, I can claim exemption. And especially in all these type of transactions, the quantum is huge. Whenever a private equity investor comes into and starts acquiring a startup at huge valuations, all the people who have been with the company for long, like 5 years, 7 years, all their ESOPs will pay a good amount of money. If we take it as salary income, there is no tax planning or no tax thing that they can, and they have to flat pay tax about 39%. Even if you are going in a new tax regime, 30% plus 25% surcharge and 4% cess, which roughly works out to 39%. So they will be left with only 60% of the benefit in their hand if they are going at a salary. But if we try and evaluate if the same transaction can be brought into capital gains purview, where the tax rate as such comes down from 40 to 24%, 20% plus 15% surcharge and 4% cess would come to 24. So tax rate itself would be brought from 39 to 24, which is flat 15% tax saving. Moreover, if the assessee has no houses, and if he's actually, whenever a large sums of money comes, the first thing that comes to our mind is to purchase a house. So if the assessee is actually interested in purchasing a residential house, with this tax planning, he can actually pay a zero tax on the transaction, essentially by purchasing a residential house. So that's how we can actually plan in respect of this ESOPs, where they are bought back or cancelled or surrendered. But if it is a case of exercise of ESOPs and you are selling shares, then whatever the difference between fair market value and exercise price, that is going as perquisite, and your holding period will only start from the date of exercise to the date of sale. So there is very little bit of planning that can be done. But if there is a planning of, if there is an opportunity of cancellation or buyback of ESOPs, this is something which we can definitely reach out to our clients and make them aware that sometimes there will be startups that are actually willing to work with tax advisors also on taking our opinion or taking a legal expert's view, whether they should also treat it as a capital gains and not do TDS under 182, which is more favorable to the employees. So it all depends upon how early we plan for a transaction, how well the documents are drafted, and how well the transaction is structured. Only then there is a huge amount of tax saving that can be planned for the clients. Because as we all know, as such, if we take it as salary, there is very less tax planning. Only way is to get it fall within the purview of capital gains based on technical merits and claim exemption under section 54F, or even if not 54F, we can at least save the difference between taxation from 39% to 24%. Similar scenario is for SARS also, where, like I explained, where there is stock appreciation rights are given rather than the stocks itself. Even there, if you are generally what happens is in respect of this stock appreciation rights, it is always linked to a liquidity event, where the company is going for an IPO, or where the company is getting acquired by a potential buyer, or the company is getting a private equity investment since it has reached a certain amount of valuation threshold. So in all these scenarios, all the stock appreciation rights gets monetized. Even in those scenarios also, generally the companies will show it as a cash bonus or salary and direct TDS at the highest rate. There we can actually look at the documents, or if possible we can actually sit with the company and try to structure the documents in a way that helps the key employees of the company. Because most of the stock appreciation rights or the ESOPs will be given to the valuable employees of the company. So if we are able to actually sit with the higher level of the company and make them understand that if you truly want to reward your employees, the documents can be structured in a way that this can be taken as a technical stand of capital gains in hands of the employees. Even if the company does a TDS of 192 for them to be on the safer side, the employees can still fight it out on a capital gains basis, where they can claim huge tax benefit. So that way both the company as well as employees both are rewarded, and it's a win-win situation. And even for SARS, there is a specific case law, which is a Supreme Court case law in case of ACIT versus Bharat v Metal, where it has established that SAR qualifies as a capital asset, and if there is a redemption of SAR or an extinguishment of right that happens, it actually results in a capital asset. It actually results in a transfer under section 247, where the gain should be taxed as a capital gains and it should not be a salary income. So this is a kind of tax planning scenario which can be adopted both for ESOPs and SARs. It again depends upon the documentation. So one thing which we need to look at is how the transaction is structured there, whether it's a cancellation or exercise and bought back. Sometimes what happens is they'll ask the employees to exercise and they will buy back the shares. So there this will not work. This will only work when the options at the option level or at the right level itself it is cancelled or bought back or surrendered. Only then this tax planning scenario would work with this. Coming to second tax planning alternative, one is which I thought as car lease. We have already learned about in the previous session that there is a car lease perquisite also, where it can be the employer purchasing a car and leasing out to the employee, or employee can be purchasing a car and the employer will reimburse the expenses, and the car can be used either for wholly official purposes or personal purposes, or partly official, partly personal purposes. So in these cases, if we look at the numbers, the perquisite is 1800 per month, 2400 per month. The amounts are pretty less compared to the current market scenario. So how do we claim a bigger benefit using a car lease model where the tax planning can be maximized? So one such scenario is, let's say if many of us who are employees, let's say, want to buy a car, if we are purchasing it on an EMI basis, do we get any reduction under Income Tax Act if I am paying an EMI for a salaried employee? No. Right. Only if it is a business person, they will claim a depreciation of the car, etc. But for a salaried employee, nothing. But if it is an electric car, there is a limited exemption available in Income Tax Act. But that is also very less compared to the price of the car that we are paying. It is not at all commercially feasible. But there are certain companies which actually gives a car lease flexible policy to the employees. So how does that work is, let's say the employee wants to purchase a car. So if the company has a car lease policy, he reaches out to the company saying that under the car lease policy, can you buy me this car and lease it out to me? Whatever the price the company pays for the car will be adjusted with the salary structure of the employee itself. So that on the component of car lease portion, the employee will pay only the per visit value at a very lower rate when compared to the actual car lease amount. I'll better explain this through an example. For example, let's see pre-tax planning scenario here. The total cost to company is 50 lakhs. Let's say there is no car lease benefit in the first scenario, and total gross taxable salary will come to 50 lakhs. So there is no per visit as such because the employee is buying on his own. The taxable salary is 50 lakhs, on which tax liability is 13.65 lakhs. Let's say the car EMI that is paid by the employee for a year is 6 lakhs, 50,000 per month. So after from 50 lakhs of salary, he is paying 13.65 lakhs of tax and 6 lakhs of car EMI. Net what is left with the company employee is 30 lakhs. This is the cash that he has in hand. If we have to further drill down, monthly take home salary is 3 lakhs, but the net salary available with the employee is only 2.5 lakhs. But let's say if I am going with a restructuring of my CTC using the car lease benefit. So here what happens is the employee's CTC will still remain with 50 lakhs only, but he will negotiate with the company such that 6 lakhs will be the car lease portion, because if I have to go by my EMI basis, I have to pay 6 lakhs. So I will ask the company also to pay the same 6 lakhs and readjust with my salary structure. So my salary structure will come, my gross salary will come down to 44 lakhs instead of 50. But against this 6 lakhs, which the company pays, and basically this is like company purchasing it on loan and they will give me the car. I am using for both personal and official purposes. If I am using a car for both personal and official purposes, then my per visit amount is, assuming the car is more than 1600 cc, 2400 per month, plus let's say I am taking driver also, 3300 per month. So the per visit amount on which I have to pay tax is only 40,000 roughly. But overall if we see, the taxable salary will come down to 44.39 because the 6 lakhs component is restructured as car lease. So my gross salary is 44 lakhs plus 40,000, on which the tax is around 11.9 lakhs. So overall net cash salary which is available in my hands is 32.5 lakhs, whereby there is a tax savings of 1.75 lakhs. And if I come down, the overall net monthly salary available with me is 2.7 lakhs. If we observe this both scenarios, in the first scenario the employee is buying car on his own and he is paying salary tax on his salary. After everything he is left with 2.5 lakhs per month. But in the second scenario, where the employer purchases the car and gives to the employee as on a lease basis, again where the salary itself is structured as a car lease component and other salary, he is left with a higher salary of 2.7 lakhs. The saving is only because of the structuring of your CTC with car lease model and without car lease model. That is the benefit, which means effectively the 50,000 per month EMI has been brought down to 35,000 per month because of the tax saving. 1.7 lakhs is the saving, which means roughly 15,000 per month. Which means effectively I got a car. If I am purchasing on my own, I would have paid 50,000 per month. If I am structuring it to the company, it is only 35,000 per month. So this is one significant tax planning that is available for salaried employees, especially where the companies have car lease policy. So if the employee doesn't have a car on his own and he is planning to purchase a car on his own, it is better to reach out to the company and structure through this model so that there is tax saving and there is always the objective of car lies with the employee as well. So this is one model which we can approach, whereby the tax saving is material. There is no other component in salary related provisions where there is tax saving is so material as other than car lease. This is a predominant one. Other one is HRA, which we already talked about. Second most important thing in respect of income from salaries is the car lease tax planning. one more tax planning which relates to a car related one only. This I have observed in my experience working with many CXOs, CTOs, etc. What happens is many of them plan to buy a luxury cars because of the status or the designation that they have. But most of them don't want to buy in their own name because they will want to purchase the car in the name of company and claim depreciation, etc. However, if we observe practically, the luxury cars always demand a higher resale value than the regular cars. If you actually buy a regular car and use it for 5 years, the resale value comes down significantly. It may not be even equal to the return on value of the car in the company books. But the same is not case with the luxury cars. Luxury cars, even if you use for 5-6 years, if it's a Benz or Audi or a BMW, it always demands 50 to 60% of the original price even after 5 or 6 years of usage. So here, what is the tax planning that we can look at? Is, let's say the CEO or CTO, the high net worth individual wants to purchase a car. Let him purchase the car in the name of company and let him get it as a car lease model like we discussed in the previous one, so that he will get a benefit on the car lease component on his salary part. That is a recurring salary. In addition to that, at the end of 5 years, let the company transfer the car to the employee at the WDV itself, so that he will not be paying anything. So there will be a perquisite component. Whatever the WDV in the books of the company at which the car is being transferred, the day on which the car is being transferred, that WDV will become perquisite in the hands of the employee. The employee has to pay tax on the perquisite, which will be around 30% plus surcharge and cess. But if the car is resold, the difference between the selling value, basically the resale consideration is tax free in the hands of employee, because the car is not a capital asset, it is a personal effect. So it is tax free. If I have to put it into numbers, let's say there is a car which is actually 2.5 crores and the period of usage is 5 years, depreciation rate is 20%. At the end of 5 years, let's say it is sold at 60% of the original price, which is 1.5 crore. But the WDV at the end of 5th year is 81.92 lakhs in the hands of, in the books of the company. If this car is transferred to the employee, it will be on this 81.92 lakhs, he has to pay a perquisite of 28 lakhs. But he can sell the car for 1.5 crore. So that 1.5 crore minus 28 lakhs, the 1.2 crores, this is a tax-free amount. So this is something which we can explore in terms of luxury cars, because resale value is more than the WDV value of the company. In addition to this, they can always take the benefit of car lease on this. So when there is a luxury car purchase being contemplated by any of your clients, one thing we can suggest them is it can be purchased in the hands of the company and leased out to the employee and claim the car lease benefit. Take the depreciation benefit in the hands of company. Later, at the end of 5 years, when they actually plan to sell the car, transfer the car to the employee. Let the employee bear the perquisite tax, and the resale proceeds will be tax free in the hands of the employee. Because if the company sells this, there will be implications. But if the employee sells it, it's a personal effect and it's tax free. This is something which we can also advise to the clients when there is a car related tax planning to be done. One more tax planning scenario which we have thought is on contribution PF. Generally, PF is contributed at 1800 per month or 12% of the salary. It depends upon the employee's personal choice. So what happens is, as we already understood in the previous session, the contribution by the employee is deducted under 80C. But the contribution of the employer is a tax exempt under section 10. So there are many companies where the employees are opting for 1800 per month. But if we practically observe, the employer and employee contribution both are included in the total CTC itself. So the only reason why employees opt for 1800 per month is they will get more net take home salary. That's the reason they opt for 1800 per month rather than going for 12% of salary. But at the same time, what they are not being aware is, if they opt for 1800 per month, only to the extent of 21,600 per year, that will be claimed as ATC deduction, and only the same amount of 21,600 is exempt under section 10 as well. But if I actually opt for 12% of basic, my take home might come down, but still the same 12% of salary can be claimed as tax exempt under section 10. So this is something which we can think of to employees, where for them the net take home is not a problem, but they want to save some tax on the on the salary that they are earning. So if I have to put this in numbers, let's say an employee whose salary is 90, whose total CTC is 90 lakhs, in which employer, in the first case, he has opted for 1800 per month, which is 21,600 per annum, and basic say is 45 lakhs, which is 50% of CTC. In this case, his taxable salary will become 90,000. This 21,600 is exempt, and this 21,600 will go under ATC. So net taxable salary will be 89.56 lakhs, on which tax liability is 30.7 lakhs. Net cash salary he will be having in hand is 58.82 lakhs. But at the same time, if I ask the employee to convert from 1800 per month to 12% of basic, then in the 90 lakhs, 5.4 lakhs will become employer PF contribution, and even employee contribution also will become 5.4 lakhs, but the maximum allowed under ATC is 1.5 lakh. So the my taxable salary will come down to 83 lakhs, on which tax liability is 28 lakhs. So the net cash salary comes down because a higher contribution is made in the PF. However, there is a savings in tax of 2.22 lakhs. So if I look at overall tax, overall net salary, including PF, there is a saving. That saving is only because of the higher portion of exempt salary that is claimed as part of 12% of salary. So, but however, the net take home salary or the net cash salary comes down. So this is something which we can look in case of employees, where the net take home salary is not a concern, but they are looking for some tax saving on the salary structure revisit, which we can suggest. But however, one thing that should be kept in mind here is this 12% of basic should not exceed 7.5 lakhs, because the moment it exceeds 7.5 lakhs, there is an amendment recently in the recent years saying that if the employee's contribution aggregate of PF, NPS or superannuation fund, if it crosses 7.5 lakhs, that excess amount will again taxed as per visit. So this tax planning will work good so long as your 12% of PF contribution, 12% of basic as PF contribution doesn't cross 7.5 lakhs, which means roughly at 62.5 lakhs basic. So as long as your basic is 62.5 lakhs, and if the employee is already at, if the employee is at 1800 per month, you can actually advise him to revisit the PF contribution to 12%, so that there is a good amount of tax saving that he can make on the increased PF contribution. Yeah. And one more tax planning scenario which we have taught on rent-free accommodation is, like we have already learned in the previous session, that sometimes the employer, instead of giving a house rent allowance, they will provide a rent-free accommodation, whereby the employee can stay at the rent-free accommodation either at a nominal price or free of cost also. But let's say an employee is receiving salary which includes HRE, and he is also planning to purchase a house on a home loan. The benefit at max what he gets is the section 24B 2 lakhs of interest benefit, and under ATC he will get another 1.5 lakh benefit. But we can actually plan the purchase of home through instead of purchasing home on his own through a loan and staying in the home, whereby he cannot claim HRA, he can only claim 24B and ATC. He can actually structure to a rent-free accommodation. So how does this work is, let's say if I want to purchase a home, I will purchase a home on a home loan basis. Then I will give the home and on lease to the employer, and the employer will give that home back to me as a rent-free accommodation. So what happens is I will purchase the home. The home will be on my name. The home loan will be on my name. I will be paying the EMI for the home, but the home will be leased to the employer, where the employer will be giving me rental. But the same home will be given back to me as a rent-free accommodation. What happens here is, because the loan is in my name, I am paying EMI, I am getting huge interest accumulation on the loan, which I can offset against the rent that I am receiving from the employer. At the same time, there is a benefit of not paying tax to the extent of the HRA portion. So if I have to better explain this in numbers, here what I have made the assumptions is, let's say the property is 4 crores worth, in which I have taken 3 crores on loan and 1 crore is my own funding. And if I take a tenure of 25 years, there is an EMI of 2.45 lakhs per month. And let's say I am leasing this home to the employer at 1.5 lakhs, assuming an interest rate of 8.75% for the home loan. In the first scenario, let's say my salary is 55 lakhs and I am getting a 18 lakhs of house rent allowance, for which I don't have any exemption because this is a home owned by me and I am staying in it. On the loan, I will get 2 lakhs of loss benefit. So my net taxable salary is 71 lakhs, on which my tax liability is 22 lakhs. So by net cash surplus, if I have to take the total cash salary of 73 minus tax liability of 22, net I am left with around 51 lakhs of cash salary. But if the same thing, if I take this loan, home on loan and lease out to the employer, and the employer will pay me 1.5 lakh per month as rent, which is equivalent to my HRA. Instead of paying me HRA, he will pay the HRA as a rent on leasing of this property. Now what my salary will be only 55 lakhs, I am getting rent-free accommodation on which I have to pay perquisite. That perquisite is only 10% of the basic, which is 10% of 5.55 lakhs, which is 5.5. My loss still I can offset only up to 2 lakhs. So my net taxable salary will come down to 58.5 lakhs. Tax liability is 18 lakhs, but the rental income in addition I will get. So what is the planning here is that 18 lakhs of rental income is tax free, because if I am paying 2.5 lakh per month as EMI, my interest after standard deduction and interest, there is no taxable rental income that I am getting. Whatever the rental income that I am getting from the company is tax free. So my overall surplus goes up.
One second. Sorry, why this rental income is tax free? Sorry.
My rental income is 18 lakhs per month, 18 lakhs per year.
Yes.
In which standard deduction of 30% goes. Right? If I am doing the house property calculation,
Yes.
18 lakhs minus 30%. So 5,40,000 goes off. I will be left with 12,60,000. If I take the EMI schedule of this property, which I have taken a home loan on, so there is an 2.45 roughly per month EMI. If I take for a full year, around 30 lakhs of EMI I pay. In the 30 lakhs, if you take the interest portion, that will be almost 80% of amount will be the interest portion. So that interest portion will offset by rental income. Sorry?
That is loss of letter.
No, if it is a let out property, I can offset to the extent of rent, and adjustment of the excess loss against any other head of income is only restricted to 2 lakhs. The offset of interest is permitted in case of let out property. If it is a self-occupied property, you are right, it's only 2 lakhs. So instead of getting HRA and staying in a home which is owned by me through a home loan, I can actually get this structured to the employer, where instead of him paying me as a HRA, he can pay me as a rental income for the same home. But I will be purchasing this on my own. The loan responsibility, everything is mine. I will, instead of to the extent of HRA amount, I will ask the employer to repay it as a rental income, whereby I can structure this better so that there is a tax saving that can be made.
Excuse me.
Yeah.
What in case the loan is not there, and I take a rental of say around 6 lakh, and
Okay.
I pay rent free accommodation is 5,50,000.
So you are saying-
Can the company give less rental to me and rent free accommodation is not?
So in this example, the reason I have taken is just to show on par. Let's say instead of HRA, because when I am getting HRA, which means that the company has deemed that 1.5 lakh per month is your rental expenditure assumed by the company. So I have assumed in this example saying if I receive the same rental income, if you are actually able to get a better rental income from the company, this option will work out even better for you.
No, lesser. So if I am giving on rent to the company and company is paying only 1 lakh nominal, and I am getting a perquisite of say 5,40,000.
Right. So there will be a arbitrage to an extent where the rent should not be below that limit. If we are actually going to structure, let's say your HRA here is 18 lakhs, and you are saying if I am not receiving 1.5 lakh, let's say I am receiving only 1 lakh as rent from the company. That's what you are saying,
Yes.
right? If I am instead of 1.5 lakh, if I am receiving only 1 lakh as a rent, so my rental income additionally in this case will become 12 lakhs. So my shortage will be 6 lakhs, but the benefit I am getting is 4.3 lakhs. So in that case, I'll be at loss of 1.7 lakhs. So here the assumption is that whatever the HRA you are able to recover through the employer as a rental income. That is an assumption.
So basically, the rental should be more than the the
fair rental should be equal, at least equal to HRA. Even if it is slightly lesser, as long as your benefit is not depleted, it will still work out. But if it is more than that, then it is beneficial. If it is way less than that,
will the income tax officer again say this? You have paid more rental income to the.
So when we are structuring this as a rental income, we should always look at the market norms also. I mean, it cannot be an arbitrary number that we can quote to the employer, ask them to pay. It should be a market number, but as long as it is within the regulation, where it is like the income tax officer should also believe that it's a reasonable rent that can be derived for the property.
This is only feasible where there is a loan on the property. In case there is no loan on the property.
Right.
Another thing is it's also.
So this is feasible only if the employee is actually planning to purchase a home, but the employer has a rent-free accommodation option. So this can be worked out with the employer saying that I'll take the loan and purchase the home, but can you give me the same home as a rent-free accommodation through this structure?
Another thing is only feasible only for the initial few years of the loan, where the interest component.
As long as your interest component is offsetting, as long as interest component is offsetting 70% of the rent, because 30% you will always get as a standard reduction.
It is feasible even if there is no loan. Something at 30% standard deduction.
Subject to that will be very less, because the major benefit here is being only because of the interest component. If we are only looking at the 30% component,
Mostly held company, then
this structuring is possible. Yes. These are the few tax planning scenarios that I have thought of, so that if something is practically relevant, we can actually always go back to our clients and suggest. And if there are any doubts in all the slides that I have covered, please let me know. I'm happy to answer.
So that the luxury car example you showed, no?
Right.
They actually one point from the GST point of view missed, because when we are buying, we are not eligible for ITC, but when we supply further, so even if it is an employee, we are a related party, and I need to go for open market value, and then I need to pay
GST. Yeah,
so
for
that
employee it will be a
difference.
GST leakage, correct.
So the actual company that will be cost.
See, here what happens is, it is transferred at the WDA. You are talking about scenario where there is a sale.
Okay, here we don't have that margin.
Yeah, I'm giving away on the WDV amount, the employer will pay perquisite. Yes.
Assessing has a vacant land.
Vacant land.
Vacant land.
Okay.
Assessee spouse has constructed on that. Can she claim 50% reduction based on that? Because legal owner is the assessee. Spouse has constructed the property, house property. Can she claim the property 54 reduction?
Under section 54. 54F. So you're saying assessee's spouse is constructed the property.
Yeah, she has a capital. Now assessee has a
vacant land on which spouse constructed. Yes, she can claim 54F, but she won't get the cost of the land. Only to the extent of the constructed cost that she can get. The land she won't be. The land cost she won't get, because land is constructed. Land is owned by the. Yeah, she will get a 54F reduction.
How about when they sell the property after 3 years condition?
When they sell the property after the 3 years, since the land is owned by the assessee, that will become capital gains in the hands of assessee. So to the extent of the cost of construction that she has claimed as 54F in benefit, that she will claim it as under section 54. For her it will be, for him it will be capital gains other than residential. For her it will be capital gains of sale of residential house.
So there is no restriction, she should be the legal one.
No, but the only thing is, when she is constructing the house, from a documentation perspective, she is to get the rights of usage of the land from the husband. When she is constructing, because she is not the legal owner of the land, she has to get an MOU or right to construct on the property, rights to construct on the property, rights of usage. That rights of usage she can get from the husband and construct.
Connected to the same dowry sign, right?
Yeah.
So we are selling on the WDV, but actually the rules of the GST says that it should
No,
stay
here what
market
happens
value.
is we are not selling, we are just transferring the car.
No, still it is covered as an Schedule 1 and related party. No? The company and employee is related under GST.
Okay.
So maybe what value you have taken WDV.
Employee and employer is not considered separate.
Yeah.
On the GST.
That is only employment service. Apart from that, it is so it is.
Yes, on the corporate side is not covered.
The thing is,
If
you're
it
not
is as
actually
part of
No, I am
employment,
telling not purchasing. That sale of car.
so you're not selling the car. The company, the employer will never pay the money to the company. That's why you're treating employees only pay zero. That's why the book value is being purchased for the employee.
No. So I'm telling that at the end when he transfers,
WDV only.
you will pay. No,
That's
it
what
is
I
exempt.
No,
It is exempt. The company is selling the car.
Hmm.
No, when company is selling the car, if the selling price is more than less than WDV, then less than or more than WDV, then only the GST arises.
That's what I'm telling. It says that you need to take open market value.
Ah.
So in the example, the open market value is 1.5 crore. So that's difference is there still. That's what
My understanding is here the WDV is 82 lakhs. At 82 lakhs, the company when the WDV is at 82 lakhs, the company is giving off the car to the employee.
And the
Because
WDV
many companies have the policy that where the car is taken on lease by the employees at the end of 4 years, 5 years, or 6 years. Once that period of repayment of loan by the company is over, they will transfer the car to the employee because effectively that cost is recovered from the CTC of the employees. They will transfer the car on the WDV itself. At that time, whatever the WDV is in the company's books, that will be perquisite. The employee as such will not pay any monetary consideration on that. Because of which there is no GST implications is my understanding. I can check and confirm to you. Because of which
They are talking about the fair market value.
Yes.
No, that won't come into picture. That's what he's trying to say. See, when employee is leaving when the employee is getting the car, employee is not paying a rupee to the company.
No, Harshit, what happened? No, here fair market value is 1.5 crore.
Agreed.
Okay. Now employee, there is a relationship between the employee and employer.
Agreed.
When there is a related party, fair market value
No,
comes into
because
picture.
it's
No?
coming as part of my employment. See, it's
Agreement.
an
If it is
employer-employee.
perquisite, then it is
See,
expensive.
I'm not paying anything for the car because I'm employee of the company. The employer is giving it to me at zero rupees. The perquisite of 81 lakhs or whatever, that becomes perquisite to me because I am employee. So it's an employer-employee thing, not covered in GST.
Correct.
You got the logic? So it's not covered in GST there. For perquisite purpose, only 80 lakhs or odd what is in the books will be the perquisite value. But then when the same employee sells it in the market, that difference will become not taxable because, like he said, it's a personal effect.
But at the same time, it should not be a cost to the company. At the 50 year, 81 lakh 92,000. In what way?
So
we
what
have to
happens
make it-
is the 5 years period when they structure it, like I explained in the previous example, they will actually, if I instead of me taking the car for 5 years loan, the company will take car for the 5 years loan. So the entire EMI that the company pays is already recovered from the CTC of the employee. So that is not an additional cost. That is the only reason in the first place the company agrees for this policy. Otherwise they will not want to bear something of their own pockets.
What in the case of closely held company? I don't have any policy right now. At the time of selling, can I give it to him at WDV and then he sells it?
Yeah, you can still, because you are saying that there is no if it's a closely held company, you can always make a policy. One, or even if there is no policy, generally in the Income Tax Act doesn't mention as such the company should have a policy, but it only mentions about the scenarios in which these tax provisions will come into picture. So when there is actually transfer at WDV, even if you don't have a policy, these provisions will still apply. That policy is only for a documentation purpose to substantiate the transaction.
But in this case, the company sells the car directly in the market.
If the company sells the car directly, you are saying company sells the car in the direct market.
Resale value is 1.5 crore. WDV is 81 lakhs. So 70 lakhs will be the gain.
Right. If company sells it. It goes and reduces the block of the assets in the
There
company.
won't be any tax. There won't be any tax, right?
No, exactly. You are saying if the company sells 1.5 crores, it will go and reduce the WDV.
You won't be tax, income tax.
Short term tax.
Or it will become, if there is no other asset, it will become STC.
There is no other asset.
It will become short-term capital.
Short-term capital gain. So the tax will be only on 70 lakhs.
Correct.
But here the employee is paying tax on the 80 lakhs.
No, but that 70 lakhs is for the company. At 70 lakhs minus tax.
Only when you want to transfer the car.
You want to give the benefit to the
This is
employee.
mainly for transferring the car.
Car,
To the
yeah.
employee.
Not for
Tax planning.
In fact, even if you look from that angle, the employee, even though he is paying 28 lakhs, he will get 1.5 crore. So he will get the 1.21 crore in hand, which is better than the 70 lakhs that the company goes on.
Because essentially this cost is completely recovered from the CTC of the employee. So obviously he would want to get the car back in hand or any other benefit that is associated with the car in his own hands. Any other questions? Okay. Thank you very much. You have been a lovely audience. Thanks for your attention.
Thank you, Speaker. On behalf of Bangalore branch of SAICF ICI, we present the moment to the Speaker. Thank you, members. We'll meet tomorrow.
Good afternoon, good evening. Welcome to this revisit income tax sessions on income from house property. We have two speakers, eminent speakers today to address all of you. It is CA Rani NR and Omar Abdullah SN. I request our chairman to escort both of them to the dais. Welcome to both of you. I'll just make a brief intro of both the speakers for the day. Rani NR is a fellow chartered accountant from the Institute of Chartered Accountants of India and is a partner in Anant & Company. And has more than 20 years experience in statutory framework relating to not-for-profit and for-profit sector. Prior to this, she worked with Ernst & Young for a year. She has been a regular speaker at various forums including ICI and the Direct Access Regional Training Institute, and also she also has authored a book on international taxation and co-authored a book on transfer pricing. She holds a master degree in business laws from National Law School, Bangalore. So it's a pleasure to have you here, Rani. Thank you so much for being here and welcome to you. Can we have a big round of applause? The next speaker of today is CA Omar Abdullah. He is a member of Institute of Chartered Accountants and holds a BCom degree. He has vast experience in handling assessment proceedings, representations, appellate authorities before appellate authorities, and rendering advice to a wide range of clients in domestic and international tax matters. He is a trainer again at Direct Access Regional Institute of Income Tax Department, and he has also co-authored 2 books on international taxation. He has also completed a diploma on blockchain from the Institute's Digital Accounting and Assurance Board. He is a regular columnist with ICI for SIRC and Bangalore Journal. So it's a pleasure to introduce you to the people here. Thank you for being here. Thank you. I hand over the dice to both of you. You please take it.
Good evening, everyone. At the outset, I thank Bangalore branch for giving this opportunity. Indeed, I should say that when we take up the sessions like this to speak, we learn more. When we see income from house property, 22 to 27, 5 sections, always we tend to think that rental income, very specified deductions, there is nothing complicated. And practically, I don't think we have, out of say 100 returns we file, very rarely for practicing chartered accountants, we may have to pay attention. At the partner level, we may not get any issues to resolve. It might get solved at the senior article level and returns get filed. In my personal experience, I had some surprises when we got scrutiny notices. And the observation was under income from house property. So that is the time when I realized what we think we know, we don't know. We really don't. And it was so obvious, I was wondering how we missed it, and finally it was a tough time resolving that scrutiny issue. So it is really this revisiting is indeed helpful. So in the course of preparing for this session, of course, new learnings as always. So we have planned, me and Omar, in fact we did the same thing in 2021, I think same Rita was there, Revisiting Income Tax Act was there, and both of us did the same income from house property. So Omar, between us we have planned that I will explain to you the basic provisions from 22 to 27, and next we have planned we will bring up some issues, because basic provisions I don't think we get doubt. That is the whole thing. This 22 to 27 we never get a doubt. That is the problem. We get always a doubt in business chapter. We get plethora of problems in capital gains. Every other chapter we get a doubt, including salary, but in income from house property we never get a doubt. So we have tried to bring in some issues which are very interesting, and Omar will help us to understand how the courts have viewed it, what are the judicial precedents, what is the answer based on the legal research on it. That is how we have planned. So let me quickly, in fact, the second part of the session is going to be more interesting, and I am looking forward for that. So let's quickly go through the basic provisions and then get into the second session. So I may not be going slide by slide here. Whatever I speak is definitely in the slide, and to be very honest with you, all the chartered accountants here, there is nothing new. We are all familiar with the terms municipal valuation, fair rent, rent received, then the the deductions. So slide by slide I may not be taking, but whatever I speak definitely is there in the slide. So touching the basis of chart. So this income from house property, if you understand, not only from income from house property, if you want to get a perspective of how the whole tax law looks, Income Tax Act, what does it, like when we read an accounting standard, we have measurement, recognition, disclosure. Like that, for any income computation, the basic principles is what is that the income tax, the taxman want to start tax. What is that they want to bring it under taxation? That is the first point we have to look into. Next, in whose hands it gets taxed? It may not be straightforward in all the cases. Sometimes the taxation may not be in the hands of the person whom the person is earning the income. So who is the person who is liable to tax? Then what is the amount which is subjected to taxation? That is called what we call in our term computation. So any income from salary to other sources, what we are trying to understand when we read any provision, we have to understand what is being taxed, in whose hands, and what is the valuation, how you compute the amount to be taxed. So with this premise, if we go to section 22 to 27, Basically, the topics what we will be covering will be basis of charge, what is the basis of charge, and property. When they say house property, there is a categorization of the property under the Income Tax Act. Though everything has building and land, it has been slotted as depending upon the how the owner is treating is, there is a categorization. And for computing the income to be taxed, there are specific deductions. Then there are some peculiar concept where practically because of the situations there could be arrears of rent, unrealized rent, all those are highly practical situations which giving rise to that situations. Then ownership. Owner is very critical term when we understand income from house property. Owner as it is has various facets. When we understand ownership, somebody owns something. But there are concepts like deemed owner, beneficial owner, absolute owner, registered owner, legal owner. All these are the facets of ownership which is very critical not only for understanding income from house property. These concepts, these are basic concepts even to appreciate GST law, even to appreciate international taxation, or even to appreciate a problem in capital gains. Then we have composite rent where the money what the owner of the property collects will have not only a component of occupying the premises, especially in today's world, the rent as it is complicated. People are not paying only for the facility. We are witnessing in a world where we find very interesting revenue models. Actually the models what we come across, we may not even know how the revenue is being recognized. Unlike the earlier time where somebody will sell the good, there will be only two people in place, somebody will manufacture good, they will sell the good, they will earn the revenue, or somebody will render the service, earn the revenue. Now in the present situation, that is not the case. So who is recognizing revenue, who is the service provider, it is so complicated. So composite rent situation. Then some situations like if house property is in the name of the partnership firm, or if house property is in the name of the partner, what are the implications? And some incomes which are not charged as income from house property. Though prima facie it appears as income from house property, it may not be an income from house property from income tax point of view. I think I am loud enough without mic, that people can understand. So these are the sections. Section 22. Section 22 is income from house property. Defines what is annual value, what is income from house property. 23 again, how to determine the annual value. So what they tax, they don't use the word only the rent. They use the expression annual value. So definitely we have to understand what is annual value, how it is computed. That is section 23. Then section 24, deductions from the annual value. And that is how we arrive at the amount on which the tax is applied, the taxable value. Then we have under the deductions, various categories of deductions like standard deduction, interest on borrowed capital. Then what are the deductions not deducted? We cannot claim it as deduction under the Income Tax Act. And as I told you, arrears of rent, unrealized rent. Then there is a concept of co-ownership. And section 27 defines deemed owner. So these are the sections. So each sections in the presentation will be shared to you, where I have tried to bring in what each section describes. Typically I have reproduced a summary of what is there in the Act. So if we look from 22 to 27, our focus should be basically on section 23, which has various situations. As I told you, so what is getting taxed? The annual value of a property consisting of any buildings or lands appurtenant thereto, of which the assessee is the owner, shall be subjected to income tax under the head income from house property. That is what the basis of charge, the charging section is as follows. So now what are the concepts? What is getting taxed? Annual value. Annual value is subjected to taxation. Annual value of what? Of a property. Now what is a property? Under section 22, a property consists of a building. So building is a prerequisite for bringing any income under this section 22. This is something which we have to remember. Any income generated from a vacant land without a building, a structure, will not be subjected to taxation under income from house property. When it is not taxed under income from house property, the rules applicable for the computation of income from house property is outside. So we have to be very sure that when they say a property should definitely have a building and land appurtenant thereto. Now this lands appurtenant thereto is subjected to various interpretation under various judicial precedents. We will come across some situations when we discuss the case. Definitely there should be a land for a building to exist. So any land associated with the building, but the focus is on the building under income from house property. For example, in this context, any income from a vacant land. There is no building. But that is also a property. When people say I have a property, people mean vacant site, right? If somebody has a site, that also we call it as a property. I own a property. When I say that, doesn't mean that always there should be a building. So when the client tells you I have a property in Mysore, I get a rent, we should be precise in asking when you say property whether it has a building. If it has no building and it is only a vacant land, we have to be very sure that that income has to be reported under income from other sources and not under income from house property. Then the next critical word is owner. Who is an owner? Now, as I told you, ownership in our common parlance, we understand somebody who has the right to possess the property, right of disposal. I have the ownership of this phone, means on this earth, I am the only person who can claim rights on it. If I have to throw this phone, nobody will ask me a question. If I have to give the phone as gift to Omar, nobody will ask me a question. I have the right to possess. So, ownership, all of us have read in different contexts, right? See, we would have read right of possession, especially capital gains chapter and all. When we read, we have Transfer Property Act. Property has been entered into, registration has not happened, I have paid the full money. Who is the owner? If transfer happens, whether capital gains has to be reported. So we understand ownership has different facets. Right of possession, right of ownership, right of transfer. All this we have to understand when we compute the income from house property. So the word owner is very important. In that situations, what are the different situations we can come across, we will see later. So we understand fundamentally the person should have an ownership, either right to possess or right to own, absolute ownership. The person should be an owner in whatever capacity. Next, it is subjected to, and then we have to compute, and so annual value of a property of which there should be a building, and the income is that annual value is subjected to taxation in the hands of the owner. Next, that is section 22. So we know what is the basis of the charge. Next it talks about different situations the property can have. If we understand, I have a land and building, what all we can do with that property? It is a fundamental common sense. I can occupy for my, I will live in that, me and my family will live in that property. So that category of property is called self-occupied property. Simple. Next, what can I do? If I have more than one property, what I will do? Definitely I will go for letting out the property from which I can earn a revenue. So prima facie, the properties have been classified as self-occupied property and let-out property. Now this we understand. Now, out of this, I will just explain the categories of properties here and then I will come back to the slides. So under the house property, prima facie you have to understand self-occupied and let-out. This is very important. This is very critical. Then after self-occupied and let-out, why this distinction is required? Because the computation of the annual value, which has to be subjected to taxation, depends on what category the property falls in. Now, under then first is self-occupied property. The taxation of self-occupied property we will see. Next is let-out property. This is the most interesting part. If you ask me income from house property, this part is most interesting. And this is the place where we get tricky questions. If we understand how the taxation happens in various scenarios, I think there is nothing much in this 22 to 27. So first situation, I have a property, I have let it out, I have entered into an agreement with the tenant who occupies it and who gives me rent. Now, it is called a let-out property, and what I get is a rental income. How to compute the income, we will see. Now, let-out throughout the year, full year I entered into agreement. When I say year, our financial is from April to March. From April to March, it was occupied by the tenant, monthly rent is coming, let-out property for throughout the previous year. Now, there could be a situation where it is a let-out property. My intention is to let out. All these words, what I am using, intention to let out. All these are very critical, especially when we discuss the case law. Very, very interesting case laws have come out based on the intention of the owner. So, I have a property, I have the intention to let it out. With my, the manner in which I treat the property, how I have entered into I have told brokers to find a tenant for me. There could be a situation where he was not able to find a tenant for the whole year. We have case laws like that. But still, I never had an intention to occupy it for myself. It is intended to let it out. So, let out throughout the year, or there could be a situation I let it out, I have intention to let it out, but I had a tenant for 6 months of the year, or I had no tenant for the whole of the year. So, let out and vacant during the previous year, from April to March. This is the second category of the property. Next situation. I have a property. Imagine a 2-story building. first floor I am living with my family, ground floor I have let it out. That situation you will very common in Bangalore. It has two separate residential units, and one unit is I have intention to let out. It is for earning rental income. The first floor is occupied for me as a self-occupied property. In this situation, it is called partly let out and partly self-occupied. In this, I told two separate units. There could be a situation in the same unit, 3-bedroom flat, one room I will let it out, another 2 I will use for myself. There could be how the calculation of annual value will happen. This is a different situation. So part of the period let out or part of the property let out and part is self-occupied. How we will compute annual value? Next is fourth situation. Under let out property only this will fall, where actually it is not let out. But by deeming fiction, in Income Tax Act we come across many situations where predominantly it is not a let out property or predominantly it appears to be something else. For example, we have section 9, deemed to accrue or arise in India. Section 11, where income is deemed, income from property forming part of the trust, we have a deeming fiction where the computation is done on a deeming method. So, the deeming provision under the Income Tax Act, the property is deemed to be a let out property. That means originally it is not a let out property, it is deemed to be let out property. Then third category is house property held as stock in trade. This will come in the case of business people where they, especially builders or somebody who owns multiple apartment and they consider it as a current asset. When they say stock in trade, it is not a fixed asset. For a common person, if you imagine a balance sheet, it is normally fixed asset. This is case where it is a part of their business to sell the building and land. So they have held it as stock in trade. Now let us go back and see how the annual value and how various provisions are attracted for these categories of property. Now, in the case of self-occupied property, annual value is considered as nil. Now what is annual value? Let us understand what is annual value. Under the Income Tax Act, they say that for computing the annual value, we have to understand certain terms. There is a building. First, the Income Tax Act says, look at the rent what can be expected for that property in that area. Like market value, in our common term market rent, or reasonably what rent can be expected for that building. This we call as fair rent or rent reasonably expected. Actually Act doesn't use the word fair rent. The expression they use is rent which can be reasonably expected. That is one number which we should know. Another number which we should know is municipal valuation. See, in Bangalore we have BBMP, which do a valuation based on which the owner of the property has to pay a BBMP tax on house property. So they have fixed a value for this particular, depending upon the area, depending upon the square feet, they fix a value. This is called municipal valuation. This is one expression in the Act. Another expression which they discuss is standard rent. This is again when the Rent Control Act is applicable. So in Karnataka, I understand that for some properties there is Karnataka Rent Control Act applicable, for which they have fixed a standard rent. This is again based on the government's decision. They have fixed a standard rent depending upon the area and depending upon the situation of the property. They fix a standard rent. So there is a fair rent, there is a municipal valuation, there is a standard rent. Then the fourth category is the actual rent receipt. So for computing the income, it is not only the rent what is coming in place, it is these four numbers which is relevant to understand, to compute. Practically, we may not do this because, especially in Bangalore, always the rent actually received will be much higher than all other three numbers. But this systematic approach to adopt to compute the income is relevant in some unique situations which we will discuss. So, now I told you self-occupied property and let-out property. Now let us see what is the difference. I told you it is mandatory to understand the category of the property before computing the income. Now, summary of the computation is gross annual value. This annual value which has four components: fair rent, standard rent, municipal valuation and actual rent receipt. In the case of a self-occupied property, as per the Act, it is called nil. Why nil? Because there is no intention to let out. There is no revenue expected, so all these are irrelevant in case the property is occupied by the owner himself. So gross annual value, the word gross is very relevant because gross annual value less a particular deduction arrives at net annual value, and subsequent deductions is a function of this net annual value. So gross annual value in the case of a self-occupied property is considered to be nil under the provisions of the Income Tax Act. First we will finish self-occupied property, then we will see let out property. Then municipal taxes paid. So we know that whatever we do for personal purpose, even under the Income Tax Act business chapter, or even section income from other sources, where somebody has incurred an expenditure for personal benefit, even Income Tax Act, we cannot claim for, in the case of a company, Income Tax Act paid by a company cannot claim as a business expenditure. Why? Because it is something which you have not paid it to earn a revenue. That is the concept, right? So in this case, the owner has occupied the property for himself. So whatever tax he has paid to the municipal authorities has not earned any revenue for him. That is the rationale why they say for a self-occupied property, the property taxes, the BBMD tax what we pay in Bangalore is not allowed as a deduction. Okay, but the same will be allowed as a deduction when the property is let out. Why? What is the logic? He has paid the tax for a property which earns a revenue. So that is why that municipal tax paid is allowed as a deduction. Coming back to self-occupied property. So gross annual value plus municipal tax, you have net annual value, and then deductions under section 24. Very exhaustive deductions. There are no other deductions allowed under income from house property. So there is no room for creativity or tax planning. Thank God. You can tell the client that nothing doing. These are the only allowed deductions. To that extent our time is saved and we don't have to be creative. So standard deduction. What is standard deduction? 30% of the net annual value in the case of let out property. Again, there is no standard deduction for self-occupied property. Why? Because there is no revenue. Then the only deduction available again is self-occupied property is interest on borrowed capital. What is interest on borrowed capital? We will get to know. Anyway, there is a limit of 2 lakh. What is interest on? I think we can discuss. Most of you are familiar, so we will discuss now only. What is borrowed capital? Loan taken by the owner of the house property. There are conditions. Loan taken for repair, reconstruction or purchase. All these conditions has to be satisfied depending upon what is the purpose of the loan. Definitely the loan has to be something related to the house property. He cannot take a loan for marriage of the daughter and claim that interest against this house property. So this is the check which we have to do at the time of doing the computation. So the scrutiny case which I came across, that was the thing, because interest on borrowed capital, the client told whatever loan he took, out of the loans what he had taken, one loan was not taken for house property, it was taken for purchase of land on which there was no construction. So when we asked him the loan document, whatever loans you have taken for, this is the question, in our checklist what is the question? Any loan taken for the property, please bring the document. Right? He gave some multiple loans, so three loans were there. Out of that, according to him, vacant land is also a property. One site purchased in Davanagere or somewhere is also a property. He brought that loan. When we computed the computation, total interest included the loan taken for that vacant land. So by mistake, the claim of interest is wrong. So that is where, that's what I told. Certain things which appear to be simple in terms of documentation, we have to be careful. So any loan taken for, very precise, the section is very precise, repair, renewal, reconstruction, acquisition, all those things, any interest paid is allowed as a deduction. This is the only deduction available in the case of self-occupied property. And in the case of self-occupied property, the deduction is restricted to 2 lakh. Okay. Now this 2 lakh, again new regime, old regime, you should be familiar. I think you will have a separate class on computation of income. Under the new regime, there is no deduction available. But if at all deduction is, if the assessee opts for old regime, you will have a deduction of maximum 2 lakhs. Finally, income from, so always, income from self-occupied property, if you see the final computation, the outside column will have either 0, where the person has no loan means nothing, no income. Income from self-occupied property is definitely 0. If at all any number comes, there could be a loss because no revenue, only a deduction is allowed. It will be a minus number. Maximum is 2 lakhs. There ends self-occupied property. Now coming to let-out property. Under let-out property, we have different situations. First, let us understand how the computation is done. So in this case, 23(1) let-out property is, so what is fair rent? Reasonable expected rent. For a similar property in the place where your property is situated, what is the rent expected? This is a market value, I should say. That is the first number which you should have when you compute the income. Next, as I told you, municipal valuation. then where Rent Control Act is applicable for the property which you are handling, the jurisdictional, you may have to see whether the property is covered under Rent Control Act, then that standard rent fixed by the respective government has to be considered. First condition is, we have three numbers, fair rent, municipal value and standard rent, whichever is higher. That is the first number. Next, the actual rent received or receivable from the tenant as per the rental agreement. So another critical document which we have to see, make sure that we see, is the rental agreement with the tenant. Every time there could be a situation, there is change in the tenant, there could be a situation, because this is very critical now. I will straight away tell the practical problem. See, there is a change in the tenant means now in AIS, the tenant who is claiming HRA deduction, it appears. So, and the landlord, in the AIS of landlord, it gets popped up and the landlord is expected to confirm that yes, this rent belongs to me. Unless the landlord confirms, the person who claimed HRA will not have, the claim will be disallowed. So this is very critical for clients who are with us for 20 years, 30 years. There is a tendency we'll make a copy paste of the previous computation. At least earlier times when I started practice, we had an Excel sheet with computation. Nowadays even that is not there. If somebody is using a Winman software, there will be a PDF. We don't know from where the data has come. So this is very critical. As far as the actual rent received, we have to make sure that the latest rental agreement we have seen. If not, there is the rental agreement, at least tell the owner to have a rental agreement, a formal rental agreement where the actual rent has to be proved. And if they have a tendency to take rent in cash, please advise the clients to encourage them to get in a banking channel. It is because when there is a cash, there is always a doubt to the income tax officer that the full rent is not declared. Then, so the actual rent received or receivable is the second number which we are dealing with. So, coming to the first portion, fair rent, municipal value and standard rent. So, between fair rent, municipal value and standard rent, we will identify the highest number but subject to a cap of standard rent. Practically, we may not be using this, but this principle you should know. If there is a standard rent declared under the Rent Control Act for that particular property, this number cannot exceed. The subject is that is the maximum cap is the standard rent. So that is the first number. Second number is actual rent received or receivable. Between the two, whichever is higher is the annual value which has to be considered. That is the first number, gross annual value. In the gross annual value between this fair and municipal value and standard rent, subjected to standard rent, then compare with actual rent, whichever is higher is the annual value. Then, in this context, so that is how we have considered for a let out property throughout the year. Now second situation I told you, there is a let out property, it was vacant for some part of the year, either 3 months it was vacant or full year it was vacant. So actual rent received or receivable is what it uses. So that means on accrual basis, you have entered into a rental agreement where there is rent is 10,000 per month. So 1,20,000 is the rent for the whole year, which is receivable on accrual basis. Now there could be a situation where the property was vacant for 4 months. So vacancy allowance is allowed as a deduction. So if the property was vacant for some part of the year, you can claim vacancy allowance from the actual rent received or receivable. So in effect, though the taxation is on accrual basis, by allowing a vacancy allowance, in effect you will end up paying tax on the actual rent received. Okay, there are some 1 or 2 unique situations which we will come across. So gross annual, for computing the annual value itself, you can deduct vacancy allowance. Then after deducting vacancy allowance, we will come across the municipal tax paid. So you have the annual value, vacancy allowance. Then from there, municipal tax, I told you, for a let out property, municipal taxes paid. So the word used is municipal taxes paid by the owner of the property. This is very critical. You have to really see from the bank statement or whatever mode he adopted, see the financial year. There could be a situation where there could be a regularization of the tax issues and some previous year's rent, taxes and all have been paid in the year. So the date is very critical, it should have been paid within the financial year and that can be claimed as a deduction from annual value. Then, from the annual value, you have specific deductions in the case of a let out property. What are the specific deductions? 30% of the net annual value, gross annual value minus municipal taxes, net annual value on that 30%. This is a blanket deduction, standard deduction, irrespective of the actual repair. So if the client says that I have incurred so many expenses, it is irrelevant, 30% of the net annual value is allowed as a standard deduction. Then the next allowed deduction is interest on borrowed capital. In the case of let out property, there is actually you can claim the interest what has been paid for the whole year, but there is a cap of 2 lakh for that particular year. To the extent of interest what was not claimed in that year can be carried forward to subsequent 8 assessment years. This is only relevant for let out property. So this we have to be careful. Again, new regime, old regime, the rules changes. In the new regime, there is no claim of interest. So there if you see the computation, imagine the person has a salary income and income from house property and opting for new regime, outside column no deduction comes, computation gets filed, but whatever interest which has been deducted, gross annual value less municipal taxes and less interest, that in the computation, that loss figure, if it is a loss figure, that gets carried forward for subsequent year, because if the person has no business income, as you know, they have the option to choose between new regime and old regime every year. So this unabsorbed carry forward losses get reported in your income tax return. So this you have to look for in the subsequent year when the person, suppose old regime appears to be beneficial, and if old regime is opted, then this previous carry forward loss can be claimed, again subjected to cap of 2 lakhs every year, maximum 8 assessment years the person can carry forward it. This is only for let out property, not for self-occupied property. Now, third situation, this is vacant for the year, this I have discussed. This is a situation where the house was partly self-occupied and partly let out. Now what happens? The property was partly, imagine no separate residential unit. There is one house. First 6 months, the owner self-occupied the property. The rest of the year he let it out. In that situation, what happens? In that situation, whether it could be for the period for which it was self-occupied, should it be considered as self-occupied property, and the period for which it was let out, should it be considered as let out property, or should it be considered fully as self-occupied property, or should it be considered as fully let out property? Under which category we have to fit in? Because this categorization is very critical for computation. That is what we have seen, because all the deductions are depending on the categorization. So here the rule is that if the house property is partly let out and partly self-occupied, then it falls in the category of let out property, and accordingly the computation has to be done. This is one interesting situation where the property is partly self-occupied and partly let out. It falls in the category of let out property. So in the computation you have to be careful. Then there is a situation where there is a property which actually not let out. The intention is not to let out. This is a unique situation where they say under section 23(2)(b), where the house actually the intention is to occupy for himself. It was not let out, but he couldn't live there because for employment he had to move out of that place. He couldn't live there. In that case also, though he is not physically present in that house, it's a unique situation where if such house or part thereof cannot be occupied by him because of his employment, business or profession is carried on at any other place, he has to reside at other place that does not belong to him. In that case also, the Income Tax Act is giving the benefit of declaring that property as a self-occupied property. This is a unique situation which you can ask the client whether this particular property, whether you occupied, whether you lived, or is it left for letting it out, or have you retained it for self-occupation. If any such situation comes, make sure that necessary details are reflected in his tax computation. Going forward, this is the situation 23(3)(a) is what I was saying. If a house or a part of the house is actually let during the whole or part of the previous year, or any other benefit is derived therefrom. In the sense, part of the year I self-occupied, but part of the year I let out, then it will not be given the benefit of self-occupied property. It has to be considered as let out property. Then fourth category which we saw, let out full year, let out part of the year, let out part and let out self-occupied. These are the three things. Then fourth situation we saw, deemed let out. What is a deemed let out situation? That means When you say deemed let out, it is not actually let out. This is the special provision under the Income Tax Act where a person is allowed to retain 2 properties as self-occupied property. I can have one property in my name where I have say 3 properties in my name. 2 properties they told you keep it for self-occupation. Means what? I give you the benefit of not declaring any rental income. Though you may be living in one house, another house is fully vacant, but you have no intention to let it out. Say you have a property in Basangudi, you have a property in Electronic City, you work in Electronic City, Monday to Friday you live in Electronic City home, and weekends you come and live in Basangudi. So 2 properties, you have no intention to let out the property. Income Tax Act told, I will give you the benefit of considering it as a self-occupied property up to 2 properties. Earlier it was 1 property, they made an amendment. 2 properties a person can retain for self-occupation. But the same person has more than 2 properties. There could be a situation, I have 3 houses, even the 3rd house the owner has no intention to let out. He will tell, I want to retain even the 3rd house, I don't have any intention to let it out. But Income Tax Act told, they don't want idle asset. See, the intention of the legislature here is that you have invested in something, it should earn revenue, it should earn return. So, beyond 2 properties, if there is any property which is retained by the owner for self-occupation, that property is deemed to be a let-out property. That means what? The computation mechanism applicable for a let-out property comes in place. Means what? For that 3rd property, you have to consider fair rent, standard rent, municipal valuation, consider which is higher, take actual rent received or receivable. In this case, what happens? The 3rd property never had the intention to let out and I have not let out. The owner has not let out. So if you can imagine the computation, let us assume fair rent of that property is say 10,000 per month, right? Now fair rent is 10,000 per month. Let us assume municipal valuation and standard rent is also within that 10,000 and the first number is 10,000. Now next number is actual rent received or receivable is 0 because I have not let it out. Now what is our annual value? Between the fair rent, that first number, and the second number, whichever is higher. So which is higher? 10,000 per month. So 1,20,000 per month is the rent, notional rent, which is expected to be declared. From there, municipal tax paid is a deduction, 30% standard deduction, and if I have a loan on that property, claim interest on borrowed capital. So in this case, what happened? There is a notional rent, a notional income is subjected to taxation. So in my view, not in my view, actually I think in the Income Tax Act, this is one chapter where there is a taxation of a notional income. There is no real income. There is no real income, a notional income, assuming this 3rd property, if it is let out, what is the annual value, and you are expected to declare a rental income, and you cannot simply stop at saying, I have a 3rd property. You are expected to compute the rental income. Here is what that step-by-step approach to compute the annual value becomes relevant. That's why I told, practically if you come across a situation where somebody has let out a property, there is a rental income coming in, very rarely we will even think of fair rent, municipal valuation and standard rent, right? Because we always know that the actual rent received is much higher, we will straight away take the rental income and compute. But this is a situation where the assessee has a deemed let out property situation. We don't have the actual rent, which is 0. So we are compelled to understand what is the reasonably expected rent for that property. There is a number attributed to that, and we are expected to compute the annual value and declare that notional income in the return. Otherwise, practically what can happen, this can go on and on unless the case is picked up for scrutiny, because it is an invisible transaction. Somebody will ask whether income tax officer will know this. My answer is yeah, every return is not subjected to scrutiny unless it gets picked up for scrutiny and the officer really asks you how many properties you have, only it will come. Unless the assessee has more than 50 lakhs income, there is no need to declare all the properties. So where the vulnerability comes in future, he will sell one of these properties. That time he will come to you capital gain. Then if you declare a capital gain, the income tax officer sees that okay, this guy has 3 properties, 2 properties, this property what you sold, what did you do with this property all these years? So if he says self-occupied property, the officer can ask, okay, how many self-occupied properties you have in your name? I have 3 properties. Out of that, one property is what is being sold. Okay, all these years have you declared notional rent on this property? At that point, that question can come. So when you explain to the the client, most often the client will ask you that question back, how the income tax officer will know. So you have to tell, this is the situation. As per the rule, you have to declare a notional rent on deemed let out property. This is very critical. You have to ask that question if they have more than 2 house properties in their name. Now, this is the same thing I have explained in detail. This is a very simple problem. It is to appreciate the provisions. I think it's a very straightforward case. It is only to explain that mechanism, how to choose the rent. I think unless somebody is really, maybe quickly we can see fair rent, municipal rent, actual rent, whichever is higher. So expected rent higher of A or B, 90,000. Then actual rent, so whichever is higher. So first the cap is standard rent. So here there is no standard rent in this problem because it is not subjected to Rent Control Act. So the only number we have to compare is first fair rental value and municipal value. Between that the higher number is 90,000. Actual rent received is 72,000. Between 90,000 and 70,000 the higher number is 90,000. That becomes the gross annual value. From there the actual tax paid is deducted and net annual value is arrived at. Now second situation, so for each situation I have tried to bring an illustration. Next, if income from property, if the property has been let out for the whole year, however, this is a question of like a vacancy allowance. 1 month the property was vacant, so from 12 months rent, 1 month's rent is deducted as a vacancy allowance and balance is considered as the gross annual value. The property is vacant for the part of the year and owing to vacancy the actual rent is lower. So here is a situation where the standard rent is 2,40,000, but the actual rent which was received is lesser because it was vacant for 3 months. So in this particular situation, what happens? The actual rent received in this case, whichever is higher principle is not applied because it was vacant for part of the year. The rest of the year it was occupied. So it is pushed to let out property and whichever is less has to be considered. This problem you can understand it is pretty straightforward. Then this is the case which I already discussed. 2 independent units, first portion is self-occupied, ground floor is let out. So ground floor neatly you will declare as let out property and first portion. If there is a common loan, imagine 2-storied house and there is a single housing loan, then you have to do proportionate, you have to claim proportionate interest. Now coming to deductions, 30% of the net annual value is standard deduction and actual repairs and depreciation is irrelevant. Though the assessee has incurred any expenses, it is irrelevant. Now interest on borrowed capital, these are the conditions where repairs, renewals. So here the documentation, as I told you, here there are situations where practically what we come across. Joint property, husband and wife owning joint property. I have one slide on that, I will explain the situations, practical questions. Like there is a joint property, there is a joint loan. So first when they say that there is a joint property, the question what we have to ask is, when you say joint, there could be a situation where the name of the spouse is added only for security reason. The spouse may not be a contributor for repayment of the loan. Spouse may not have an income on her own or his own. So only for the sake of security the name is added, but predominantly the loan is being repaid by one of the spouses. Then the interest, the word joint ownership cannot be, we cannot split the rent and declare it. So if the person has no source of their income to contribute to repay to the loan, though the property loan is in joint name, you have to ask joint ownership. If they have joint ownership, then you can split it. If there is no specific ratio mentioned in the documents which the sale deed, then the assumption is 50-50. Equal share, then you claim the interest on loan in both computation. If they have no source, the spouse has no source and they have not contributed, then though it is a joint loan, you have to declare the whole rental income or whatever interest claim only in the person who actually repays the loan. This is one critical situation where practically we have to look through the documents and ask the questions.
In case of joint holder, there is no fixed percentage number.
No, there is no fixed. So if the documentation is silent, which is the case in most cases, they will be silent about the ratio of ownership. 50-50 is the accepted. I mean, we can.
Any percentage we can.
Any percentage. Like most conservative is 50-50. Now 60-40 if you take, there is a chance income tax officer will ask what is the basis for 60-40. This is an interesting concept. Pre-construction period interest. This basis I think it is okay, right? These are, if you have any doubt you can ask, because I think most of you are familiar with all this. We are just revisiting only. It is only a revision in all of your yes.
Regards to interest on loan.
Pardon me?
Interest on loan. Then it's in the bank only or NBFC also it's okay. You can take loan from NBFC.
Any loan, including relatives, personal loan. Even personal loan you can claim interest. They don't use the word financial institution. They use the expression interest on borrowed capital. Unlike section 80C where they say the loan, the principal portion what we claim, it has to be from financial institution. In this case, interest on loan from even relative is fine. And interest on loan after this pre-construction period interest, there are some situations I will tell you. What is pre-construction period? There is a loan, and once you start taking the loan, especially when you are investing in a property, say under construction, suppose you are entering into a agreement with the builder, and the payment, the disbursement happens on depending on the percentage of completion in installments. Loan sanction will happen, mostly the money will move from the bank to the builder directly. You will end up paying an interest until the construction is completed. Then construction is completed and the loan will continue. So under the Income Tax Act, whatever interest paid during the period when the construction happens is called as pre-construction period interest. And this interest portion, whatever has been paid during the pre-construction period interest, can be claimed from the year in which the construction is completed to the next 5 years in equal installments. So if you ask for the interest certificate, nowadays bank only will mention pre-construction period interest. Otherwise, if the property, if the loan is taken for a construction, going on construction, you may have to ask that in which year the construction got completed and whatever construction period interest paid during that construction period has to be claimed from the year in which the construction is completed. And the loan has to be paid within 5 years also. That is also another condition. It cannot be a situation where the loan was not repaid. So that condition has to be satisfied to claim interest on borrowed capital as a deduction. Just see if I have missed any point here. Self-occupied property, calculation. Now this is actually, I think we will have a separate session on, again this interest on borrowed capital, one amendment which recently happened was, see all these years, whatever interest has been claimed as a deduction under section 24B, suppose you have taken a loan, you have a property, and subsequently when the property is sold, any interest claim, any interest portion claimed as a deduction under section 24B should not form part of the cost of acquisition under section 48 of the Income Tax Act. This is an amendment. So that means people were claiming that interest as an additional cost when they compute the capital gains when they sell the property. I think when you have a session on capital gains, this will be mentioned since it has a connection with 24. This is an amendment. So till this amendment, in fact, before also, I'm thinking, I don't know how many people used to claim that interest as a cost. At least we were not claiming that interest as a cost. After the amendment only we came to know, oh, this was possible all these years, to be honest with you. We were thinking, oh, unless they specifically, so somebody already applied their mind and they realized that purchase deed, cost of acquisition included the interest component what has been paid to repay the housing loan. So somebody has used the brain to claim it and they got it, then they brought this amendment. So we were not claiming all this years, so we felt very sad that all these years we could have claimed. So this is one thing which you have to keep in mind. This set off and carry forward, this just I wanted to, for you to understand that there is an impact, two things you have to keep in mind. One is old regime, new regime, and another is letter property and self-occupied property. Self-occupied property, the maximum cap 2 lakh is applicable for both self-occupied property and letter property. But in the case of self-occupied, there is no benefit of that carry forward. But in letter property, that benefit of carry forward is there. So this is the situation where both husband and wife are co-owners of the property. Now, coming back to original section 22, we discussed annual value. We discussed different types of properties. Now, third situation was owner. The owner, who is the owner of the property? After reading who is the owner of the property, then we will know the situations of co-ownership and deemed ownership. So owner, as I understand in our common parlance, who has the right to enjoy, right to have possession of the property, who has paid for the property, he is the owner of the property. Now under the Income Tax Act, they are discussing two situations of co-ownership and deemed ownership. What is co-ownership? One property is, there are more than one owners for a particular property. That is called co-ownership. I'll bring that section so that you can read what is co-ownership. Property owned by co-owners, where the property consists of buildings and land appertaining thereto and is owned by two or more persons and their respective shares are definite and ascertainable. This is very important. There is a property where there are three people who are owning the property, but if their shares are not definite or ascertainable. So, in the case of a joint ownership, suppose the sale deed say that husband and wife owning the property, and if the shares are not specifically mentioned, they may not be given the benefit of co-ownership. What is the benefit of giving a co-ownership? The income can be split between the two people, two owners in their respective share. That is the relevance of having a co-ownership understanding. So if their respective share is definite and it is ascertainable, then such persons will not be considered as an association of persons. Suppose the definite share is not ascertainable, then it will be considered as association of persons, and that will be that status will be AOP, which is a separate status. In the case there is a co-ownership, which is the definite share is established, then the respective income will be taxed in the hands of the respective owners. Suppose there are multiple owners and the respective share is not identified, then the share, that the income will not be taxed in the hands of the respective people. The whole income will be taxed in the hands of one entity, that AOP, and the taxation will happen accordingly. So imagine you cannot split the rental income, you cannot split the municipal interest on interest claim and all those. So this is a concept where you have to understand when there is more than one ownership, you may have to ask whether the shares is definite and whether it is more than definite, whether it is ascertainable. There could be situation where it is not possible to ascertain the respective ownership. In that case, what happens? You cannot say that the whole income is taxed in the hands of one person, that multiple people will have it is an AOP. AOP taxation is different. AOP taxation is taxed at maximum marginal rate. It is, if the shares are definite, then you will get the benefit of slab. If the shares are not definite, what will happen? The income is taxed at maximum marginal rate. That is why when there is a co-ownership, we have to ask whether the shares are definite or ascertainable. That is the practical challenge in the case of a co-owned property. So these are the points which you have to remember. Co-owner is not assessed as association of persons. Each owner is treated as an individual owner. Each owner is entitled to benefit of self-occupied or let out, depending upon the situation. Suppose it is a let out property, the respective rental income will be taxed in their respective hands. If the property is self-occupied, each person will get the benefit of self-occupied property. Each co-owner is entitled to the deduction of interest. So separate people, husband, wife, joint property, shares are identified, 50-50 identified. Each person can claim the deduction of up to 2 lakhs if it is a self-occupied property. Then another concept, this is very important concept, deemed ownership. When you say deemed ownership, prima facie they are not owners, but they are owners which is deemed under the Income Tax Act. Which are the situations? First situation, an individual who is transferring a house property as a gift. Husband transferring or wife, one of them, the spouse transferring the gift to the other spouse, giving the property in gift without adequate consideration. When I say gift, there is no adequate consideration. Then the income therefrom is taxed in the hands of the original transferor. So when there is a transfer of property between spouses without adequate consideration, have to be very careful. The intention of that transfer may be to split the rent between husband and wife. That will not work, because even if there is a transfer, even if there is a gift deed, even if there is a conveyancing document specifying that this portion of the property has been transferred in gift, when I say gift, there is no adequate consideration. There is only natural love and affection. It is gifted to the spouse. though in the document it is the transferee is the registered owner, for as far as the income computation, if the property is let out, even the share of the transferee gets added, has to be reported in the income of, in the computation of the transfer. It is like our clubbing provisions. So if you read section 64 also, it will say subject to section 27(1). If you read section 64, it will talk like that. So this is something which we have to remember. So these are the situations specifically mentioned under the Income Tax Act where there is deemed ownership. One is individual transferring to spouse, then individual transfer property to minor children. One specific exception is minor married daughter, which we may not have now. It is 1961 Act. Minor children, same like clubbing provision. In clubbing provision we read, right, if the income is not earned out of the skill of the minor child, it gets added to the income of the parent whose income is higher. Same logic, if the property is transferred in the name of the minor, but the income therefrom is added to the transferor. Then holder of an impartible estate. If the partition has not happened, he is the deemed owner. Though the partition has not happened, if he is holding that estate, he is deemed to be the owner. So any income therefrom is tagged in his hands, in the hands of the holder. Then a member of a cooperative society, company or other association of persons who is allotted a building under a house building scheme of such society. So what happens? He has been allotted a property and the rental income may be going to the bank account of the cooperative society. But if that allotment has happened in the name of the member, then that member is deemed to be the owner. The income has to be reported in the tax return of the member. Then, under the person who is allowed to take or retain the possession of any building or part thereof in part performance of a contract, where every formality of sale is completed except the registration of the property within the stamp valuation authority. This is very interesting case, where money has been paid, right of possession has been given to the buyer, there is a seller and a buyer. The buyer has got the right of possession, the buyer has got all the rights, only thing that registration, that event of registration has not happened. In that case, if at that point if the property is let out, the property has the person who is allowed to retain the possession, the property, that income gets taxed in the hands of the person who has the possession. He is deemed to be the owner. So, if you come across any such, on day-to-day basis we may not have that situation, somebody comes until registration has not happened. Also we have to ask all these questions and see that whether he has the right to retain the possession and all the formalities in respect of the sale is completed. Only that event of registration is pending means he is supposed to be the deemed owner of the property. The buyer is deemed owner, though the registration has not happened. You can't say that the seller is the owner because the registration has not happened. The rental income has to be declared in the hands of the seller, you can't say. Because all other formalities have been completed. If it is only pending for the event of registration, then buyer is deemed to be the owner. Means what? The income therefrom has to be reported in the computation of the buyer. Then a person who acquires, this is a lease situation. We may not come across on day-to-day basis, but it is 100% required that we should know it. A person who acquires any right or with respect to any building or by way of a lease, by building or a part of the building by way of a lease for a term of at least 12 years. So that 12 years is very critical. Excluding the rights by way of a lease month to month. So monthly rental category will not come for a period of not exceeding 1 year. So that is why 11 months agreement are being entered into. Because once it crosses, then that ownership, there is a question. So different situations, the lease term is 12 years, then the lessor is the registered owner, but any rental income will be taxed in the hands of the lessee. He is deemed to be the owner when the lease period is more than 12 years. So if you have taken any from Karnataka Industrial Development Board, KIDB land, some 99 years lease, you will come across, and there will be a rental income from go down or warehousing and all. In such situations, we have to see whether the rental income is taxed in the hands of the lessee. And 11 years, up to 11 years, no problem. Beyond that, there is a deemed ownership attributed to the tenant. So any income therefrom, tenant subletting or something will happen means then that income will be taxed. That ownership is a question. So prima facie they are not the owners, but because of the situations they become the owner, and then the taxation under section 22 is attracted.
That is 12 years or 12 months?
12 years, lease 12 years. 11 months and 12 years, lease period.
Madam, in case point number 1,
yeah.
Individually transfer his property to either parents or children. That time, what will
So now, spouse only that. Children, major children, no problem. The child becomes minor children, only problem.
No, it's inadequate consideration. The person is transferring to either parents, like that.
Parents is not problem. Parents they have not told. Suppose the son is transferring a property to father. There is no deemed ownership. The father only will become. It will not get added to son's income. These are very specific. This is a one line. Taxes levied by a local authority in respect of any property shall be deemed to include service tax levied by the local authority in respect of the property. I never had a situation practically to see this applicability, but there is a section. Then another concept is unrealized rent and arrears of rent. So if you can imagine the computation, we computed the annual value, and from there rent received or receivable. There could be a situation where the rent was not realized. Actually, the rent has the owner of the property has not realized the rent. So it was not subjected to taxation at that point, and later at some point of time, this rent which was not realized initially was received by the person. Why I say by the person? Because by the assessee, because the year in which the rent was realized, there could be a situation this person has already sold the property. Some earlier unrealized rent, it is taxed in the year in which it is received in the hands of the person who realized the rent. Need not be the owner at that point. At that point, maybe he has sold the property, need not be the owner of the property, but if the money has been received in that year of receipt, it is subjected to taxation. This is unrealized rent situation, and there are conditions. There should be a tenancy, should be bona fide. And why it is unrealized rent? Because when we compute the taxation, if the money has not come, that unrealized rent is allowed as a deduction. I didn't get that money, so I will not pay tax on it. So subsequently, when the person received the money, it has to be subjected to taxation. So if it is claimed as a deduction earlier year, no tax was paid at that point. Subsequently, so at that point it was allowed as a deduction. Why? Because the tenancy is bona fide and the owner of the property made lot of efforts to recover the rent, but he was not able to recover the rent and the money he never realized. So he claimed it as a deduction and he didn't pay tax. Now subsequently, when he realizes the rent, it has to be reported as income from property and tax has to be paid. There could be a possibility when he actually got the money, he already sold the property, he is no longer the owner, but still it has to be reported in the hands of the person who receives the rent. Then arrears of rent. Arrears of rent means what? Rent was not paid for many years. This mostly happens in the case of retrospective situation where there could be an agreement between the tenant where they say that we increase the rent with the retrospective effect. So earlier rent wouldn't have been realized because rent was 10,000 per month, and today an agreement is entered into saying that with the effect from previous 2 years we increase the rent with the retrospective effect. So there is an arrears of rent. Again same rule applies. Arrears of rent is taxed in the year in which it is received, irrespective of the fact whether the person is the owner at that point of receipt. These are, if you come across any such situations, make sure that you apply these provisions. So these are the basic provisions of income from house property. Then another unique situation I wanted to discuss is coming back to original charging section. Let us read section that charging provisions again. Any other term which we have not discussed. Annual value of the property. So we know now what is annual value of the property consisting of any building or land appurtenant thereto. So we know building is a prerequisite. Vacant land is not subject to taxation under this section, of which assessee is the owner. So we have heard now ownership, deemed ownership, co-ownership, these situations we have come across. Other than that, now some exclusion he said. Okay, there is an annual value, there is a building, and there is an owner. Other than such portions of such property as he may occupy for the purpose of any business or profession carried on by him, the profits of which are chargeable to tax shall be chargeable under income from house property. So there is an exclusion, though other conditions are satisfied. Let us assume it is a self-occupied property. There is a self-occupation, there is an owner. and there is an annual value considered as nil. But the property is being occupied for the purpose of carrying on his own business or profession. It is outside the purview of this particular chapter. That we have to remember. Now, whether by doing business he earns an income, the point is if he earns an income from that business, that income though it is from that property. So we may have a responsibility to find out whether that business he is using the property and earning a revenue from that property. He is using that property, earning a revenue from that property, but that revenue falls within the definition of business means, then that revenue, that income will not be subjected to taxation under section 22. This is very critical because section 22 to 27 has specific methods to compute the tax income. So if the property is being used for the purpose of business or profession, then that is outside the purview of this chapter. This much we have to remember. This is the only last limb in that charging section. So this, yes.
If I am running a hotel, I need some residence, small lodge. Then in that case, you mean to say that
that income. Now, when you say lodge, that means there is a building. All the conditions satisfied.
Yes.
You have let it out. There is a building. You are the owner. Now you are not. It is actually self-occupied. You are using it, but self-occupied for what? For purpose of running business. So whatever revenue earned therefrom will not be taxed under income from house property. It will be taxed under income from business. It makes lot of difference because under income from house property, you have only 2 deductions or rather 3 deductions. 30% standard value, municipal tax and interest on borrowed capital. You will be all the more interested to say that I run business because against business income you have all the expenditure what you earn the revenue can be claimed as a deduction. We have some interesting situations we will discuss. But this is the point. So you have to ask self-occupied. Okay, I have 2 properties. I have self-occupied 2 properties. Okay, both can be said. Then you have self-occupied means what? Are you living there or are you running some business out of it? If they are using it for business purpose, then it is outside the chapter of income from house property.
Can claim also depreciation.
Depreciation not under house property.
No.
Under once it goes under section 28, yes. Also section 32, yes.
At a higher rate or lower?
Depending upon what is the acquisition and what is the purpose for which it is used.
Example as a hotel.
Yeah, the applicable provision as a hotel if the section 32 allows, yes, why not? You have to comply with section 32.
Is it litigation free or is it under litigation?
Now you have to prove you are running a business.
So if some commercial developers have let out the marks, they are claiming it as business income. But the department has put case on it. But it is under our property.
So here, good that you asked that question. Anyway, we have a discussion on this. So here, how you prove? Now the onus is on the assessee to prove that he is running a business. So the situation is like how letting out can be distinguished from merely letting out a property and letting out for business. When you say business, you give additional facilities. Maybe one point which we thought when Omar is in discussion, we will discuss it. We will bring that. I will tell you the theory. Practically, he will bring up the case. One property is there. Let us say one 4-bedroom apartment is there. Between me and my brother, let us say we inherited that property. I will tell that I will approach a broker. Please find some tenant. He will pay me monthly rental. I will enter into a simple rental agreement. I will not do any additional facilities or I will not even bother. It is like a normal, simple let out. Whereas my brother may be interested to list out the property, enter into say Airbnb, or he may want to run it like a vacation home, or he may want to give additional facilities in the form of housekeeping, security, internet, water charges, and he will give additional facilities, and it may not be one tenant. He may tell that I will run it like a PG. In that case, it becomes business. The volume, the frequency, the facilities offered, all those things will be the onus of the assessee to prove that it is being run. Because business definitely is more wider than a mere letting of property.
No, madam, one person take 2 loans separately, one for purchasing empty land, another for construction of house. Can you claim the interest on empty land?
So in this case, purchase of loan for the purpose of construction, they say. Okay, this is a debatable issue. There are judicial precedents on that. The land itself is used for construction, so that loan is nothing but it is a part. See, I cannot construct without a land. So if that is the case, then land, both loans interest can be claimed. It is how you prove to the officer that the purchase of land is pertinent for construction. That is what exactly we pleaded in that case which we came across. Yeah. But it was a very small shed or something, so I don't think we got a favorable, because it was at ITO level and the assessee didn't want to go to the next level, so he paid tax on it.
If it is considered as business,
Yeah.
so can we take 4480?
Obviously. 4480 can be. See, once it is outside the chapter of income from house property, then provisions of such business 28 to 44 will come. You can. That conditions have to be satisfied. That's all. You should be an eligible business. Obviously, income from business is so eligible. It's not a commission income. No, very less exclusions. So, in this context, I want to bring one case where there is a property owned by the partner of a firm, right? And the property is being given to the partnership firm to do its operations. Situation 1, let us assume the firm is not paying rent. Okay. Question number, the issue came up. The issue is like, if the partner is using, whether the property will fall within the exclusion saying that the owner is using the property for business. Who is running business here? Is the firm running business, or since he is one of the partners, he will get the benefit of exclusion? So, when the house property is owned by a partner, so this is, two situations are there. One is property owned by the partner and given to the firm for running business. Business is not run by the partner, business is run by the firm. So, if firm is paying a rent to the partner, that rental income will be taxed as income from house property in this computation. He will not enjoy the exclusion because business is being carried out by the firm, not by the partner. But these are all debatable issues. Where the house, another situation, where the house property is owned by the partnership, the partners cannot be assessed as co-owners under section 26. The firm is assessed as the owner. So this is the situation of AOP. Now there is a firm. The firm has a property. In the balance sheet of the firm, there is a house property. Now there is a rental income being received by the firm. So the question came up was, there are two partners, whether shares is definite and ascertainable, whether the rental income will be taxed in the hands of the partners, in the hands of the respective partners, or whether the rental income will be taxed in the hands of the firm. These are all litigation points. The Act is silent about such situations. So the partners cannot be assessed as co-owners. You can't say that the total income, since what is ascertained is the share of profit, not share of ownership in the property. So you can't say that in the profit sharing ratio the rental income will be divided between the partners and the respective rental income will be declared in the respective partners' return, was the decision in this case. The firm owns the property, the rental income will be taxed in the hand. Definitely they will be interested to consider a co-owner. Why you tell? Because firm's income is taxed at maximum rate of 30%. If they say the rental income can be split between both the partners, imagine both of them will get 30% standard deduction and they will get the benefit of slab rate. Then, transfer of immovable property of the firm to partners without a registered deed. Transfer is invalid, rental income from the property to be assessed in the hands of the firm. So, this is actually where they made a paperwork saying that the partners are the owners. There was no registration, so partners were not valid owners, so the rental income. These are all litigative issues. Properties cannot be transferred to partners by book entries of the firm. Income of the property cannot be assessed that of AOP but belong to the firm. So in the sense, all these are the situations where the property is owned by the firm, and if any paperwork is done to prove that the partners are the owners, it will not work. The income will be assessed in the hands of the firm. Here, this is the two school of thought. This is a ulta case where the property owned by the partner and used by the firm. Two schools of thought. One held that it has been held that the exemption provided under section 22 of the Act can be availed by an assessee if the business in which the assessee is a partner carried on the premises owned by. So the premises owned by the partner, by one of the partners, and the firm is running in the premises owned by one of the partners. In Rasiklal Balaba, it was decided, imagine the partner is getting a rental income. They told that it is income from house property. It is not income from house property. Why? Because he is carrying on the business, he is a partner in the firm. But another line of thought is no, the business is being carried on by the firm, not by the partner, so he cannot get the benefit of exclusion. It is a debatable issue. This is the question which Sir has asked. Composite rent, where property is being let out, there would be a situation where property is let out, the rental income includes the rent for, including nowadays it is very common, right? Bring your clothes, everything, rent, the rent includes rent for not only the building, it includes the rent for furniture and other facilities. So that is called composite rent, where the rent includes there is a component attributable to the building and there is a component attributable to other facilities. In that case, now if the component is separately identifiable, saying that out of the total rent what is being paid, if the agreement is very clear saying that this much is for occupation of the building, this much is for using other facilities, if it is identifiable, the portion attributable to the rent can be declared under income from house property, the rest can be reported either under income from business depending upon the volume and frequency, or under income from other sources. Where and the letting out of that facility is not integral part of the contract. In the sense, the tenant has a choice. Tenant can say that I can take out only the building, I need not use that facilities. It is not integral part of utilization, then it is possible. But if the composite rent in such a way that it is not possible to identify the components and letting off the asset and facilities is integral part for using the building, in that case, again depending upon whether it has to be under house property or under business, depending upon the contract, in the sense whether the landlord is telling that, see, this is what I have, this is the monthly rent, these are the facilities, you have no choice. And definitely the tenant also cannot have an option to avoid the choice, income from house property. In addition to giving the facilities, he is giving some extra benefits and all, and he is running it like a business, then it becomes either income from business or income from house property. So the point here what I wanted to drive is, when somebody is telling that I get a rent which has multiple components, please look little more deeper. Is it a composite rent where things can be separated, and whether the assessee is running a business or whether the entire thing can be reported under income from house property. This is very critical. Then, refundable deposit. So we know that. So these are the situations. See, why summary points? Because this and all are not straightly available from 22 to 27. These are practical situations. There is a situation where non-refundable deposit was collected from the assessee. Non-refundable deposit received from the tenant is to be included in the annual rent. Rent received or receivable. Non-refundable deposit is to be added on pro rata basis. What was the logic? The monthly rental income was very less and a non-refundable deposit was taken. So non-refundable deposit is a capital receipt for the owner, and owner told I am getting only so much kuti rent every month. So the assessing officer told, see, you are taking so much kuti rent because you have taken some lump sum. So pro rata basis he added. Another situation is notional interest. We have a discussion on that. So these are some of the issues. We will come across this. Shall we start now, Omar? Or what time is your break?
6 o'clock.
Shall I quickly go through this? Yeah. Maybe there might be a repetition. I think quickly I'll just read out some summary points so that we don't miss it. Then another situation is notional interest. Like as I told you, deposit taken, monthly rental is coming, the rental income is very small, deposit is huge. The income tax officer wanted to include this, maybe you can think, when we come back we can have a discussion. The question is, I am not going to tell the answer. Huge deposit was taken and a nominal rent was taken. Now, by computing mechanism, let us assume that actual rent receivable, somehow he managed to cross the fair rent, but a phenomenal amount of deposit was taken. Now the income tax officer told that you have taken very high deposit, I will attribute a notional interest on that deposit and I will consider it as a part of the rent and tax. Whether is it correct? Can he do that? That is one debatable issue. Then advance rent. For the next 1 year I will collect. There is a difference between rent deposit and advance rent. What is the difference? Rent deposit is something you have to give the back to the tenant when he vacates. Advance rent is collected in advance for future years. So So advance rent shall be taxable in the year in which to which relates and not in the year of receipt. So financial year wise we have to do. It is like a accrual. Yeah, it's like matching concept is there. We can't declare the whole rent for the whole year. Okay, next.
Then in that case, if I take a deposit, refundable deposit, non-refundable deposit for next 2 years, at a time I will take. Then in that case also I have to do pro rata basis.
So non-refundable deposit, there is no rent component. He will tell that you are not collecting rent at all. I will, pro rata basis only. 1 year he will split it and say this much is the rent, fair rent he will compute, and out of the non-refundable deposit this much is the rent. I will consider this as your rent and pro rata basis he will tax. Understood?
Yes.
So this, when assessee did not occupy his own residential house but lives in the same town with parents for the sake of personal convenience, annual value of such property shall not be taken as nil. So he is not self-occupying for, see where they gave exception, you are not able to occupy the property because for want of employment or something you are not able to occupy. For convenience if you choose, he will not give you the benefit of nil annual value. Occupation of the owner for the purpose of own residence in section 23(2) of the Income Tax Act refers to only human owner and not a fictional entity. Maybe this case. Deduction for interest on paid on loan is not available when loan was taken after acquisition of house property. This is so in the case of interest on loan, there is one specific circular. There is an original loan. In what all? First situation, taken a loan, repaid the loan. Second situation, taken a loan. Then I got some additional say facility with a new bank. So what I will do? I will take a new loan and repay the original loan. Even the interest on the second loan is allowable provided the original loan was taken for purchase, reconstruction or repairs, and this original loan is to repay the original loan. Now here is a situation where property has been purchased. After purchasing or after finishing construction a new loan was taken. Can you claim that interest? The answer is no, because the loan was not taken for utilization. Purchase or so the utilization is very important. So these are the situations where we might miss. They say property loan, you have to ask whether when the purchase happened. If you have taken the loan after the purchase process is over, it cannot be claimed as a reduction. Both husband and wife can claim exemption of interest on housing loan subject to the satisfaction that property should be registered in both the names, housing loan should be taken in both the names, housing loan should be repaid by both. Actually most of the cases first two will happen. You will find joint loan, both names will be there, but you have to really ask whether the spouse has the source to repay the loan. That is very relevant, especially when you declare capital gains also. If the what happens, rental income, if you keep, many cases I have seen, like throughout the year when they were getting rental income, one of the spouses will declare the rental income, but at the time of capital gain they want to split. So we have to be careful. Borrowed money utilized for paying a tenant, for handing over the possession of the property or for surrendering tenancy right, not allowed as so purpose again. Somebody took a loan for vacating the tenant or getting the tenancy right and all cannot be claimed as interest on. So interest on borrowed capital is very precise, purpose is very important. Even loan taken from relatives allowed as a deduction. In this point I want to tell, if loan is taken from a non-resident. Suppose you have a friend outside India and he helped you with your, you took it for construction or purchase of the property and there is an agreement where you will pay him interest. What is the agreement? You will pay that interest, you will deposit to his NRO account in India. You will not send it directly. There is option to send it directly or you will deposit to NRO account. What is the obligation as a person who pays the interest? You have to do a TDS under section 195. Section 195, I think you will have a session on it. There is no limit. Any income, any sum paid to a non-resident which is in the nature of income chargeable to tax in the hands of the non-resident. No limit. So this interest income which he earns on the loan given to the resident borrower is an income chargeable to tax in the hands of the non-resident. So the person who pays the interest has an obligation to do TDS. See, when you deposit to NRO account, the banker will not ask anything. He will not even know that you are depositing to NRO account. When this guy, your friend, want to repatriate the money, at that point the banker will ask for a 15 CSEB certification. That time the chartered accountant is expected to identify the source of this money. That time he will tell it is an interest on loan given to my friend. Two situations. One, the person who took the loan and paid the interest cannot be claimed, they cannot claim the deduction of the interest unless he pays the TDS as per chapter 17b. Second situation, the person who wants to repatriate the money, at the point of repatriation, if the chartered accountant will ask, what is the source of this money which is getting repatriated? Interest on loan. whether TDS has happened or has you declared the return of income. See, at the point of repatriation, there is a chance the person has, if he has reported the income in India and paid tax, at least at that point there is it will help the person who want to repatriate. But for the tenant, he cannot claim the reduction unless TDS has been deducted and paid under section 195, and under section 195 for TDS the person should have a TAN number.
No, this is a normal deduction, no, madam. Interest under a housing loan, no. So that is for 40, no. If the TDS have not been deducted, then that cost.
That is for business, but now here also, see, you are not running a business. You are a normal.
Normal, madam.
Yes.
So just because I did not deduct a TDS doesn't mean that interest is disallowed, no.
No, it is not only 40. Specifically, they are saying you have to do. Yeah. Even same thing I will tell you. Rental income, rent, no. See, you are using it for your residential purpose. You have taken a property on rent from a non-resident. Okay, the owner of the property is in foreign country, say US or Dubai. You are paying rent on monthly basis. As a person who pays the rent, you have an obligation to do a TDS under 195. You may not claim a deduction for business. That is a different problem. Section 40 may not be applicable for you because you are using it for residential purpose. But the income tax officer can send you a notice asking why you didn't do TDS. Because TDS compliance has something to do with whether you are using the property for business or residence.
Agreed. I was talking about the disallowance of interest.
So here, that's the same point I am saying. When you are making payment to a non-resident, the utilization for business or not is irrelevant. You don't have a specific section to disallow. But if you are claiming that interest on borrowed capital and that loan is taken from a non-resident, income tax officer will not allow you that deduction. He will deny you that deduction under section 24 itself.
24 also?
Yes. There are certain categories of income which appears to be income from house property but not charged as income from house property. Rent from putting up hoardings on the top of a building. The assessee has a building. The terrace has been let out to put a hoarding, advertisement hoarding. It was held that income cannot be considered as income from house property as hoardings do not form part of the building. It is a separatable thing, right? Income chargeable under income from other sources. Rent recovered from employees for occupation of residential quarters owned by the company is taxable as business income, not income from house property. Property given to bank and police station for smooth running of business. Income from such property is taxable as business income and not income from house property. These are all helpful to understand how the department is viewing the situation. Leasing of shops in a mall along with various other facilities accessible as business income. It was not a case of giving shops on rent simpliciter. Assessee entered into business of renting out commercial space along with that facilities. That is why it is a business income. Leasing the hotel and charging 1% of total revenue accessible as business income and not income from house property. Then this is, though it is related to the building, there is a passive connection with the building, the income is not taxed as house property. Other categories where it is charged as income from house property. Maintenance charges. This most often we come across. They will ask the question, the tenant is paying maintenance charges directly to the apartment owners association. It is not coming to my bank account. So it is not, even rental agreement itself they will make like that, saying that rent should come to me and maintenance charges. Whether the maintenance charges is a rental income or not. I think we have a case on that, no Omar? So it is a food for thought. Letting out commercial space where objects of business is not letting activity. The High Court opined that since the assessee had not engaged in any business activity, income received from letting out of the property is assessed as income. So this is where you have to prove, to answer your question, this case law, where the assessee has the honors to prove that it is not a business. Definitely the officer may have interest to prove it as business or whatever. Rental income from unused portion of business premises owned by the assessee engaged in software business is income from house property. Income derived from unsold flat. So this is the fourth category. If you remember type of the property, to recollect self-occupied property, let out property, various categories we saw. Let out full year, vacant, partly self-occupied, partly let out, deemed let out. Then fourth one was, another category was house property held as stock in trade. But what is the situation? A builder has 10 flats and he is waiting for the buyer, right? So the government came up with amendment saying that 2 years we will give you the benefit of keeping it as a current asset, as a stock in trade. Please find your buyer and sell it off. If you don't find a buyer, then what happens after 2 years? The builder has to declare it is deemed to be let out property, and he has to declare rental income. Income charged as house property income. These are all some of the situations where it was considered as house property income. Assessee company engaged in the business of construction and development of residential and commercial units. It had given some commercial units on lease and received rent therefrom. Assessee failed to prove that lease rent received by it was from exploitation of the property by way of complex commercial activities. See, these are the expressions. He has exploited it for complex commercial activities. Therefore, it was assessed as income from house property. The officer will be interested to push it under income from house property, because under business means the assessee has option to claim lot of expenses, right? Business closed and quarters attached to factory let out rental income, not a business income and as well as income from house property, merely because in the past the premises have been used for commercial purpose. So, past utilization may not be the criteria. Earlier years, I was running a PG in that premises. Now there is no PG. There is only one person occupying the premises for his residence, and I am not giving any additional facilities. So it makes a difference in your computation. Till last year, this was declared under business income. This year onwards, it is coming as house property. So you should have enough documentation to prove that it is no longer a business. Any questions?
In case of reverse mortgage.
Yes.
In case of reverse mortgage.
So reverse mortgage, let us understand, I own a property, the assessee owns a property. He enters into a contract with the bank, where the bank will be giving monthly rental, is it? Monthly rental. And
They may give some lump sum amount, and after 10 years property goes to bank.
So in the case of mortgage property, this becomes a rental income, because it is
To
from
bank.
properties. To who the owner receives the rent, right? The person who owns the property receives the rent. It's like only thing is, at the end of the this person's life, what will happen, that the money has to be repaid, no?
Property may go to bank.
So there is no question of repaying that mortgage amount. So, but there is an option for the legal heir to repay the. There is no specific exclusion. Maybe some case law we should see. Any case laws are there, Omar? In the case of mortgage, reverse mortgage with the bank. As to my mind, there is no specific exclusion. It should be taxable as income from house property.
So you will be the real owner, but then you will also be earning the income.
Yeah.
So you will
See, in this case, bank cannot be the deemed owner, because there is an option for taking the property back, right? It is only an arrangement with the bank where banker will, at the end of the year, if I repay the loan, the person can take the property back. So,
but is it even a rent? Because I am the occupier. I am occupying the house. I am the tenant. I am the owner. I am receiving the rent from the bank.
That's what we see itself. AMHS will help senior citizens to monetize their property. But it is structured in such a way that you still be the owner until the bank takes register the right of possession. So you still be the owner.
so his question is, can he enjoy the benefit of it being a self-occupied property, though he gets that monthly amount from the bank?
Yes, because that is more in the nature of capital receipt. That is not rental receipt. So you will be chargeable to capital gains tax when the transfer actually happens later on.
So the monthly amount what he receives may not be taxed under income from house property.
No, it will be capital gains eventually. That is what we see. Whenever there is a problem related, that was his scope.
Otherwise, it will be detrimental to the senior citizen. He ends up paying tax on it.
So the banks may not realize that capital. Government may not realize.
Yeah. It will come as a monthly credit in the senior citizen's bank account, is it? That amount?
Yeah.
This is similar to the case where we have one case now where company takes the property and give it back to the director. No? Maybe in that context we will revisit this.
Ma'am,
Yes.
section 27(1). So in case of a divorce agreement, the husband is transferring a property to the wife.
No deemed owner, because other than in the situations where there is an agreement to leave a party is there. There is a specific exclusion. It is there. It's there in the section itself. Yeah. If I have not put in the slide, it is a lapse. Other than where there is an agreement to leave a party, it is there. In the case of divorce, transferee becomes the owner.
In
Yes.
which case, the gift deed and even if you're registering the property in the wife's name,
Yeah.
then if there's no divorce, on a normal scenario, if we are having a gift deed as well as transferring, getting it registered, still it will apply.
It will apply provided there is no adequate consideration.
So making sure adequate.
Yes. Exception, if you see the first thing, property is transferred with an agreement to live apart. Then the registered owner will be the transferee.
I have a question over here.
Yes.
So, in this case,
You will only find the answer also.
no, I mean, I just came across me when the participant asked me the question.
Yes.
Recently, I was reading a news report where due to a divorce decree and the house being valued at like a very high value, they are not able to split the house, right? So the court has awarded the spouse maintenance to ensure a lifestyle is maintained, that the husband has to give monthly rent equivalent to 35 lakh rupees. So she's getting this maintenance for house property to maintain her lifestyle of 35 lakh rupees. So will that also be exempt in her hands? Because of an agreement to live apart and she's getting 35 lakhs per month.
No, why it is exempt? Agreement to live apart means she becomes the
She has no ownership. So because she's not able to give us
she has no ownership. Maybe income from other sources will tax.
The judge has said that you have provided a house where the monthly rent should be equal to 35 lakh rupees. That kind of house you have to provide her.
So she is not the owner.
She's not the owner. She's not getting this house as well. But the husband has to ensure that she lives in a house where the rent can be up to 35 lakh rupees.
So in this case, I think it may not be. He may not have the power to bring it under house property. It is not a capital receipt, no.
That's what, so
It is not a capital receipt according to me. He can tax it under other sources. He will tax it under other sources only. Yeah. Any other situation? Have we covered everything? So these questions we will see. Another 10 minutes. Mr. A took a loan on property for personal reasons. These are some, I am sure all of you know. He passed away and his son inherited the property and continued to pay EMI of the loan. So father took the loan for personal reasons. Okay, he inherited including the loan. Can the son claim interest as a deduction? What is the answer? Yes, no, not applicable. The section says where the property has been acquired, constructed, repaired, renewed or reconstructed with borrowed capital. So the amount of any interest payable on such capital. Since son did not acquire the property with borrowed capital, he cannot claim a deduction. Self-occupied. So the loan is for some personal purpose. And he inherited the loan and he repaid the loan. It has nothing to do with the property. Self-occupied and deemed let out. This is an interesting case. A non-resident Indian, resident in USA owns and lives in a house in USA. He has an own house in USA. He also owns a house property in India. In this case, imagine he also owns a house property in India as well as another one in Singapore. So basically, 3 properties in that person's name. He lives in USA. Maybe once in a while when he goes to Singapore, he will use that house. Otherwise, throughout the year it is vacant. And when he comes to India, he will use this house. Or there is no intention to let out. The intention is to retain it as self-occupied property. Whether he has to declare that deemed rental income in India as per section 23. So what we understood, any persons owning more than 2 self-occupied property, the third property at the option of the assessee. The assessee has a choice. The officer cannot insist that the property which fetches the maximum rent should be declared as deemed let out. At the option of the assessee, he has to declare one as DLOP. First, whether you agree on this, don't read the answer. In fact, I wanted to do animation, but so the thing is, the section doesn't use the word in India. Actually, Income Tax Act is aware of that word because if you see section 54, they say property has to be purchased in India. If the person purchases property outside India, they will not get the benefit of section 54. So it is not, Income Tax Act is not aware of that. Income Tax Act has not told whether the property has to be only in India. So in this case, the officer, I think he insisted to declare a deemed rental income on the property in India. He cannot insist on house. Obviously, the assessee has a choice. So, Income Tax Act does not specify the self-occupied property must be situated only in India. From the reading of the IT Act, the rule of more than 2 properties will apply to global properties, not just to the property situated in India. So this question maybe we should ask to our non-resident clients.
But practically it doesn't really make sense, right? Because if you are non-resident, your foreign property entities cannot be taxed.
No, income tax officer will not tell DLOP. He will tell you declare DLOP of the property in India. That's also is in India, right?
But it's in the option of the.
So assessee, see, if he opts to declare Singapore property, that is not right, my problem. There it is extraterritorial jurisdiction. He can't say all the 3 are self-occupied. So he will say one property you have to. I will tell you declare on India. That right India income tax officer has. There if the assessee chooses to declare Singapore, income tax officer cannot say no. He has the power to insist on Indian property. The very fact is the assessee has a property. Can interest paid on loans taken from friends and relatives be claimed as a deduction while calculating house property income? The answer is yes. There should be documentation and you have to prove. The problem here is you have to prove that loan was used for your property construction. So you may have to make sure the money comes to the bank account and from there all like a capital gains account scheme you may have to operate it. All the checks to the builder or construction or masonry, everything should go out of it and you will have a tough time proving this. If the interest claimed on accrual basis is not subsequently paid by the assessee, whether taxable as income from house property. This is an interesting case. See, unlike municipal tax, they use the word municipal tax on property can be claimed only on actual payment. But interest on borrowed capital, they never use the word paid. That means on accrual basis also you can claim it as a deduction. Now, throughout the year you claimed it as a deduction. At the end of the year, he didn't repay, it became a bad loan and he didn't repay the loan. What is the consequence? I don't know how income tax officer will catch this, but if at all he catches, he can disallow that, obviously. Whether interest on loan taken to buy vacant site can be claimed as a deduction, the answer is no. This is under section 10, where specific exemptions. It is all the conditions satisfies. What are the conditions? It is a income from house property owned by the assessee, building on land apartment, that all the conditions satisfies. But section 10, as always, they will give some, though other conditions satisfy, it overrides. This section 10 overrides and they give benefit. Income from farmhouse forming part of agricultural income. There are a lot of case laws. If you do this, interesting case laws are there, how exemption was enjoyed. Annual value of any one palace in the occupation of an ex-ruler. Property income of a local authority. Property income of, these are all very direct cases where, so if you come across any of these situations, you make sure that you don't miss it. You should not be insisting to tax. Then these two sections, you may come across this when somebody, you have a chapter on computation of total income, so they will discuss chapter 60 deductions. But since it is relating to house property, I thought I will include 80EE and 80EEA. These are some special sections which they introduced, in fact, to encourage housing sector. If you comply with certain very precise conditions on the value of the house property and amount of the loan and period of the loan. 3 things. Period of the loan, value of the property and amount of the loan. If you satisfy that specific conditions, additional deduction in addition to the interest claim under section 24, you can claim additional deduction. So these are precise portions, make sure you read it. Then this we already discussed. Composite rent, non-refundable deposit. Thank you so much. Thank you.
Should I start or we'll wait for another 2-3 minutes?
In 10 minutes. 6:30.
All of you.
Start ಮಾಡೋಣ. Good evening to all. I first of all thank ICAI for providing me with this opportunity to speak before you. Today I'm going to be speaking about pertaining to the important topic of taxation of income from house property. I say important because as India is growing by leaps and bounds, real estate is emerging as a major asset class. And these 7 sections, though simple, play a vital role in facilitating tax collection from the revenue yields of this burgeoning asset class. Therefore, these 7 sections, though might seem small, have a major impact on revenue. If income tax gave us bifurcation of headwise income on which tax is collected, I think real estate, income from house property will be one of those prominent sections after house property, after business income that is. I also would like to thank Rani ma'am for accepting my request to stay back and conduct this session jointly, because Rani ma'am is Rani is an inspiration and also a guide to me. Inspiration because of all the wonderful initiatives she's taken, like writing books on international taxation, driving us on research. So the way I have structured this session is that I have crowdsourced certain queries from various professionals on pertaining to income from house property. I'll pose that question to Rani ma'am, who's an ocean of knowledge, and after that I will also present what is the legal research, what is the result of the legal research which we have done on these questions. So that is how I've structured it. So before we start off, there are certain fundamental questions, philosophical fundamental questions that always arouse the curiosity of man. That is whether the chicken came first or the egg came first. When will the RCB men's team win the IPL trophy? In that same league of questions, I felt one of these questions is whether rental income from house property is business income or income from house property itself, because it is such a litigated question. So my first question to you, ma'am, will be whether rental income from this structure, is it business income or house property income?
Yeah, so taking a thread from the discussion what we had, Amar, I will go back to that original example. Let us assume we inherited a property, me and my brother, a 4-bedroom apartment in Bangalore. So we decided, okay, we'll let it out. Now, I being I thought it is easy to catch some magic bricks or somebody or some broker and tell, see, please find a tenant and this is the monthly rental, let it come to my bank account and peacefully I will declare my rental income and be happy. But my brother being very ambitious, he told, no, why you want to settle with that? I will get it listed with say Airbnb and we will give it additional facilities and we will convert it into a vacation home. So to my mind, that approach, how you want to get there, though both generate, other conditions are satisfied. It is from property, we are the owners. Other conditions being the same, the character by which the income is revenue is earned makes a distinction. So in my case, it will be house property income. If we take the way my brother wants to do it, it will be business income.
But madam, alternatively, say for example, I have incorporated one private limited company and I have taken some 50 homes just for rental purpose, residential rental purpose.
Now 1 minute. You are private limited company means 2 people should be there.
Yes.
Now there are 2 directors.
Yes.
There is a private limited company being incorporated.
Yes.
Now property is in whose name?
Company's name.
So company bought a property. So it is a fixed asset of the company.
Yes.
Now what do the company want to do?
They want a fixed income so that only rental income will be,
Very much to my mind, it is how the company wants to earn revenue. Just they want to let it out the premises and keep quiet and earn monthly rental income, or they want to give additional, make it a big thing like
only rental, madam.
Income from house property, because they never told a person, only individual. Any person under section 2 subsection 31, any person having income from property is under income from house property. Company can very well have a rental income.
It is optional or it is
You have to prove, the onus is on the assessor, it is not optional. You have to prove whether you are keeping it as only a mere render simpliciter or you are running it like a business, like a high level, like a service apartment where additional facilities are being given. Maintenance of lift, security charges, internet charges, and how you are running it. That makes the difference. Maybe Omar should add.
Question is start from this asking that company start its main business is renting out the.
So you have the answer already. You are in the, when you say in the business, what do you mean by? I think maybe Omar you should take the question.
So this thing,
See,
situation
to
is
be very
common
honest,
where
this is a
case
session
law,
of Omar,
right?
okay?
Right. So there are two overarching Supreme Court decisions on this currently, which are like guiding lights. So there is one decision in 2017, Raj Dadarkar and Associates, and another is Chennai Properties and Investments. In Raj Dadarkar and Associates, what the SEC did is, it's a partnership firm. They took a bare shell structure. They took possession of their bare shell structure, put up shops, and let it out. Right? They had in their objects clause earning rental income. Right? In their partnership deed they had there. Supreme Court said, no, you're just earning rental income from this property. You're not providing any continuous services, no organized activity is there. So therefore, it is income from house property. In Chennai Property and Investment, again Supreme Court itself, in this there were two properties. One is both very high-end properties this company bought in Chennai, luxury properties. So there the Supreme Court looked at the objects clause and said, okay, you want to invest in house property and earn rental income, it is business income. So still, no clarity, right? Both the decisions are the same, because over here they looked at the object clause of a private company, and over here in the partnership form also it is mentioned. So therefore there is another decision after these two decisions of Allahabad High Court, Miraj Estates and Developers. Over there they have differentiated both the decisions. They have considered the principles emanating from these two Supreme Court decisions, and they have said that, you know, okay, you also have, even in this case, the private limited company had in its object clause that it will acquire property and earn rental income. But they said it is not just earning of rental income by renting simpliciter. That is, you can enjoy the property, enjoyment of the property or exploitation of the property. Over here, the SSC had let out a house to Gale, and they also had said that, you know, they will maintain the property and all of that. The Supreme Court said, the High Court went into the facts of the case. It said you have employed only one person for just cleaning or whatever it is. There is no continuous activity, nothing is provided. What you are earning is just rent. Whereas if you are doing something in addition, right, providing services, for example, there is a Karnataka High Court decision of Rao Consultants. That's also a recent decision of about 2021. Over there, they are providing, say, leased line, they are providing furnished spaces and all of that. Then, that rental income which they are earning is business income. So, they look at the intention, that is whether you are exploiting, whether there is a concerted effort. Only if there is some concerted effort in earning that income, then it becomes business income. So, in every case, it will be a very fact-specific exercise. You will have to be able to prove it, because otherwise for the assessing officer both the cases, like, you know, are supportive, right? Chennai Investment also you can fall into, or you can fall into Raj Dadarkar and Associates. So that's how it is.
So something that they should pay some value addition services.
Exactly, value added services.
To be making it as a income from business.
Yes. That's
I think some principles of common sense we can apply. I will ask you a simple question. Somebody, you have a house, you are renting it out, one family is living and giving you rent. Same house you are letting out, somebody is running a PG. Immediately you can make out, right? The running a PG is a business.
But he is running, but for
me. No, I am telling the owner himself. Owner himself. Not the tenant.
Oh. Right. So in a similar sense, right now if you go outside Bangalore, go towards Tumkur Road, go towards Kolar Road, everywhere, because of the e-commerce boom, you see a lot of these build-to-suit boards everywhere, that, you know, you put up a warehouse and you let it out to one of these fulfillment centers. So it's become quite a common way in my circle, at least, that whether it is income from house property or income from business, when you construct a warehouse and let it out for warehousing purposes. So again, for that also there is a Madras High Court judgment, where again they say that, you know, if you just earn rental income, then it is income from house property. Whereas over here you are providing storage solutions, you are doing storage, you are giving updates, what is stored where, so all that. So same just is continuing, right? Concerted effort. So with that, I think at least for whether rental income or business income, these case law are the guiding light. Next, now if you look at house property income chapter itself, there are about 7 sections. Section 22 is the charging section, which has about 4 limbs in it. So the first limb says that there has to be an annual value, and annual value pushes you to section 23. So with regard to annual value itself, there are a lot of questions which I took a source from. So let me pose the first question to you.
Yes.
So in this question, the SSC runs a hotel in a multi-storied building. He has let out the ground floor because to attract more footfall to his hotel and to make it more prominent, he let out the ground floor shops for rent-free by taking or nominal rent by taking substantial deposits. So the question is, can notional interest on interest-free deposits received by SSC, can it be charged to tax under income from house property, or could it be in business income itself?
I think this one question we had posted before break, no? Whether notional interest can be brought to taxation under section 22.
Yeah. Yes.
Correct?
Yes.
I think that question was there. I have not forgotten. Ma put in
We also have.
that. So, anybody has any inputs? Like, now we have understood the basis of charge. We have understood.
Now then the company is assessable value itself, that is comparable rent will come.
So in this case, the nature of the receipt is a notional. See what is happening? There is a deposit and there is no rent. Now the officer wants to say that whatever interest, perhaps he will be saying that the deposit what you take, you put it in a bank. You will earn an interest of say 6%. I will tell that you are not taking rent because you have taken the deposit. So it is actually that interest I want to consider as income from house property. So the question is whether notional interest can be considered as income from can be considered as annual value.
Before going to that standard rent and
Right.
usual rent, there we can get the answer.
So if ALV is computed, it is correct, sir. But sometimes what assessing officers are doing is they want to compute interest income itself. But if you go as per that, so that's what even courts are holding. Then you compute what is the lettable value. If the lettable value is higher, you do it. But what has happened in a couple of instances is, for example, in this next case, CIT versus Asian Hotel, Delhi High Court, they have tried to say that this notional interest will be charged as perquisite under section 28(4) of business income. We will charge it as a perquisite because you are getting this interest-free deposit from the business you are running. So the court has held that 28(4) perquisite is only for other than cash, only in kind. 28(4) applies only when you pay something in kind, not in cash. So that's why they have been able to sail through. But now from assessment year 24-25, that amendment has happened because a lot of these this thing, right, all these one-time settlement with banks and all of that, they were escaping taxation because of this 28(4) only in kind section. Now it's been amended, so we have to see whether they can now go ahead and charge it under 28(4) because of the ratio emanating from this decision. Whereas in another case over here in CIT versus Moni Kumar Subba, the SSC was earning monthly rent of about 5 lakh rupees. Even in I think Shobha also, Bangalore case, Bangalore tribunal judgment also, right? So what happened is they received an interest-free deposit of about 10 crores and reduced the rental value. So the assessing officer wanted to charge notional interest on that. In this case, Delhi bench, the tribunal has said that you can't charge notional value. You have to go as per what you said, fair rental value. You compute that and you charge. This is wrong. What you have done is wrong. Therefore, the order was quashed. Whereas in the case of Bangalore tribunal, Shobha Investments, there they have said no, notional interest also is this thing. You have to pay tax on that. There is prima facie case, and they have allowed it. So that's how it is.
See, previously in the previous slide, 28(4) you were telling that. Actually, we were talking about income from house property. 28(4) perquisite, I did not get that law.
28(4) is charging section under business income, right?
Yeah.
One of this thing is charging perquisite from
Yes.
business. Like if you are a doctor, somebody comes and gives you a gift for saving his life.
Yes.
He gives you a car. Okay, 50 lakh car. That is your income, right? That is what the 28(4) was for. So therefore they said no, this is also perquisite. So that time the judgment said, the court held that 28(4) is only to tax situations where you are getting something in kind, whether they convertible in money or not. So that is why this thing is. That is how they were able to sail through, but maybe not now.
So between house property and business, why prima facie the officer would have thought that it is not income from house property. First he chucked out of income from house property and he bought the income to business chapter. Then so that I think the intention may be to get a loop for that he can bring it under taxation. Because if you strictly go by the method of computation of income under 22, it is not fair and municipal value standard rent you will put. There is no room to accommodate notional interest. That
No,
is
why the income tax will normally want to go for, what do you say, notional rent rather than comparable rent? Because in India, if you look at Bangalore's market itself, rental yield is about 6%, right? Whereas interest rates are hovering at around 10%. That is, so you will tax higher income over there. Whereas if you go for comparable rent, because this thing is standard when you compare, when we talk to SSEs and all of that, when you compare Bangalore or Dubai has rental yield of about 10%, 10 to 12% on their this thing. Whereas over here capital appreciation is more. In India the market capital appreciation is very high, but rental yields are pretty low. So that is why officers prefer to tax under business notional. They want to bring to tax notional interest because it is easier to compute also. Where will the officer go and look what is neighboring property, how much rent they are giving and all of that. Now maybe they look at magic bricks and all that because we are seeing assessment orders where when you have claimed agricultural sale of agricultural land, they have gone on Google Maps, they have checked what is the distance between the outer periphery, outskirts, so all of those things.
It's
Right?
not mentioned in the act itself, it's drawn from case law.
Yes. Yeah, this is this thing.
Actually, notional thing you can attribute only for fair rent. Anything other than that, he can't bring it under Chapter 22. You compare between fair rent and actual rent. You can't bring notional interest and say that it is a substitute for fair rent or rent. He can't say. That is why we want to push it to first get out of income from house property. Business has more wider ambit, and as Omar rightly told, definitely he can get more bandwidth by bringing it under product. Yes.
Next question we have already discussed in the previous stage, but over here what I wanted to bring to the audience's attention is that when you normally say you are living in a rented house, in Bangalore it is common term that rent girada, lease girada they will ask, like you deposit, you give a substantial deposit and you give it out on lease. Okay. Now this lease amount you will deposit it in an FD and you will be earning interest income from that. Whenever the tenant vacates, you will give him back the interest free deposit. Now this, when you deposit into your FD, it will start reflecting in your AIS and you get a notice. Earlier all that used to not happen, now it will come in your AIS. So when we are filing returns and all that, normally we are, nobody ever pays attention to this aspect. But can there be like you take lease deposit, take that you use that funds to make an FD, you will start earning interest income, and then if it gets picked up for scrutiny, asking where do you get the funds for these making this FD? You say I got into a lease agreement, I've got this rent-free deposit. Can the assessing officer then assess income on house property on the fair rental value and do a double whammy to the assessing? There where you are also earning your tax under this thing on the interest income plus also on your house property income. What is your opinion?
Unfortunately, I think yes.
Yeah.
There is no sympathy, I'm sorry.
Can it be taxed under income from other sources?
Interest will be
Interest will be charged on other sources.
The two are different.
Yeah, that's all. So that situation is covered under Karnataka High Court judgment itself of Ujanappa, where they have said, yeah, like interest is you tax it under other sources, and over here on the annual value you have to pay tax.
What is restricted to the annual value?
Annual value.
What is the fair rent?
So fair rent and actual rent zero, so mostly you will end up declaring fair rent.
Then
What
this
we
is,
are doing is another question.
then this question. So there is Mr. X, who is owner of Building B, right? He lets it out to Firm F, which is into providing co-working spaces. So they will get some enhancement, they have a brand and all of that. So can the assessing officer say that, you know, this, you let it out at say 100 rupees and the Firm F is earning rental yields of say 500 rupees, almost 5 times more. Can the assessing officer say, you know, even your annual value, because it is expected rent, right? Fair value is expected rent. Can he go back and assess your income also at 500 rupees itself? What your tenant is getting from his sublettees, will he be able to assess that income in your hands as well? In Mr. X's hands in this example.
Subletting. Actually, subletting is under other sources. What does it say? Legal research.
So that's what.
That's what he's asking.
No, he has done legal research.
So in this, so in a similar matter in CIT or Calcutta acquisition, CIT also the Indira Company Limited, they have said that, you know, you have to go by the bona fide with the agreement. Maybe the other party is doing some enhanced services and that is why he is getting higher rent. So you have to go by the bona fide of the agreement, and otherwise it becomes very dangerous. Nobody is ready to sublet it. Now in this case, there is owner of property.
There is no concept of fair value, standard rent. Where is the concept?
It is there, but you don't
Fair
exercise
rent.
it.
He will ignore fair rent provisions there.
Fair rent.
See, the same property, you will let it out.
Standard rent is not there because Rent Control Act is gone. For most of the properties, when Rent Control Act was promulgated in, I think it was re-promulgated in 1999 in Karnataka at least, and it was applicable only to property which are older than 15 years at that point when the Act came, and it was supposed to have a limited life, right, to enhance the economy for the move. So therefore now fair rent is whatever your expected rent is.
So on the same property, you have let it out for 1 lakh per month and your tenant is letting it out for 5 lakh per month. Definitely that is fair rent. No? Straight away, without any hard work, the income tax officer got fair rent. What is fair rent? The amount for which the reasonably expected rent. I think there the agreement should be strong enough to prove that subletting agreement is different from original agreement.
Yeah, and what is the subletting business? Like, you know, there are more of this stuff. That is what.
See here, no, this 2 minutes. Here, see, somebody will come to you asking, we are entering into a rental agreement, sir, rental agreement also, thing and all, they will come to us, no? Don't think that this is only for computation of income from house property. Many times the tenant, the client comes to you for, he might give his big premises for some business, tech park or something. That time you should make sure that wording is fair enough that income tax officer will not catch.
All the chartered accountants have to become lawyers now, right? After caseless assessment. Paperwork is so important for every transaction. So in this case, ma'am, there is a owner, Mr. X is the owner of property. Due to depressed market conditions, the property was vacant for the entire year. He tried to let it out. Now, if you look at annual value computation, it gives you a vacancy allowance. And in the verdict, it says the vacancy allowance is for property which was let out and then vacant. So, is it mandatory that the property should have been let out at least for part of the year, and only then, if it was vacant, you can claim vacancy allowance, and if it was vacant for a whole year, then there is no vacancy allowance. You have to pay tax as per expected rent, that is on fair value basis.
I have all the intention on earth to let it out.
Yes.
Please give me vacancy allowance.
So,
see, tenant didn't come. What can I do? I think there is a case on that.
yes, that's what. So let's look at the legal. So there are two case laws, right? One is Vivek Jain versus ACIT, Andhra Pradesh High Court, 2000, pretty recent itself from case law perspective. Here they say that if you look at the construction of section 23(1)(c) providing you vacancy allowance, it had to be let out for some part of the year, and only then you could have claimed vacancy allowance. Because it was not let out throughout the year, no vacancy allowance, you pay tax. Whereas in the case of our batting maestro Sachin R. Tendulkar, the Mumbai IT-80 said that you had the intention to let out, for whatever reason you couldn't let out, we'll give you vacancy allowance. So those are the two this thing. But it is very difficult to convince an SSC saying that there's a high court decision, you pay tax on expected rent. Then the property is not being let out at all.
See, the point here is we should be aware that there are hidden bombs. See, in Sachin Tendulkar case, if my memory is correct, the case law says the judgment was based on the documentation where Sachin had shown his intention to let out by writing repeated reminders to the broker. If, it is not like that normal, maybe. So I think he had some 3 properties in the same premises, or some 3 properties where out of that one I think he got a tenant, or 2 he got a tenant, and the documentation to prove his strong intention to let out is what saved, I think, and also the smartness of the person who argued the case.
Yes, definitely.
Yeah.
Madam, when money itself is not coming to the assessing account, how can the assessing officer claim that you have to pay the tax?
That is the magic of,
that is the magic of Section 22.
that is the magic, notional income. That is the magic of
so that's why.
Everywhere.
that is why they use the word reasonably expected, and otherwise
Real income is taxed in most of the other sections, except for a few demon sections. Whereas over here in house property income, notional income is taxed. Actually, under the 1922 Act, Section 9 was there, even self-occupied property you had to pay tax on 10% of your income. So there the constitutional validity was challenged before the Supreme Court then, before pre-independence itself. There in Bhagwan Das Jain's case, they said no, I mean like income tax can bring even deemed income also to tax. Therefore it is constitutionally valid. So that is why that this is a thing that notional income also can be taxed. So in the similar like you are saying okay, intention to let was there. Okay. There was a strange query which I got from a professional colleague where he said his client has bought a property near Yelahanka on loan. Okay, the house is in completely like ruined condition. It cannot be let out actually.
Okay.
Okay, but he wants to claim vacancy allowance for that house and also claim interest deduction.
Wow. I have intention to let out.
Yeah, I have intention to let out. But is there a capacity to let out?
So property, whether see, look at this. All conditions satisfied. There is a building, there is a land apartment to the building, there is an intention to let out also. Can I claim a vacancy allowance?
Yeah. So
I think the inherent capacity of the property to earn the rent is also one condition now. Omar, I think officer will tell that even if you want to let out, nobody will come. So he will not give vacancy allowance. Is what I am thinking. What did the court say?
So that's what. So I came across a very interesting decision for this case. It's a Calcutta High Court decision again. During the partition, West Bengal government passed a special law for requisitioning properties, large size big properties, to house refugees. So in the case of this company, Mahmudabad Properties Private Limited, they had a prominent property on some nice road over there. In 1947, they requisitioned the property, government took over possession and they housed it. In 1960s, they released the property. 1960, they released the property. And it was in ruins because for so many years it was not maintained, government also didn't maintain it, it was completely in ruins. Once they got back the property, during that time, now you have standard deduction and against loan. During those times in the 1960s, you could claim deduction against ground rent, you could claim deduction against insurance premium, deduction against maintenance. So the SST during those times claimed house property loss of about 1,60,000. So the assessing officer came, inspected the property and all of that, said there is no capacity to let out this property because nobody can stay in this property. So therefore, this is outside the ambit of Section 22. We will not allow you to set off the losses because set off of losses also there was no limit then. Now we have a 2 lakh rupee limit against other heads. So they had done this planning. Then this went up to through the various hierarchy of litigation and went up to the High Court. The High Court held that there is nowhere which says capacity to lend, right? There is a building. So expected rent, you should have done that. You should not have done the order this way. So it will allow the entire loss to be set off. That is how the court ruled. So therefore, even in this SSC's case, which the professional colleague had he can always rely on the judgment and said that I had the intention to let out really Sachin Tendulkar case and this case together and claim the interest reduction.
But if you go in that systematic way, again I'll go back to the way. Fair rent, reasonably expected rent. You can't expect a rent. That number will be 0. Actual rent received also 0. Computation will fail.
Right, I mean, it's absolutely that.
Okay. Anyway, debatable issue.
Yeah, debatable issue. That's
So,
what.
property in ruined condition. This are all simply we can think, no, like maybe how.
That's what I mean, like,
See, we should have, very. If you are practicing chartered accountants, all of us would have come to practice with the intention to appreciate the law, but because of the work pressure, we are not able to read the basic section. All of us have become form vetters. We are just seeing what is ITR criminal vartha, ITR criminal vartha, at that level we have come. So when you get some time to introspect, see, it is interesting. That way, Omar is lucky. He is indulging in litigation and reading and enjoying all the cases. Go ahead.
So, next question now. Now, apartment society, so this is like a quite common question right now because whoever is doing society audits of apartment society provides function halls at nominal rent to resident members. Whether this rental income from this function hall inside your apartment building, should you offer it to tax under income from house property?
No, I have the answer. Principle of mutuality, Chelmsford Club case.
Right, so there is Supreme Court case, right?
So apartment association, principle of mutuality. Even apartment association's IT return also only the interest income will be subject to tax. Maintenance charges is outside principle of mutuality.
Okay. So that is the answer. But also
unless you let it out to a third party.
Because then it goes out of the principle of mutuality. But there is one very interesting case now, like recent, couple of months back. I have not brought it over here, where it just happened to I am able to recall now. There is this famous Saturday Club Limited in Calcutta. Very prominent club, like how you have your bowling and Bangalore Club in Bangalore. So there are corporate members. Reliance is a corporate member over there. Reliance, what it has done is, it has gotten into a lease agreement with Saturday Club Limited, asking, taken a portion of it, taken the portion of the club's premises for whatever it's this thing, for its own use. That's how it is. Now the club has not offered that in comfort tax, whatever lease rental it is receiving. Saying principle of mutuality, I am getting it from a member.
But member is making money.
Yeah, member is making money. So that assessing officer has disallowed it, saying no principle of mutuality, but it's gotten remanded again back to the IT80, going into other facts and all of that.
No, I
so
think
there is
what
no
you
finality,
say,
but
what is it? Let us say what.
my duty to arouse your curiosity, I wanted to present this as well.
Yeah. What is your
What is our
view?
correct
You are an income tax officer. How can he deny principle of mutuality just because the person who took it on, he is one of the club members. He is making money.
So the assessing officers saying is that you have not taken it as a member, you have not taken this property as a member, you have taken it as a tenant. That is why it's allowed, but then it's got remanded. There is no finality to this case.
So, if this function hall or shop is rented to a non-member, then it is.
It's income from house property.
House property.
Yes.
It looks like the intention itself is to avoid a tax.
Yes.
So obviously the assessing officer may say, okay, the intention is not correct, so you have to pay tax.
Maybe they can rely on that Bangalore club judgment where SBI was a corporate member, they deposited funds into it, they were earning interest income, they claimed exemption on principle of mutuality. So maybe that's what it would achieve. But there's no finality on the
For
decision.
own personal purpose of resident member, then okay, it is agreed as a mutuality. But he is doing a business from there, no? So that could be.
So Lada, if you see, even if this thing what bowling club, when I go for meetings recently, bowling is a UNESCO World Heritage Site because it's a very old property. Apparently, even if you have to change one brick or a window, you have to call people from you and take a license. They will come specifically for inspection. Only in front of them you can do these changes, right? Because it's a UNESCO World Heritage Site. So there also you will see there are corporate members, they have done up the bar, the library and all of that, and they have that exclusivity to retail their liquor itself. So is it income from house property for them when they get this like lease rentals, or is it still mutuality?
I don't think income from house property alla, because they are not the owners. When the business are also.
No, for bowling club, because bowling club is getting deposits from its corporate members, and those corporate members are doing business.
What does the bylaws say? Maybe reading that would make throws more light.
True, I mean that's what it comes to question.
Give a lot more clarity of what they actually mean, intention for corporate memberships. Because as a member, even if I'm not the corporate member, as an individual, if I go to my member club, I can still use it, have events, whatever it is. So I also can go and do events, not just a corporate person. So when you're comparing a corporate and an individual,
that's a good point actually. It's a good point.
Housing society, they are registered under Cooperative Society Act. If they deposit money in Cooperative Society, whether ATP exemptions are
To the cooperative society, is it?
association.
No sir,
They
no.
registered under Cooperative Society
Society Act.
Okay. And they are kept deposit.
ATP is only for a cooperative credit society, because even that is also a recently litigated issue, right? Where member, then that Titan member and all of that was litigated for Bangalore ITAT, and recently itself, where they said ATP is eligible for both Saharda Saukari. There are two types of cooperative societies now. There is that cooperative society per se, and then there is this Saharda. So for both of them, ATP is there, but only for a credit society. So now next question, ma'am. Again, this is also like this is quite a prevalent practice where all these community trusts, they have community trust. Like there will be some community like XYZ community trust, right? They have these marriage chowdhury halls. They let it out. They let it out and they say that this is we are doing charitable activity. We are providing this marriage hall at a nominal rent to our community members. Therefore, it is an object of general public utility. We will they are claiming exemption under section 11.
So whether question is okay, first this charitable trust has section 11 exemption. They will get section 11 exemption only if they fall within their activity fall within the definition of charitable purpose under 2 subsection 15, and they enjoy section 11 exemption. And so the point is charitable trust is earning revenue by letting out the marriage hall.
Yes.
So whether that letting out will fall within the definition of charitable purpose is question number 1. And now whether that rent itself will be computed separately.
Yes.
Okay, I will tell. To my mind, section 11 entities, the method of computation, it is a deeming. Again, the whole section 11 is another deeming fiction where it doesn't follow the regular method of computation. The mandate for that entities, for those who are not aware of the provisions, any organization which their activity fall within the definition of charitable purpose under section 2 subsection 15 are eligible for exemption under section 11. Now the mandate for them to enjoy income tax exemption is out of the gross receipts, 85% they have to spend in the year of receipt, or they can accumulate by filing specific forms. So the question which Omar is posing is whether that gross receipt, now gross receipt if you take in the balance sheet, bank statement includes this rental income, because this particular trust has a marriage hall which is letting out and gross receipt. So to my mind, you don't have to give a separate status for that rental income. That also forms part of gross receipt along with the donations or grant or whatever it is. Rental income also comes. There that the individual heads of income loses its status separately.
Yeah.
Gross receipt apply 15 less 85%. Only mandate is it should have been utilized for charitable purpose. I don't think you have to nitpick and tell that this is rental income, this even interest income for that matter. Corpus interest what they earn, they don't consider under other sources. That is my view.
Whether this is treated as commercial activity and whether 20% of slab is that will apply.
So yes, that point is if they are they have charitable purpose have it is outside any object of general public utility, there is a cap of 20%. So Once it crosses 20%, then it will not, that section 11 is out. That time that officer can say I will put it under house property. That's a good point. The mandate is like if you are under that 7 links of charitable purpose, if you are under any object of general public utility, you have another rider. That proviso says that your gross receipt which are in the nature of commercial activity. Commercial means quid pro quo, like a service agreement or you are getting something. There is a service agreement, quid pro quo arrangement. Then up to 20% of the gross receipt you have a cap. They still consider you as a charitable organization. If you are crossing that, yes, there is a chance that officer will assess it under house property.
Right. So
even though they are charging it not a nominal rent, a regular rent. And in other halls where whatever they are charging, this trust also charging. Even if it falls less than 20%, then also it will be exempted.
Yeah. So that 20% is arithmetic.
Arithmetic.
Yeah. Even if nominal rent, suppose the so-called nominal crosses 20% of your gross receipt, you will be outside.
This is a case of any other object.
Yes, only that. When you are under specific limb, for example, you are in preservation of environment or you are yoga.
In this case, even in the community itself, it is only for the community of a particular community. Then it is comes under any other object of general public.
So there, that when you say community, see the assumption based on which I answered is general public is the beneficiary. If you have identified only one particular community is beneficiary, then it may not be public.
No, the bylaws will say it is a public district, charitable trust. It is
actually one of the
normally
conditions
they rent it out only for a community folks. Right?
Actually, one of the conditions for section 11 exemption is it should not be any caste, creed, or it should be. So within that, what they do is another question.
Right. So this is, if you look at this thing, charitable institution itself, they are under a microscope now. After they are asking you to go for renewal of registration, Form 10A filings, all of those are going on right now. And then there are these 2 recent Supreme Court judgments, Ahmedabad Urban Development Corporation, Noble Education Society. So in a similar league, over here in this, this is a very famous chowdhury on near Ashoka Pillar, Kucharam Charities, right? Where the assessing officer has said what you are doing is not a charitable activity. You are charging substantial amounts of rent. We will not allow you exemption from section 11 in income from house property, and they have assessed it. And this has been upheld even by the Bangalore Tribunal.
So that he didn't take that section 11 computation, is it?
No, they have taken, that's what they have gone under section 11, but they have said no, you are outside the ambit of section 11 itself because you are charging substantial amount of rent favorable to the revenue.
So the 20% did not work in this case.
Not at 20%, they're just like, they've
they would have exceeded 20%, or under whether they also would have gone under general public, or maybe they would have put as relief of the poor.
Relief of the poor.
We don't know. Should read that case now.
Court award, so in this case, ma'am, normally the use took us in detail on arrears of rent and unrealized rent, right? That is when arrears of rent is like you disputed rent was going on, they said no, you increase it, but the rent agreement was still in subsistence, and after that you realize some rent, right? Arrears, if the rent was revised on a retroactive or retrospective basis, and unrealized renters, rental deed was still active, and rent was still alive, but the non-payment of rent was there, and you have taken certain whatever the listed action. But there are many situations where rental agreement has also expired, right? There is no rental agreement subsisting, but the tenant, it is very hard to vacate them. They are still in possession. What happens in such a situation where court awards you damages along with eviction? You go for eviction to the court to file an eviction suit, and after that court also awards you damages. Whether it's a capital receipt or is it still income from house property?
The damages.
Yes.
And you want me to tax on that damages? Already I am a victim. No, it is a capital receipt.
It's a capital receipt.
Is it? Did they tell that?
So in that's right. In Narang Overseas Private Limited, what happened is in this case there is a Supreme Court judgment of P. Mariappa Gondar, where the issue in question was the assessing officer had taxed the damages received in the year in which the lease got over. So for example, it got over 5 years back. So he had gone back 5 years and then taxed that receipt. So there the assessee went up to the Supreme Court and said no, it is taxable in the year of receipt. it's taxable in year of receipt. So the Supreme Court said yes, it's taxable in year of receipt. There will not be an assessment order. So they will not argue further, right? Once you get a favorable order on whatever point, whatever grounds, you are happy with that. But then it will set a precedent. So what the assessing officer said is, okay, because of the orbital dicta emerging from Maria Papi Gounder that damages received are taxable in the year of receipt, we will tax you in the year of receipt in the case of Narang Overseas. So these guys, PSC guys, they've gone and fought and said in Maria Papi Gounder the question was what? The question was year of taxability, but they've never gone into the question of nature of receipt itself. Now I am questioning the nature of receipt. So the tribunal set up a special bench, and then the special bench decided that it is for the damages to the capital, right? For the injury caused you are getting something. It is not a return from the capital. Therefore,
not the exploitation of the property.
Not enjoyment or exploitation both. It is not a yield from the property but damage to the capital, right? Therefore, it is a capital receipt and not taxable.
So see here the principles, how to, this case will help not only for house property. If sometimes we will have a situation where the receipt is a revenue receipt or a capital receipt. The same case law, if you read, they would have done a detailed analysis as to what can be capital, what can be revenue. No? Have they done that in this? Maybe
Yes, they have done that, that's what. So if you look at the...
So one case law may not be answering only for...
In this case, only for the damages, they told that it is a capital receipt and it is not taxable.
That is the specific question for this case law. Now what is a capital receipt, what is a revenue receipt, they would have discussed it.
They would have discussed it. What I was thinking, for years together, for example, this Chennai Port Customs Authority, they will not pay any rent for years together. Say for example, after 10 years or 15 years, they get a lump sum amount, then that is also taxable, right? Under this.
But was there a lease agreement subsisting during that time?
Yeah. Is there? Agreement is there.
Once the agreement is there, then it is like the renter is over here. In this case, there is no agreement itself, right? And still they are in unlawful possession. So this was the first limb of section 20, charging section, annual value. These are the questions relating to the first limb. Now when you go to the second limb,
sorry. Here actually there is no damage for my property just because my agreement got expired and they were in. My property is in their possession. Because of that, I received damages.
Damages is a very legal term, right? Like for example, somebody is recent that ITC Delhi High Court judgment ITC, where this model went for a haircut and she said she wanted this specific kind of haircut. The person, he didn't do that kind of haircut. That is why she was hurt emotionally. Therefore, damage is awarded over 1 crore rupees. Right?
And it is exempt.
It is exempt.
Why?
Because capital receipt damage is listed.
So just to avoid the tax, say for example, I will give a rent to my tenant, rent my property, and agreement will be for 11 months. For 5 years he will be, and I will put in a case on him. On 5th year he will give money, so that it will be damages, and keeping this case law I can avoid the tax.
It will be unrealized rent. It will be taxed in the year of receipt. How will you prove this?
But how will you damages, madam? Wait, how are you sure that SSC will actually pay after 5 years?
No, because of
that is the arrangement.
That is the arrangement.
But after 5 years, if it is a substantial amount, nobody will take that risk, right? A normal human being.
No, if it all.
Then it's looks like planning. Next. So the next limb of the charging section is we've covered annual value. Next limb is property should consist of any building or land appurtenant thereto. So here, one query which I received is all these wedding venues these days. So there is wedding venues in the outskirts where there will be a small house, whatever, an ancillary unit, not even capable of living, shed sort of thing, and there will be a huge lawn. Because of that, you are receiving good rental income. It becomes a party venue. Even if you look at palace grounds also, right? Palace is only the backdrop. Otherwise, lot of rental income to the king's family, right? Because of those wedding this thing. Now, because there is land appurtenant there to say houses of 1,000 square feet, whereas apartment land is 1 acre, 44,400 square feet. Then is it income from house property when I let out these wedding venues, or is it income from other sources? Because if it is income from house property, I get a standard deduction of 30%. It is very advantageous to me.
So actually, if you go strictly by definition, yes, okay, now I'll tell you, annual value of a building and land appertaining thereto. So the intention is that building is the thing which should be earning the revenue, like because you see income from house property.
Yes.
House property. Did you use the word income from property? No, Omar.
Yeah.
House property means the star is the building.
Correct.
In this case, the rental income is measured on account of the land. I don't think somebody will go into the building at all. So
Right.
I think it is income from other sources.
So-
Any other view? Actually, this question is supposed to be to the audience, and audience should be answering the question.
House property, we would not have taken a vacant land. So in my view, it is income from house property.
So here is the thing, the officer will be more interested to put it under other sources. Your challenge will be to prove that the
Officer will go through the wedding venue photos.
Yeah.
Nobody is going to wedding. Everybody
The
knows that.
difference between a marriage hall and between a palace grounds, why you chose to go to a palace grounds? Because it is outdoor. So
No,
that
had it
attraction
been that
is
small
there.
house is not there, I will not go, no, madam. Had it been that small room or something, it is not there, I will not take rent.
No, I will
But
go
the
to-
purpose is for.
So you have to defend yourself, that's what. So if you look at the legal
So the
research,
idea is to you prepare all of you to defend the income
Defend.
tax officer.
and arouse your curiosity.
But there is no regularity, no, it is not monthly income, not that.
No, even Chowdhury, right?
Actually,
Chowdhury,
they
if
never
I have a
regularity.
wedding hall,
Ah.
if I let it out, it's income from house property. If I had constructed it,
Then I will go as per the definition itself, it is a house property income. Why I should go for the other source?
no, if it was a normal structure over here, this is an outdoor wedding venue.
Okay, but definition of house property says this is.
Yeah, so this is a
Immediate
possible
vicinity of
threat.
land.
I mean, possible challenge. The income tax officer will try to tell you it is not house property.
It's income from letting out of
That's the
land.
whole idea. He will tell predominantly the revenue earner is the land, not the building is what he will try to establish, because he doesn't want to give you the 30% standard deduction and all those.
You had a question.
But under section 56, yes, sorry.
What if we put it under business income? Then it's more beneficial.
To the assessee. So
Now, for example, what is the SSC not maintain any staff, no expense?
he will not allow you to put it under business. He will tell it is income from vacant land.
I have only one security person.
I have to maintain the
Okay, yeah, right. But what is my expense? If I put it under business income, what is my expense? For example, if I'm earning a revenue of 1 crore from letting it out, letting out this venue, and I have one security person and one guy to mow the lawn. Hardly 20,000 rupees is my expenditure monthly. Whereas over there, I would have got 30% deduction.
Then I'll show some subcontracting. No, I put up a mandap, I got.
No, that is your tax planning. But what is
Actual.
Between
easier way?
Straight simpliciter, it is beneficial to push it under house property.
So if he does house property and he makes a temporary arrangement of those tents and all, will that be considered as a building?
No, not temporary. Not temporary. It has to be a structure. No, yeah. It has to be a
No,
structure.
nowadays what is that? Those metal houses are coming up.
No, it's still a structure, right? Metal houses are still this thing. You still take a building license. You still take a building license for all
will not
those.
be considered as a
All those container box houses, right? You still have to take permission from the village authorities or from the municipal authorities. You will have certain this thing, right? Permanence to that structure.
For that also.
Yes, yes. There are
So that's
regulations
some
for that
case
also.
laws where they have defined building, you may have to read. What is building? No, seriously. What is a building?
No, there are laws for everything, right? Like for example, recently I was reading that for generators which you have in your house or whatever, you have to file a return saying how much electricity you have generated.
To whom?
To the KEB, but nobody does that. So that is how, like, law is very wide.
Not KEB, electrical.
To answer your.
Sorry, sir.
Not KEB, electrical inspectorate.
That's what.
Okay.
No, no, no.
Inspectorate.
It's an officer.
Yeah.
No, in your case, even if they considered as income from house property, there also you can claim deduction under section 57.
Sorry, in your case means which case? Palace ground case?
This you said no in your.
If it's considered as income under 56, income you can claim deduction under 57, but it's not beneficial. You want the standard
But the
deduction.
problem with the section 56, no, you can never have a loss under 56. This is one thing always I have. See, you have to incur an expense to earn a revenue. Have you ever come across a situation where expenses under section 57 exceeds income from 56? Loss from income from other sources, there is no discussion on loss from income from other sources because it is a passive income. But in house property or business, I can have a loss. I can always show my expenses was more than the revenue. But that we don't have in, and also section 56, 57 is very clear where they say you have to incur the expense to earn the revenue. That maybe perhaps we will be able to establish. But I think income from other sources, there is no loss in it.
No, there is.
That is another matter of fact. You can ask that the person who handles income from other sources.
So now, coming back to the legal research on this issue.
Lots actually.
So,
move a little faster.
land or building appurtenant thereto, same term is appearing in section 54. So there is an Andhra Pradesh High Court ruling in terms of section 54, where Ms. Srimati Zaidunisa Begum, she was a Nizam's relative. She had a house, small house on a 5-acre land in a prime locality in Hyderabad. She sold that for a vast amount and claimed the entire sale proceeds at deduction under section 54. The assessing officer said, no, we will only allow you to the proportion of the house, whatever, like say 10% of the land was covered by the house. We will allow you only for that 10% as sale proceeds from house property. For that we will allow the deduction. For the remainder, we will not allow you the benefit of section 54. Then this matter went up to the High Court. The High Court then had seen what land building appurtenant thereto means. So the High Court has said building or land appurtenant thereto means land which is required for enjoyment of the building, like parking space, there is driveway, all of those things. Whereas if there is land which can be put to independent use, you can do farming, it is so vast, you can do anything you want in those land, then that is not land appurtenant thereto. So that way, I mean, like if you have clients who come up to you and say, okay, there is a vast property they are going to sell, one money cut video, then you can claim deduction. So you have to be careful about that.
The 54 and 54 of one is only for building, other is for land. So any property other than.
What about a person has a house property with big land, but he sells part of the land?
Part of the land.
Yeah.
Then.
So in the sale deed scheduled premises, they have mentioned only land means only 54. If 54F can work, 54 will not come. You have to see the sale deed. There has to be a mention of the building. That is why sometimes some creative planning land may be another shedditta. Then unless it comes appearance, it appears in the sale deed. No, income tax officer will not consider 54.
Now they are asking for electricity charges. All of those they are asking.
So you have to tell the client to approach you before sale. This is the point you have to see when they send you draft sale deed for waiting.
So we're still in section 22 itself. Though it seemed like a simple section, we have discussed for almost an hour now, and still we are in the third lane. We are going to the third lane. So tax is based on annual value on property, which is a building or land appurtenant thereto, and assessing must be the owner of the property. For this owner of the property also, there are certain questions we were able to identify. So here, the SSC entered into a purchase agreement and paid entire purchase consideration and took possession of the flat. But for whatever reason, he didn't register it. Now he let out the flat also. Is rental income earned from such flat income from house property or income from other sources? Because he is actually not the legal owner. He's taken possession, he's paid the entire purchase consideration, agreement is there, but no registered sale deed. In Khata, still his name is not appearing, it's still the builder's name.
Deemed owner concept.
Deemed owner is for what? Money for this thing, right? Spouse.
No.
One of the conditions is all the intention, all the major activities in the process of sale has completed pending for registration.
Yes.
So he is considered as a deemed owner. The buyer is considered as a deemed owner is one of the points which I came across when we read section 27. So complying with that, it should be house property is my view. He is a deemed owner of the house property. Any other view is
No, that's not. So similar, not deemed owner, they have looked at beneficial ownership, right? So in this case law, Poddar Cement, again a Supreme Court decision, what the SEC had done is, this property was located on a very famous road, one of the India's most expensive houses is located on this road. This is Dundal's Napier Sea Road, where he had bought the house in 2011 for 400 crores. So they bought 4 flats in a building. That is how he bought it. Is he had entered into a rental agreement, into a sale agreement with the builder, where the entire purchase consideration take position for 2 flats. Another 2 flats were bought by a sister concern of Poddar Cements. And then from the sister concern, again the same mechanism. Pay the get into a sale agreement, pay the entire purchase consideration, but don't register it. And then use this, get out of the head under income from house property, because they were using it for their own personal purposes or whatever it is. They didn't want to pay income tax on income from house property, right? They wanted to do that kind of planning maybe. That is why, because even the expected rent on those roads, those kind of locations is very high. So because I'm not owner at all, this is my business asset, I have not yet registered, no income from house property. But then the Supreme Court said, no, nothing doing, you are a beneficial owner, you have position, therefore you will have to pay tax on annual value.
So these, just 1 minute, this concept of beneficial ownership, no. There is no beneficial owner. I don't think beneficial owner is given under the income tax.
No, there is no
beneficial. That beneficial owner concept comes in tax treaties. Tax treaties. But that beneficial ownership concept is applied for assessment in the context of maybe REIT, he will tell. Many places, so these case laws, no, don't read only for this. Beneficial owner, how the court views who is a beneficial owner, this will be very helpful.
Next, again, this was a very interesting query. I don't have an answer to this. So, in this case, this professional colleague's client is situated in Pune, and he already has 2 houses. His father, who is aging, his father and mother who are aging, his father inherited a property. He's inherited a property. He wants to gift it right now itself, because later on, if not there, fathers, brothers, children, all those, there will be disputes. So he wants to gift it, keep it clear. Gift it right now, but retain life interest. That until he is alive, he will be in possession and he will enjoy the property. Right? But it's gifted to his son. Now, because his son has become owner of 3 properties, does this property become a deemed let out property?
Though, yes, of the son. For the son.
Yes, for the son. Because even though he can't enjoy the property, there is life interest still with his parents. It's a unique situation, but I think it's quite common now. Like, with an aging society, we have all the succession issues. So it's a pertinent question.
So in this case, he is not a spouse. For a spouse, the transfer or inadequate consideration, everything will come. So from parent to son, it came. Already ownership transferred. Transferred. Whether parent is living or any other is living, definitely it is going to be charged under income from house property.
So in this case, you want to explain?
No,
so in this case, it is gifted. So it is a transfer. Yes, as you told, there is no spouse problem. Here the issue is different.
Life interest rate.
Now, first thing is the son already has 3 properties.
Yes.
Now this is the 4th property for the son. Father is retaining the life interest. Father has the right of possession. Any rent, supposing future the property gets let out, the rental income, who will enjoy? The father will enjoy. Only in registered paper the son is an owner, he becomes an absolute owner. So here the concept of registered owner versus absolute owner we want to bring in. He is only a registered owner, he is not an absolute owner in that sense. So the 4th property, since father has retained life interest, the officer cannot insist to declare as DLOP for the son. Because son is already having 3 properties. The officer may try to tell that son has 3 properties, this is the 4th property, please declare deemed let out income. So the point of difference is the father is having the life interest, he has nothing he can do till the father is alive. So that concept is, we wanted to drive, correct Amar? One more, I will take it to the next level, the same problem. Now there are 2 sons, let us assume there are 2 sons. Now father gifted the property to the first son and retaining the life interest. But in the gift deed he will tell that I will retain the life interest till we are alive, till I am alive. If at all in future you let out this property, the rental income will go to second son. Let us assume second son is a student or he is a maybe physically challenged or whatever. He writes saying that to protect the interest of the second son, I am gifting the property to you, but rental income if any in future will always go. So there what happened? Father has life interest. Son has registered owner. The second son became the beneficial owner of the income. Now, according to whose income that rental income will be taxed, whether in the hands of the father, whether in the hands of the first son who is only the registered owner of the, he has nothing, he is only in paper. Okay, he has no, see, I will tell you what question you have to ask. If the property has to be sold, whether the son can take a decision, no. The father has to say yes. So it is only a paper.
I think both should say yes, madam.
Both means father
and son.
Now depends on how you draft your gift deed. Okay, see, father has to write. Now only son cannot, so he is not an absolute owner. Now another thing is that the second son is in place, so income tax officer will say it is income from house property in the hands of the second son. There the question can come, he is not an owner, he is only getting the rent, he doesn't have registered ownership, he is understood. These are the complexities. No judicial precedent, no? Maybe
no judicial precedent.
You can create a judicial precedent.
But I think Poddar Cements will still hold good
of
beneficial ownership.
Right. So that's what that word owner, when we read, we never get a doubt, right?
So next is...
It is like a atom bomb, that section 22 charging section. Every word is a debatable point. Annual value is debatable, ownership is debatable, property itself is debatable. Please go ahead.
The next slide is on REITs, right? Again, continue with beneficial ownership. We have brought this slide on REITs because the scheme of taxation is, I think everybody will be aware of it, that rental income, that it enjoys pass-through status. Only thing is, as the real estate industry grows, REITs is going to become very popular. India is one of the first REITs is also from Bangalore, Manyata Tech Park, which we popularly known as Embassy REIT, which is one of the first successful REITs from Bangalore, from India itself, right? And now, if you go online, if you check everywhere, whenever you go online, you keep getting this advertisement, prop share, you can own so many square feet in this commercial building and all of that. This, SEBI want to regulate it. So for REITs, right now the minimum corpus is 500 crores. They have already issued a draft law, SEBI already issued a draft law in April 24 for bringing down this corpus amount from 500 crores to 25 crores. So then REIT will become a very popular vehicle. So as professionals, it's our duty to be aware about this also, I mean, the mechanism of REIT, because this will become commonplace going forward. Next, in this case, this question is, land is obtained on lease for 10 years. The SEC is putting a permanent structure on top of it. And he's letting it out to a school, somewhere in the outskirts of Bellary. I think this is also a practical question, right? So, since the SEC is not the owner of the leased land, the structure which he's putting up and renting it out, he's not doing anything, he's just putting up the structure, he knows somebody there taking it out on lease for the school purposes. The rent which he's going to earn, is it income from other sources or is it income from house property?
For the lessee.
For the, yes, for the lessee who will in turn further sublet it.
So first
other sources.
Huh? Because of ownership, right? Because he does not enjoy the ownership of the land, can he become the owner of the structure?
He is a beneficial owner. Beneficial owner of the structure.
Okay.
For example, say husband has a vacant land and that wife has constructed a house and she is earning the rental income. So she should be showing the house property.
That's a great answer, actually.
So it's like a dual ownership.
So in India, the courts recognize the concept of dual ownership. That is, land can be owned by somebody else and building can be owned by somebody else. This, though it's not an income tax case, it's come out beautifully in this case where there were 3 brothers, right? They all owned the land jointly. So the third brother gave the first 2 brothers permission to construct a house on top of this. You guys live, right? Later on, after like passage of time or whatever it is, he said that land belongs to me also, so I also have a share in this house. So give me a share in this house. And this went up to the courts, right through the existing like civil courts and all of that. It went up to the High Court. The High Court said, no doubt the land is yours, but you've given permission to build structure and they've expended their funds. So that's what in India there's a concept of dual ownership. Land might be yours, but structure is not yours. So therefore you have no share in that house until the structure subsists. So that way that dual ownership concept is there, and so it will be chargeable under income from house property in this example because of dual ownership concept. Now we have finished owner. Now the last slip. Exclude portion of property occupied by the owner for the purpose of own business. This I think you have covered, ma'am, because the partnership firm belonging to the existing. At least in Karnataka, partnership property will not distinguish. If say client comes to you, I own a property, me and my friend will start a cafe, we'll start a cafe over there. I don't pay the rent and all that because me and my friend it's my own property. Then it won't fall under the self-occupied property. I mean, I'm using for own purpose, business purposes, because CIT versus K. Guruswamy Karnataka High Court judgment is there, where it says firm and the owner will be always separate. Next, in this question, there's a building owned by a parent company. It is allowing its subsidiary to use the building, some floors. Right? Is it for its own purpose? Because subsidiary also is this, right? If subsidiary does well, it is beneficial to you.
Partner and firm only, partnership in firm are separated, then subsidiary and holding company will be definitely be separate now.
That's the right answer. So CIT versus TV Sundaram Iyengar and Sons, Madras High Court judgment, where they let out a portion of their building to the subsidiary company without any rent. So even in GST also you will have to charge rent. That is how it is, right? If you look at the Shanmugam AR ruling. So we have covered annual value. Now annual value of self-occupied property is the second. So the first limb of section 23(1) we covered in with 22 itself, right? All the queries. So for 23(2) also there are certain interesting queries. So here Mr. X owns a residential house R. He lets out that house on rent to A Private Limited, where Mr. X is a director. Okay, and that company, that private limited company in turn allows Mr. X to stay in that house which he owns without any rent. Now this rental income which he is getting from A Private Limited, is it outside the ambit of taxation itself because of the exemption for self-occupied property? Because it's my own property, I am occupying it, right? But I am also getting rent for that.
So I am getting rent in a nature of owner, but I am enjoying the property in the nature of direct employment.
Right.
So these two are different now. So I will be charging under income from rent, house property.
And that's what I mean, like the same situation. So in Sundarai versus CIT, Andhra Pradesh High Court, they have done this tax planning, but the courts have held that you are not occupying it as a owner. You are occupying it as a status of a tenant. Therefore, it is. In this query, Mr. X owns a residential house R. House R is settled into a trust where Mr. X is a beneficiary. Mr. X and family continue to live in that house. Right now, trust has become a very popular tool for succession. So this is a quite common situation where you settle all your properties into a trust within the house, and then you can. So if I am settling my house into a trust and I become a beneficiary of the trust and continue to live in that house, will I enjoy that self-occupied property exemption?
No, because
Because
Trust is the owner.
trust is the owner. Any other
You understood the
answers?
list? I think somebody should repeat the list.
So, question is, I have a property. I bequeath it to a trust.
A private trust.
A private trust. In which
That's very
I and
important.
my family member are the beneficiaries. And we continue to live in that house. I do that because maybe the house has a very high value and I wanted to continue to remain in the existing family. So, this is a great succession tool. Therefore, I've done that. Now, because trust becomes the owner of the property, does it mean that there is no benefit of self-occupied property?
Because there is a private trust, no?
Yeah.
Irrevocable or-
Irrevocable.
So who is the owner here?
Trust is the owner.
Trust is the owner.
Registration happened, right?
Yes. Yeah, that's what.
There is no doubt on that. All of us agree on that. Trust is the owner. But trust is not earning any income. Whatever income comes, it will pass on to the beneficiary. In trust return, that rental
No, but over here, because say in this example, there is no income in the trust. There is no income in the trust because I am itself saying I am not paying any rent to the trust. But can annual value be computed and can assessing officer bring it to tax?
Trust cannot self-occupy. Artificial persons only. Other than natural persons cannot self-occupy.
Right, I mean that's also.
Yeah, that was one of the
That's a
things.
case law, right? There's a case law on that.
I was wondering in what situation a fictional entity can own a property. I think that's the answer. Beautiful.
So, but
company
this
owns a
question-
property, no, madam. The artificial person company, it owns a property.
It owns the property, but it can never do this thing, right? It can't live in it. Only natural persons can live in it.
Same way.
So for self-occupied property, it is only for individual or this
So
thing.
in a
not
company's
private.
return, you cannot have SOP. 23(2), no? Self-occupation.
Yes.
Uh-huh.
So this question came up before the Bombay
Family
High
value
Court
will can never happen in a company return.
in 1948 in the erstwhile section 9. There they have said, that's what, again, like how in Podas even beneficial ownership and all of that. So you are a beneficiary of the trust and you are living over there. We will allow you that self-occupied property, it's an exemption.
But that they didn't give for
But
the
that was in
direct-
erstwhile section 9. Right?
That's 12, hold on.
Old section, no, that is.
Now
that
the
is-
principles are similar to the director letting out the property to the company and he himself occupying. That
But
will not
yes,
work.
that's what.
Principle.
Yes, exactly. That's
Maybe here on natural grounds, see, even as a family I own, it is a self-occupied for me. And even a trust owns, it is a private trust. Maybe on natural justice they give, I think so.
But you are occupying the property in the capacity as a tenant, Allah.
No, the trust is allowing you to stay, right? Because I only created the trust. My lawyer told me to do it, but I didn't think about the tax implications. So, I mean, it's a dicey question, right? This is one supporting case, but this is the only jurisprudence we could.
Suppose this was let out.
It would have no trust income.
Who will declare the rental income?
Trust. At MMR, if it is indeterminate trust at state.
So
whatever rate.
if rental income you are saying it will be taxed in the hands of the trust, then how can you say the beneficiaries of it? See, the person who gets the rent only can only also self-occupy.
Right. So that's what, maybe that is why, because this is section 9 in the 12 section.
Private trust, will it not be passed through? Will not be the rental income be taxed in the hands of the beneficiary? But the trust will return the.
No, you can choose both, right? Section 164.
I think that is the answer, no? I don't know. If the rent is a pass-through entity, then I agree I will give you the benefit of self-occupation. If rental income comes, you will declare the
It is
rental
my
income.
choice, right? It is my choice whether I want to make it a pass-through or this is which will determine the trust.
Sir, at least you can't straight away give the answer.
HUF also, yeah, same thing. There's the case law which says even for HUF, I think we've covered HUF also. The decision, Hari Prasad, Bhoj Nagarwala, 2012 judgment.
That buy harm by some case.
By is the section 9(1). That time, that's why. Now in this case, Mr. X is a owner of R1 and R2, two residences. One house he is staying self-occupied. Another house I can have two self-occupied properties. In another house I am letting my cousin's family stay rent-free. Are both SOP.
use or?
I'm sorry, what?
It should not be vacant. No, officially tax be vacant.
It's not collecting any rent, right?
They are not collecting any
It's not
rent.
collecting any rent. There is an intention to rent the property. So there is option for two also.
Give it on.
So no, if you look at section 23, what it says for self-occupied property, it says only if it's self-occupied, it is there is value is nil. If it is vacant because you could not occupy it, we have also discussed a case law, it is vacant because you could not occupy it for some other extraneous conditions, only then again this thing will be nil. If you are staying in the same city somewhere else and you leave this vacant, then we can still compute annual value. Therefore, there is a Bangalore Tribunal judgment in the case of Ziaullah Sharif, where the SSC he was living with his daughter and he let his adult son live over here in his house. So there was a search in this case in the course of assessment, they taxed the annual value of this house also because he was not living over there. So you have to be like, for example, if you have two houses, you still show that you are living in both the places to enjoy that SOP deduction.
Now tenant will ask you, I'm sorry owner, if I weekly once visit, will it help? Sorry.
Yeah, I mean that's what, as long as you show that
So
I am living.
that be ready for such questions. Don't think this question is too far. It is waiting for you when the July starts.
Now, how about our parents are staying in one house?
So that's what you should say, that it's available to me also once in a while I go live over there. I mean it rarely happens, right? Because in the Ziaullah Sharif case or whatever it is, there was a search. That is when these matters came up.
If there's another property which is litigated and we can't stay there,
Well, still they can do a protective assessment, right? The assessing officer has the power to do protective assessment.
so what happens in that case?
They will compute annual value and they will say it doesn't matter because there are several case laws where there is litigated property. They still computed the annual value and they have taxed you. The section is not, it does not say that just because you have litigation or whatever it is.
No, because I can't let down because it's litigated. It's not.
That's what the assessing officer has all the powers to do it. Only thing is you have to litigate it, that you are imposing an impossibility on me. Those are the things you can bring to consideration. This you have covered this example. I think in the previous slide.
Singapore, US, India.
So next, so we have covered section 22 and 23. Let's go to section 24. 24 is the deduction section. So let's see what questions I have over here. Okay, so this is a good, interesting question which I came across. So you are three people, right? Three people come together. They decide that we have surplus capital. Let's build a property and let it out. There are three partners. You let it out. Come together, you build a house property and you let it out. And the firm is paying interest on capital. Okay? To the partners. And that capital was used to construct this house property. So can I claim reduction under section 24B against this interest which I am paying to the partners?
On capital.
On the capital as
capital is
interest on loan. So you have borrowed some money.
Yes.
Interest on borrowing is allowed as a deduction. Whether this capital which, so for example, if the partner himself have given loan to the firm or whatever it is, right?
So the form how partners give is important. Here the partner give as a capital but not as a loan.
Okay.
Maybe that differentiates here. Hence it will not be allowed as a
Capital is not a loan.
capital.
No, I think so.
So in this case, in CIT versus
I am very sure they will never agree.
CIT versus Sen and Doshi Enterprises, Bombay High Court this judgment. What they have done is they have allowed against the interest paid on against capital. They have allowed deduction under section 24B.
Oh. They considered capital as loan.
Yes. Loan.
But here there is a bomb, I will tell you.
So
they
but there is
considered capital as a loan. No, now they will invoke 269 SS. More than 20,000.
If you are given cash, what if they have done it through banking channel?
Banking channel, no problem. I don't think when we check applicability of 216 SS, we ever check capital account.
Right. No, but it's I think even for capital account it is applicable. If you look at this thing after 269 ST is come, when you look at it, there is no such exemption given for this thing, right?
So, but there is an SLP which has been admitted by the Supreme Court against this judgment. So only for maybe for them it is operational, for everybody else it is still not operational, this judgment. Because once an SLP gets admitted, then the judgment is at par. Only for the SSC for whom the ruling is there, it is still effective.
Okay, wherever SLP is admitted.
The next question. Can a private limited company SSC claim both depreciation and standard deduction under section 24?
Yes.
Any other answers? Like
yes, it is a fixed asset for me. I will claim it
This is under
depreciation.
income and house property we are discussing.
It is a fixed asset, madam, for me.
no, so I build a house, right? In my computation, what I will do, I will claim depreciation loss as well. Okay, and I will also show under house property income for the same asset, what the rental which I have received, I will take standard deduction as well.
Oh, business nature, okay. Business activity. There is no
And,
business
right,
activity.
and depreciation loss is like water, right? You can mix with anything. So you can set it off against this income.
Both. Actually, here what I feel, no depreciation when I can claim, if it is a business activity, I can claim a expense, no. But here, whatever I am earning from that property, it is my income from house property, not from business activity, no. So that's why I cannot claim a depreciation. I think.
So here no depreciation actually, okay, can I have a situation where in my P&L account zero income
Yes, ma'am.
and only depreciation as an expenditure, can I claim? Because depreciation is an allowance, no? Reflex of time.
No, but business, if a company has a house property, where it will show other than fixed assets?
That's what. It will show as fixed
It's
asset.
under fixed assets in the company balance sheet. Business, the company has let out the building on rent. The rental income is coming. The company will declare under income from house property. Rental income less 30% standard deduction reported income from house property. Now,
It will also
can
claim
I
depreciation.
claim depreciation also under section 32 on the building? I have income from business zero, less depreciation under income tax asset. Can I claim under section 32?
It is not a business, there is no business activity with respect to that property.
So though it is a fixed asset, it is not a business asset. So I can't claim depreciation.
Yes.
Section 32 I can't claim.
Yes, I see.
So in this case in Hardoi Baba floor mills, what the court looked at is a same situation, but there they said like you treat it as business income, you claim depreciation, no standard deduction.
Reverse. Okay.
But in this case, okay, still better. You told no house property, I claim depreciation. Whether that other situation can exist, as I am talking, I am thinking.
Exactly, that's what is possible.
Because depreciation
This is
is
allowed,
allowed.
madam. This is allowed. I also will own a property. I will tell, okay.
What is the condition for claiming depreciation under section 32? I should have utilized asset for purpose of business, no?
Yes, sir. Business.
But there's no business, so I'm not falling under business matter, maybe that is right.
Now, for example, Infosys has got so many guest houses in various places. Where that income will come?
No, that is guest houses is what? It's used for business, so it's an added value in them.
They will declare under income from business and depreciation they will claim, sir. But here one point is there. The company that is coming back. Your thing is clear, sir? As I am talking, company, house property income, no depreciation. Now in future when I sell the property, I can claim long-term capital gain because no depreciation is claimed.
Exactly,
no?
that's one.
Because if I have claimed depreciation, it will become short-term capital.
capital.
That is one tax planning.
So this, I think you've covered this very well. Can a deduction be claimed against fresh loan taken through refinance? So in case of loan, the nexus is important. Next, I let out my house property. As commission, you pay a brokerage, right? Can you claim it as a deduction? Owner, right? I'm letting out my house property for say X amount of rent.
You have the standard deduction.
Right. Other than section 24 deductions, no deductions is this thing. Now, again, next question, right? So over here, I have a flat, I've let it out, a society is imposing certain maintenance charges on.
Charges directly paid to society.
No, I'm collecting it and I'm paying it also. So again, will you say the same thing?
Included in rent.
Huh?
Madam Kaur, it is included in the rent. Maintenance.
Right, but then the case law, Sharmila Tagore or something, even in the institute guide, this case law is there, where they have allowed this as a deduction, this maintenance charges paid, right? They have allowed it as a deduction, though I mean, like, I'm not very convinced with the case law, maybe because she was a celebrity and, you know,
So when they allowed as deduction means maintenance charges they added to rental income and they allowed as deduction. Anga.
How though?
Madam, even then how they will allow, madam? I can only deduct the municipal tax
30%.
and 30% standard deduction.
Yes.
No, you say you can claim both standard deduction as well as maintenance.
No, we can't. They allowed it seems.
They've allowed it, this
This
is
is
a
wrong.
very fact specific this thing. But if you look at this Sharmila Tagore scale, I think in Mumbai, because Mumbai's flats are very common, right? Like that is from time immemorial, flats have been in Mumbai. This is Mumbai tribunal. So they relied on several other judgments also. Because I got this thing, case law from the institute's guide.
You know what? They would have considered like a like they would have added and minus, like I am a pass through, like a reimbursement they wanted to prove. They wanted to prove in the computation. I added and it is like our inclusive and exclusive method of GST. In the turnover I will add and here I will show as deduction. Like that they would have added, it has come to my bank account. Now less, I am a pass through. So ultimate income on house property would be untainted with this receipt. I think
No, but
that
it
is
might
what
not even be possible in the ITR. ITR facility itself might not give me that mistake. I have to just show it under the interest column and add it up.
If you would have a trust, then that is fine. In this case, you don't have a trust, right? Separate trust.
should read the case law.
Similarly, against stamp duty charges, no, this thing, like, you know, this is also from the institute's guide that whether stamp duty charge, because now stamp duty is increased so much, whether if an SEC comes up to you and says, like, I want to only pay, declare only my net rent, I have incurred all these expenses, I will not show this at all as my receipt, and deduct it, then again, that is not allowed. This you have covered now. This next question, can a deduction be claimed against interest paid towards an inherited loan with an inherited property? Under section 25, you've covered that.
Unrealized. 25A is unrealized.
No, under section 25, interest on loan payable, that non-resident operating account, whenever you're paying to a non-resident, you take it to the operating account. No form 15 CSCB, like, you know.
TDS, no?
Yeah, TDS.
No, I think I covered.
Okay, this is the last distinct case study we have over here. So, pertaining to section 27, Mr. X gifted money to Mrs. X. Mrs. X bought a residential house from the gifted property, right? Inadequate consideration or whatever, if you transfer a house, if you are a deemed owner. So, this is not transferred the house, he's given her money, right, through whatever banking channel, gifted money. She bought a house and then she in turn gifts the property to Mr. X for inadequate consideration. Okay, so when he earns rental income, will it get clubbed in her hands?
First limb itself is failing now. First limb itself is failing now that he will be the Mr. X only will be the owner. When Mr. X will be the owner, in second, I mean in no case Mrs. X will be she will not be owner.
Mr. X will not be the owner, no technically. Mr. X did not give the property. Even though he gave money, the income from the money is clubbed in the hands of Mr. X.
No, but she can claim that income from money is nothing but this rental income.
Income from money is not rental. Income from investment from the money is house. Income from that house is the rent.
That one.
So it's a third stage, right? So I give money. From money, property has come. From the property, rent has come.
Yes.
So you say first.
No, see, if the
So let's break it. Husband gifted money to wife and wife bought a house. That rental income is taxable in whose hands according to you?
That's the base insurance. So clubbing should be on the gift and your tax. Okay, so this gift given to the spouse. Any income earned from that investment.
Yes.
Right?
This taxable in the hands of the transfer. Let us say fixed deposit. Forget about house. Husband gave money to wife made an FD, that interest is taxable in whose hands? No, husband.
It's accretion, no? It's accretion, it's not direct income. It's accretion.
No, any income, original, see, addition to FD, see, suppose she reinvests that interest. Subsequent FD interest will be taxable in her hands. The first point of interest will be added to husband's income, no clubbing.
Yeah, but in this case, she again gifted the property back to the husband.
No, let us arrive at the consensus at this point.
First stage, yes, it is club.
First stage, all of us
If she bought and she rented it out, that income is club.
to the hands of the husband.
Yeah, but now there is a specific section, right? That whenever you transfer
Only the asset.
a house for inadequate consideration, then the transfer is deemed donor. So does
Only for the purpose of taxation of income.
Under section 27, that's all.
27 and also I think capital gains.
Right.
And I will, capital gains people you ask, okay? Really, I am saying this is a serious thing. We, terrific tax planning we do, say just gift before 2 years and after 2 years wife can set and we, both of them can invest in 54 EC bonds, split the capital gain, we give advices. To my understanding that inadequate consideration carried to husband for capital gain, section 64, whoever takes please ask this question, don't miss it, okay. Come back, I am sorry.
Right. So that's what. So does it, because there is a deeming provision under section 27.1, therefore does it mean that wife itself is a deemed donor because of 27.1, we give section 64 right now. And therefore this thing.
Now what did they achieve by this?
That's what they were. See, if he would have gifted the
He
house to her.
converted the money.
Yeah, if he would have gifted the house to her, the rental income would have been taxed in his hands. Now, what it is, he gifted the money. That money she invested in the house and she gifted it back to him.
So finally, it will be taxable under Mr. X. Because clubbing process.
Jurisprudence on this.
In the first portion only, I think I actually stand on.
See, there is one like sort of similar, this Gujarat High Court judgment 1979. I went through it, but not very sort of similar. Where husband gifted money to wife bought the house. So this is under that section 9, whose income it should be this thing, right?
No, at the
No, but
Section
so
64, when you invest any.
no, whether there is a rental income, first of all, if see they both lives in that house, there is no issue, self-occupied.
No, there is rental over here.
Rental
income.
income.
So over there in this 1979 judgment, what has happened is earlier you even for self-occupied property under the old act and under the old act, even up to I think 1960s, I think 1970s, you had to pay deemed income on your self-occupied property as well, 10% of your income. So the question over here was whether that 10% income which you have to calculate, they were okay with clubbing, the SEC was okay with clubbing. But what the assessing officer had done is, he had done clubbing on the self-occupied property, and he had, for clubbing purposes, he had estimated the husband's income itself. Whereas the SSC's contention was, no, you have to see my wife's income, her 10% of the income, you charge it to tax in my hands as clubbing, right? So that was the judgment over here, where the Gujarat High Court said, yeah, you have to take the wife's income itself. If her income was very low, it was good tax planning for them. But actually there is no jurisprudence for this situation.
Here the intention of Mr. X is to avoid to tax, then it should be clubbed in the hands of X only.
Yes.
Intention. Without any intention, he gifted it to money to his
But
wife.
there is a specific section, 27.1 says deemed donor.
But
Right,
again,
so
64, there is a clubbing provision, no, where it says that it should be clubbed.
27.1 has to be read with section 64, right?
Yes, sir.
That's what. So clubbing is happening. I am earning, husband is earning that rental income, but it will get clubbed in my wife's hands.
Even in today's scenario also, see, I have a property. I'm in highest tax rate. So I will give money to my wife. She will purchase and she will again give to me. And whatever I earn, she will be
because of the until and unless the law remedies it, correct? You can use it as a tax planning tool. So with this I conclude my questions case law. Thank you.
On NRI, is earning rental income from under 3 lakhs. Other sources is 1 lakh only. And you will file the return and get the refund of TDS.
Okay.
Whether this practice is correct, no, whether foreign US, whether we should declare this
No, he declared it in US, right? He declared it in the US. US is one country where taxation is based on your green card status. Like even if you are resident, non-resident, you have to still declare your global income. Right? In India, it is on a resident status.
Whether claiming of this TDS refund is correct, or we should not claim refund.
No, he can claim it. He can claim the refund in India. Only thing is, you have to district court. He can't take credit over there.
Okay, credit should not be taken there.
If you are seeking a refund here, don't take credit there. Because there is no double taxation. The foreign tax credit comes only when there is a double taxation. You have to be aware of that. In this case, there is no double taxation because whatever tax paid in India is sort of refund, so there is no double taxation.
So there they have to show it as income.
Income and pay tax in US.
So I thank you all for being a wonderful audience. It was great.
Madam, renting out vacant land is rental income or
other income?
Income or other sources. But again, vacant land is it an agricultural land basis? Within the definition of Income Tax Act, not within the definition of the client. Thank you all.
So, why should the wife discount the property?
That's not tax planning, right? Because she might be at a lower slab.
Don't gift it, yeah. Keep it, But really somebody has.
Madam, but this will not be forming part of a tax plan. It is like a tax avoidance.
What is the professional evasion of that?
No, something will be there. It's a food for thought.
Most of these questions which I had are all practical questions which I have been able to ask people and find it. Because outfront income as such is a very small section.
Yes. Five sections.
Check your plan.
I'd like to thank both the speakers, Rani as well as Umar, for this first session. On behalf of Bengaluru branch, we thank you wholeheartedly for this. I request our chairman to hand over a token of appreciation to both of them. As a member. Can we have a big round of applause? Thank you, viewers, and see you tomorrow for the next session. Good night. It's raining out.
Good morning, members. Welcome you to the second module of RETA. Today we are doing the third session on tax planning and imported cases, reductions under the head income from business profession, disallowances, presumptive taxation and other provisions from business. For today's session, we have CA Narendra Kumar Jain. He is a commerce graduate and an FCA. He is also a company secretary and holds bachelor degree in law. He currently practices as advocate in the Karnataka High Court. Narendra has experience of over 19 years in advising clients and handling taxation matters at various firms. His academic distinctions include: he is an All India 5th rank in CS Inter. He has got a DL Mazumdar Silver Medal for securing highest marks in Advanced Company Law and Practice in CS Final. Taxman's Prize Award for securing highest marks in Direct and Indirect Taxation Law and Practice in CS Final. He has authored / co-authored following books. Authored books of analysis of transfer pricing judgments published by CCH. Co-authored book on digital commerce, analysis of taxation aspects and emerging tax issues published by IFA Bangalore. Co-authored book on permanent establishment, emerging trends published by CTC and Taxman. He was part of the revision team updating Sampath Iyengar's commentary on income tax 13th edition. He is a regular speaker at various conferences, workshops, study circles, National Academy of Direct Taxes, etc. His teaching stints include teaching for CA final students at CAPS on direct tax, international taxation, transfer pricing from 2004 to 2018, and for CA final students at ICA Bangalore. He is the chairman of International Fiscal Association Bangalore Subchapter from 2023 to 25. He is currently the Joint Secretary of Bangalore ITAC Bar Association. He was the convener of Bangalore Subgroup of Chambers of Tax Consultants, Mumbai for 2019-20. With this brief introduction, I welcome you, sir. I request C.A. Radhakrishnan, sir, to present a bouquet to Sri Narendra Kumar Jain, sir. Over to you, sir.
Good morning. Respected seniors in profession, respected professional friends. It's a great pleasure to be here on Saturday morning to take a session on section deductions under section 30 to 37. We all in the tax computation and in the tax audit, these provisions become very important because these form the crux of computation of income for any business assessors. If you see the sections 30 to 37, there are many sections. More than 30 sections are there. But many of them today are not relevant, or many of them are very specific to a particular industry which may not be relevant for a very detailed discussion. So if we go through each and every section, it is naturally not possible to cover in 1.5 hours. So what I will try and do is look at the important sections, the sections which we have to revisit on a daily basis, apply on daily basis, and also look at recent amendments which are being made, which become really helpful in terms of tax audit, in terms of regular computation of total income. And in that process, if you see, the major sections that come out are section 37, section 32, section 36. These are the major sections in this batch of sections that are really relevant for us. 35 also is relevant if you have a scientific research. Other sections are very specific to particular industries. 30 and 31 are very generic sections. Not much of debate is required on them because they just give you deduction for rent, repairs, municipal taxes, insurance. So very generic section in that context. But what really is important is section 37, 32 and maybe 36. No doubt these sections will have to be read with the disallowance section, which I think during the day it will be taken. Section 40, 43B and those sections. Naturally then we also have tax audit provisions, books of accounts provision. All that do come into picture, ICTS provision, method of accounting, all that come into picture. But today our focus will be on 32, 37. As I said, if we are trying to see all the list of section itself, it will take a long time. But we will try and focus on the important sections which are very relevant for us. Another benefit we have in these sections is, at least when we come to 32, 37, 36, we have a long history of good decisions. Because these sections follow the pattern what we had in 1922 Act. Section 10 of 1922 Act provided deduction for profits and gains of business or profession. So like for example 37 follows the pattern of 10 to 15 of the 1922 Act. So we have a judicial precedent right from 1922 Act also, which really helps us to understand this in a better way. So on most of the aspects that we discuss, there are classic decisions. Classic decision is what we are the evergreen decisions. Even if you refer today, they give us a lot of knowledge. And frankly speaking, when I was preparing for this session, I had to go back to those decisions. In that sense, it was really more helpful for me. I don't know how much helpful this session will be for you, but it was really helpful for me to prepare for this session. So let's start with section 37 and look at the recent amendments which have been made in section 37. Certain onerous amendments have come in, which also we should be aware of. So as we all know, right from the day we have studied that section 37 is a residuary section which deals with deduction. So 30 to 36 are specific sections. We have a specific line items there saying interest or gratuity or for that matter rent, insurance, repair. But when we come to section 37, it is more of a residuary section. So we'll start with the residuary section. The most important section in this batch of 30 to 37 is section 37. Now 37 says any expenditure not being in the nature described in 30 to 36 and not being capital expenditure, not being personal expenditure, laid out and expended wholly and exclusively for the purpose of business or profession shall be allowed in computing the income chargeable under the head profits and gains of business or profession. So what important characteristics that come out of it? There should be an expenditure. That expenditure should not be in the nature of 30 to 36. Then it should not be capital expenditure, it should not be personal expenditure. And the last link there, which can be further broken into 3 sub-items, it should be laid out and expended. What do you mean by laid out and expended? It means it should be wholly and exclusively incurred for the purpose of business. What is for the purpose of business? How do you interpret for the purpose of business? All of these aspects we'll try and discuss. So as I said, it's a residual provision and it really takes care of something which is not mentioned in 30 to 36. We'll also come to the aspect that if an expense is mentioned in 30 to 36, still can come and claim back in 37. There have been quite a good amount of conflicting decisions on that aspect. So it's a residuary provision. So if I don't fall in 30 to 36, I can come here. Then it is given that it is under the head profits and gains of business or profession, the business must be carried on during the previous year for me to really name the benefit of this. Except in cases where section 3 of the income tax applies, previous year, where we start from the time of setup. If the business is set up, then the previous year starts. In the other cases, I will have to see whether the business is carried on. Many times it will happen there is a closure of business or there is a suspension of business. So there are cases where there is a closure of the business. No manufacturing activity is carried on and no trading activity is carried on. Only there is some interest income on the other sources. Can I then claim deduction under profits and gains of business or profession, or I cannot claim a deduction under profits and gains of business or profession? Can I claim? Should the business be carried on? Because ultimately it is a deduction under the head profits and gains of business or profession. If you see the decision of Allahabad High Court in JK Manufacturing, where the plant was closed for many years and there was no reopening of such plant in near future, it was not in sight. So the High Court said that there is no income under the head profits and gains of business or profession. There is no business activity carried on. Only income is some interest income from other sources, and therefore you can't claim a deduction from the head business or under the head EGPP. There could be other aspects also that one has to take care. There could be one, closure of business, or there could be partial suspension of the business. There are cases where, say, I couldn't operate for the entire year for the reason of certain natural calamities, or because of riot. In those cases, the courts have given the benefit of deduction, saying that these are acts of gods not within the control of the assessee, and also it is not closure of business, it is suspension of business. Suspension of business can arise because of various reasons. It can arise because of lockouts, it can arise because of certain natural calamities or something more. We have recent incidents of COVID also, where businesses may be shut down for the entire year also. Right? So if it is only a suspension, then they can still be able to claim the deductions under the profits and gains of business or profession. Carry over such losses because you will not have any income in that particular year. That is one aspect of it. Second, in cases of such cases where there is a suspension or partial closure, one could also argue that ultimately, suppose I am in under liquidation, then I will have to dispose the assets, right? I will have to dispose the assets, I will have to realize the debtors, I will have to pay the creditors. That is also one kind of a business activity, and there will be some expense or income arising out of that business activity. There are cases where because of such kind of activities were carried on, and it was articulated in a proper manner that these activities also constitute business. Therefore, the deduction under profits and gains of business or profession was corrected. So one really boils down to what are the facts of a particular case, but one need to be mindful that there should be some income under the heads profits and gains of business or profession. If there is no income under the head profits and gains of business or profession, then 30 to 36 or 30 to 37 may really not be applicable, because ultimately 28, which is charge for the business income, and 29 says the income under that head 28 will be computed applying 30 to 43D. That can articulate or crystallize only when the business is carried on. So that is another important aspect which we have. Source of expense is not relevant. What is relevant is whether expenditure is incurred or laid out. So I might have incurred the expense out of loan, I might have incurred the expense out of capital. So my receipt side might be capital, but expense may be revenue. That doesn't matter. So the source of expenditure, from what source I have incurred the expenditure, is not a relevant consideration. To claim a deduction for expense, it is not necessary that always there should be corresponding credit. That is not the purpose, or that is not the objective of 37. Even if you do not have corresponding credit, because look at the words of section 37, it says for the purpose of business. It doesn't say for the purpose of earning income. It doesn't say for the purpose of earning income. It says for the purpose of business. So when I incur an expenditure, the cases could be where the expenditure is not generating income, but the expenditure is still for the purpose of business. We'll deal with some of the examples as we go forward, but for us to keep it in mind is, it is not necessary that the expenditure should result in income for it to be deductible. Even if the case's expenditure does not result in income, but if I satisfy the test of 37, not a personal expenditure, not a capital expenditure, laid out expended for the purpose of business, then I am still able to deduct that expenditure by claiming the reduction. Incidental benefit to third parties. Just because an expenditure incurred benefits else is again not a basis for rejecting the claim of a deduction. What is relevant that it should be for the purpose of the business. If I am demonstrating that thing, that it is for the purpose of business, even if it benefits a third party, it will not make a difference, it will still be allowable as a deduction. When we see the first limb of 37, it says any expenditure, right? So what is the meaning of an expenditure? That is the first critical point for us to start, to determine whether an expenditure is deductible under 37(1) or not. expenditure is something which is paid out or away and something which is gone irretrievably. That means it is gone out of pockets of the assessee and assessee has no control over that fund or that amount. So it goes out of assessee's hands, assessee's control, permanently, irretrievably. If I have a sort of a control to bring that fund back to me, in those cases, it cannot be said that it is an expenditure. It should be expenditure, it should be expended. Right? So one example which is coming from one of the Supreme Court's decision is the assessee created a provision and invested that in certain securities. And the assessee claimed that this provision is meant for future liabilities. The Supreme Court held that how can this be an expenditure? It is not gone, the funds have not gone irretrievably from your control. So expenditure will mean that it should be something which has been claimed or which has been gone out of the hands of the assessee. And as we see, it says expenditure, expended. Any expenditure, if you see 37, it will say laid out or expended, third line, laid out or expended. So if these two words itself are seen, expended itself is seen, the word expended itself would mean that it is something which is spent, something which is spent. Laid out is used for the purpose of provision. So if I want to claim a deduction for the provision, expended will not mean provision, laid out will mean provision. So if I have to fit the provision into 37, it comes in the words provision. There is no other section in which you can claim a provision unless there is a specific provisions like say gratuity or something. Because 30 to 36 doesn't deal with provisions, I have to fall in 37, and in 37 the expenditure laid out would mean the expenditure for which a provision is covered. This again is a long drawn battle, but the courts have consistently held, and there are certain tests which are discussed, we will discuss in the next slide, where and what circumstances a provision can be an expenditure and a claim of 37 can be allowed for that purposes. A contingent liability cannot be an expenditure. So a liability which is in future, which I will incur subsequently, and today there is no present liability on that, cannot be claimed as a deduction, right? Now one more aspect that has to be kept in mind is a loss versus expenditure. Can I claim a loss under section 37? Suppose there is a loss, asset is just lost, or there is a theft, there is cash is just lost. Will that be allowed as a deduction? Can I claim it under 37? Is it an expenditure or is it a loss? Say cash just lost, for maybe employee has taken or customer has taken or there is some theft and there is no insurance, I am not able to get that money back. Can I claim it as a business deduction, cash out of my business, say petty cash or maybe cash box, whatever it could be. Is it an expenditure or is it a loss? It's a loss. So there was always an understanding that expenditure and loss are two different things. Expenditure or loss are two different things. Sometimes they are used synonymously because 37 applies only to an expenditure, right? But Supreme Court in the Woodward Governor's case that even expenditure in 37 can cover loss. Actually that may not be a correct interpretation of 37 word used expenditure in section 37. Nevertheless, the courts have consistently held that loss is deductible under 28 itself. You don't even have to come to 37. You can deduct a loss under section 28 itself. In the charging provisions, when you are talking of profits and gains of business itself, the loss is a deductible expenditure under 28 itself. Woodward Governor's case and tries to bring in the loss under the section 37. My opinion, it may not be correct, but anyway, even if you take the loss vis-a-vis the expenditure, if 37 is not applicable, still 28 I should be able to get the deductions. Historically, all earlier decisions have clearly held that expenditure or loss are slightly different. Both are different, both are not one and the same. Loss is something which is just lost. It could be lost because of an asset, loss of inventory, loss of various other things could arise. Expenditure is where I am claiming a deduction for making a payment to someone, something which is expended, right? Though this distinction is there, one has to be mindful of that under which section one is trying to claim the deduction of a loss. Ideally, one can claim under section 28 itself. Now we come to liabilities, provisions. Can it be fitted into section 37 and what kind of provisions or what kind of liabilities I can claim. Again, we have quite few classic decisions here. One is Calcutta Company Limited, one is BEML, Bharat Earth Movers Limited. So these are all pretty old decisions and laid out ones are quite few fundamental principles that we have to keep it in mind. If you see BEML's decision, there was a provision for leave encashment. The question was whether provision for leave encashment, which is not paid to the employee, there is a liability in future. Naturally, as per my policy, I have to give certain leave encashments. I may not be paying today, but I may be paying, say, after X number of years. So there is a liability. There is a method to calculate it. Because I know that employee salary is this, number of days leave is this. This is the amount of salary that leave encashment that will arise. The question before the Supreme Court was whether leave encashment provision is a deductible expenditure. It followed the decision of Calcutta Companies Limited, where the Supreme Court discussed the mercantile system of accounting, principles of accrual, and held that provision will be covered under Section 37. Applying that principle, Supreme Court in BEML's case, Bharat Earth Movers Limited case, held that provision for leave encashment is a deductible expenditure. Post this decision, we got amendment came in Section 43B. That is the amendment clause F of Section 43B. The reason for the amendment is the BEML's decision, where they tried to say that the BEML's decision laid down the principle that any provision which is made for a future liability, if the liability is there accruing on that year and if it can be estimated properly, that becomes a deductible expenditure. Now this is a general principle which the Supreme Court initiated in BEML's case. What 43BF covers is the leave encashment. But if there are other provisions which are not falling in 43B, clause 43B, I could still be able to claim a deduction for such provisions. The question is, again I have to apply the same principles. This was further articulated in the decisions of Rottrack Controls 314 ITR 62. The very important decision where provision for warranty was discussed. Supreme Court formulated a triple test that under what circumstances the provision for warranty will become deductible expenditure. And naturally this will apply to all similar provisions that we discussed. So today the question, the Supreme Court, what Supreme Court did is, there is an obligation as a result of past event. That means when you are making this provision on the date of provision, there should be an obligation because of a past event. That's a test number one. Second, there is a probability of an outflow because of that obligation. That means in future there is a probability of an outflow, cash outflow or some other outflow because of the obligation. Third, there is a reliable estimate of how that outflow or obligation can be computed. So this was a triple test laid down by the Supreme Court. Say take for an example, a car manufacturer, say Toyota or Maruti or anyone else, today when they are selling a car, they are giving that I will give you a free service for say 2 years. There is an obligation attached with the past event. That means when I have sold the car, I am going to say that I am going to give you say 6 free services in next 2 years. Right? This is the obligation which I am taking when I am selling. This will apply to everyone else. This will apply whether I am say a laptop seller who will say I will give you 3 years warranty on-site warranty or off-site warranty. I am giving a certain parameter, I am giving a certain obligation, I am taking over a certain obligation when I am selling the goods. Right? So there is a provision of warranty that is arising. The question is, what is the, so there is an obligation, answer is yes or no. So if there is an obligation, next question is, will there be a future outflow because of this obligation? Naturally, if I am given a warranty to serve in next 3 years, there is going to be a future outflow because of that obligation. Next, can I estimate this obligation? And this is where it becomes critical in most of the cases. The estimation will have to be precise. Not precise, it will have to be on a proper scientific basis. Naturally, the provision can never be estimated, say, on a mathematical basis and to be precise, but there has to be some basis. Say for example, if you see the warranty cases, we will find that there is some historical basis on how much expenditure is incurred. Say 1% of sale is the incurring of expenditure of last 5 years. Average expenditure I have incurred on provision for warranty is 1% of sales or 2% of sales. So some historical data is there which gives you insight into how much you can incur in the future. If this data is not proper, that means you make a provision for 3% but you incur only 0.5% and that history is there for 10 years, then there is a problem. That means the provision is not scientific, it is not having proper basis. Right? So the question is, my calculation should be scientific. And this is very important for any provision that we do today. These triple tests of fraud track control should be satisfied, because you will always see in the assessments the revenue authorities would have an allergy to provision. To them, every provision is a contingent liability, not a deductible expenditure. So to take care of such circumstances, this triple test is something which one has to be mindful of, and while saying that a provision is a deductible expenditure. So there has to be an obligation, there has to be a future outflow based on that obligation. That obligation is created because of past events, future outflow depending on that obligation, and there has to be a reasonable estimate. Some reasonableness should be there in the estimate to calculate that future outflow. If this triple test are satisfied, in those cases, the provisions made or liabilities which are future in nature, one can argue that it is not contingent liability. Incurrence is there. The future I will incur is fixed. How much I will incur is estimated. Contingent liability is you don't know whether you will incur or not. That's the distinction between a contingent liability and something which is not contingent. Right? If I am able to demonstrate that I will incur in future, and that is there, then these decisions, whether Bemel's case, Metal Box case, the decision of fraud track controls, all will be the helping hand for the assessee to claim a deduction of that expenditure. Similar situation arises in case of disputed liabilities. It could be statutorily disputed liabilities, it could be contractually disputed liabilities. That means statutory liability, today I get a GST notice. Can I say I will make a provision and claim an expenditure for that? Right? So that is a statutorily disputed liability. It could be contractually disputed liabilities. Contractual disputed liabilities may arise where you have a terms of contract that if I am delaying, I am going to make so much of penalty payment. Right? Or there could be similar other contractual liabilities which would arise. In cases of a contractual liability, it is very certain that based on the agreement, you are able to estimate that what could be my liability if I am defaulting on so and so clauses. Such default clauses, if there is a liability which is there, one. Second, if the other party has a right to claim that money from you, there is a debt due in favor of third party. There should be a debt due in favor of third party. That means the third party is having a right to claim that amount from you. In those cases, such provisions, though it could be disputed in court of law, or it could be something which is pending negotiations, can be a deductible expenditure. When it comes to statutory liabilities which are disputed, say for example GST, today I get a GST show cause notice. I cannot make a provision and claim that as a deduction because it's still a contingent liability, right? Because it's still not crystallized. But there could be situations where in future it gets crystallized, orders are passed, I don't litigate it further, then in those cases I could claim a deduction. One can again refer a classic decision of Swadeshi Cotton Mills, 53 ITR 134. This is in the context of labor payments, bonuses paid to laborers. In 1947, there was certain claims made by the labor unions against the company saying that this is the additional amount you have to pay. This was disputed, and then in 49 finally the liability was crystallized. In the assessment of 50-51, the assessee made that saying that in this previous year I made a payment of so and so amount, this is a deductible expenditure I am claiming in AY 50-51. The tax authorities rejected that claim on the ground that this liability refers to the assessment year in the year 47 and not related to 50-51, therefore we don't give a deduction in 50-51. The question was, when did this liability can be claimed? The Supreme Court held the order came in the previous year relevant to the assessment year 50-51. The settlement and the payment happened in 50-51. Though it is a liability of earlier years, the liability, that means it is relevant to earlier years, but it is arising in this year, therefore it is a deductible expenditure in this year. These kind of situations will arise in various circumstances in case of arbitration claims, in case of contractual payments. No doubt, every case one has to see the facts and what are applicable, but the guiding principles can be taken from the Swadeshi Cotton Mills case, and that can help you to decide that in which year I should get a claim, whether first deductible or not, deductible, and in which year it is deductible. Though both these aspects become very relevant, because if you claim in wrong year and the officer disallows, again there is a problem whether you can claim it in a correct year subsequently. So these aspects also become, one has to keep it in mind when it comes to disputed liabilities. The next condition of 37 is that expenditure should not be referred in 30 to 36. Right? This also becomes major hindrance many a times to claim deduction under 37. As we have seen, section 37 is a residuary section, and something which doesn't come in 32-36 can come in 37. The question which arises is, and which is arisen in many cases, is that if an expenditure is already mentioned in 32-36, can I come to 37? For example, interest, it is covered under 36(1)(3). Now, for some reason it gets disallowed under 36(1)(3), can I claim under 37? Say gratuity, it gets disallowed, it is covered under 36(1)(5)(a). Can I, if I am not getting covered there, or can I come back to 37 and claim it there? So there could be many such instances where I am not able to claim under 32-36, and then can I go back to 37, fall back on 37 and claim under 37. So it is interplay between 32-36 versus 37. If you see the Supreme Court decision in Southern Technologies, this was a case where there was a provision made for NPA by an NBFC, and based on the provisions of section 36, a particular provision was not becoming a deductible provision. The reason was, it was claimed, it was this is a notional provision just made based on the RBI guidelines, and the claim was not falling within the parameters given under section 36. The assessee made alternative claims, saying that the provision is a statutory mandate by the RBI, so I should get a deduction. If it is not falling in 36, at least give me in 37 based on the real income theory. Ultimately, what needs to be taxed is the real income theory. The Supreme Court in Southern Technologies case held that the real income theory is also subject to the provisions of the provisions of the Act. If the Act has a specific provision, we cannot say the real income theory will override a provision of the Act. But when it came to 37, the Supreme Court observed, they held that 37 applies only to items which do not fall in section 30-36. If a provision of a doubtful debt is expressly excluded from 36(1)(7), then such a provision cannot be claimed as a deduction under section 37 even on the basis of real income theory. So the claim of the assessee that it should be allowed under 37 was rejected by Supreme Court in Southern Technologies Limited. Similar is a case of a group bond where the claim was for a provision of a gratuity. But in group bond's case, the claim of gratuity was also hit by 40A(9). So again 40A(9), which provides for a disallowance of gratuity, it was hit by that section also. Southern Technologies case was more specific, but also there it was only provision for NPA. Now, if you take these cases, the principle laid down by these cases, it becomes really difficult to say that if I am not falling in 32-36, that means if an item of expense is covered under 32-36, but it is not falling within the parameters of 32-36, can I claim under 37? Apparently, if you look at these decisions, it appears that it will not be allowed as a deduction. But there are some good amount of contrary decisions also. No doubt there are High Court decisions, and the one which we are dealing with, the Southern Technologies, is a Supreme Court decision. But let's not forget that in the case of Supreme Court, the issue was provision of NPAs. Now look at other way around. So there are cases where, say for example, Bombay Steam Company, where the case was 36(1)(3) says interest on capital borrowed. That's a deduction what I get. Now interest on purchase price. It is a purchase price capital borrowed, that means I have purchased something. I have not paid payment in time. And then is it a capital borrowed? Or capital borrowed would mean something which I have really borrowed from someone. It is in the nature of a borrowing. A purchase price, no doubt it's a wider term, it is a borrowing, because ultimately it's a debt due in favor of someone, I have to pay to someone. This is a Bombay High Court decision which said 56 ITF 52 that if it doesn't fall in 36(1)(3), it will still fall in 37. It's a very interesting para on this. In the next slide I'll read that out. But these are the decisions which have taken a different view. Similarly, Siddeshwar's decision of Karnataka High Court in the context of 388 ITR 588 in the context of gratuity. It's a very interesting decision. Now these are again prior to 40A(9)'s insertion, but the point here was I have actually paid the gratuity. For some reason it is not falling in 36. I have paid the gratuity, say, to an LIC trust, right? And that trust may be unrecognized trust, it will not fall in 36. Now, when I have really paid something, is it not my expenditure? Is it not gone out of my own hand, out of my pockets? It is irretrievable. I cannot get that money because the trust may be irrevocable trust, right? The Karnataka High Court in the case of Siddeshwar observed that mere fact that gratuity contribution would not come within the ambit of 36(1)(4) would not disentitle the assessee to claim the benefit under 36(1) if the requirements thereunder were satisfied. So the question is, if the requirement of section 37 are satisfied, despite gratuity being one of the line items mentioned in section 36, the Karnataka High Court in Siddeshwar and then the Kerala High Court in KB's case, so that was the Karnataka High Court, allowed the claim of a deduction. Similar matter I had opportunity to argue before the Bangalore Tribunal in case of ACA Worldwide, where the question was, the assessee had a trust, and that trust was recognized trust, which was managed by LIC. The payment was made to that trust. Subsequently, the trust recognition was cancelled due to certain defaults. So, and the cancellation was from a retrospective effect. So, effectively, the trust became unrecognized trust, and the payment made to the gratuity trust was disallowed, saying that you are not now a recognized trust, and therefore 36 will not apply to you, and therefore there is no deduction will be given. So, it was argued before the tribunal that, see, look at 37. Ultimately, it is a money which has gone out of me. It is paid to a trust. I have no control over the trust. There is no way that money can come back to me. So, the test of 37 is satisfied. Therefore, deduction was allowed. So, that way, one has to be careful and mindful that there could be situations where this kind of a situation will arise. One should refer to this Kerala High Court full bench decisions observation. The residuary nature of provisions of section 37 will therefore have to be given its full play. The residuary nature of section 37 will have to be given its full play, bearing in mind that the reason for introduction of the words within the brackets not being expenditure in the nature described in 30 to 36, we have to remember that the words do not regulate certain species of liabilities, but only excludes consideration of liabilities which would fall under any of those sections. So what it tries to say is this: for example, if I today have an interest payment, what 36(1)(3) covers? Interest paid on capital borrowed, right? If interest is paid on something else, is it really covered under 36(1)(3)? It is not covered under 36(1)(3). So what is the specific species of expenditure that is covered under 36 or for matter any other sections? Only that species of expenditure is what should be focused on. The nature of expenditure may be same. I may be paying interest on something else, and the interest that is covered under 36(1)(3) is interest on capital borrowed. Though the nature of both is same, it is interest, but it is interest of a different dimension. It is an interest which is of not a, it is not of something which is paid on capital borrowed. So therefore, there could be circumstances one should evaluate if the cases are not fitting into 30 to 36. For some reason, there is a disallowance happening under 30 to 36. There could be possibility to claim that under 37. One has to evaluate in a given circumstances. No doubt Supreme Court's decision has just highlighted could be a situation where it could create certain difficulties. Then we come to the another clause, that is a capital and versus revenue expenditure. Another important consideration that does arise, that when an expenditure is a capital expenditure, when an expenditure is a revenue expenditure. No doubt we deal with this on a regular basis, day in, day out, and know the principles, but just to again highlight some of the important principles, some important decisions, two to three very critical decisions in this context which everyone should read when is dealing with capital expenditure: Assam Bengal Cement, Empire Jute, Devidas Vittaldas. These are all classic decisions in the context of capital versus revenue expenditure, right? So again, these decisions say there is no rule of thumb. One has to decide on the facts and circumstances of the case. If an expenditure for acquisition of a capital asset, then naturally it is a capital expenditure. If the expenditure for getting an enduring benefit, then it is covered under the it is covered as capital expenditure, and it is not something which can be claimed as a deduction for the as a revenue expenditure. The Assam Bengal case dealt with a situation where lease payment for 20 years were made in once for all. In one shot, lease payments for 20 years were made. Assessee claimed the entire lease payment as a deductible expenditure. The Supreme Court, while dealing with that aspect, discussed various aspects, saying that what is the nature of these lease payments, and they discussed various parameters, and what is the thing that they brought on certain principles, that the source of expenditure is not relevant. You might have taken a loan and then made a payment. That is not relevant for you to decide whether it is revenue or capital. Once for all payment is again not a relevant criteria. That is not a relevant criteria. Lump sum payment versus installment payment is not a relevant criteria to decide whether it is a revenue or capital expenditure. Whether it brings an asset into existence or whether it brings an advantage of enduring nature into existence. So if it is bringing an asset into existence or whether it is bringing an advantage into enduring nature into existence, those will be capital expenditure. In this case, it gave the associate a benefit of lease of 20 years, renewable for another 20 years, that means 40 years, and one short payment was made for these 40 years. Therefore, they held that it's an enduring benefit that the associate has got. Therefore, it becomes a capital expenditure. Contrast this with the decision of Devidas Vittaldas case, 84 ITR 277. In this case, very interesting fact pattern. There was a CA firm by, say, Mr. A, and he had the goodwill of that firm. He brought in some Mr. B as a partner, and then they both continued the partnership firm for some time. Later on, A retires from the firm, but the terms of agreement are such that A continues to hold the goodwill of the firm. It is stated in the terms, the agreement which they have between the parties, that I will be holding the owner of the goodwill, right from the original admission of a partner in the retirement, and even the subsequent admission of new partners, which B brings in another C there. So all along, the goodwill was owned by the A in our example, and the term said that you'll have to give me percentage of so and so revenue in perpetuity. They don't, till you use the name, so and so name, you'll have to give me the royalty or you'll have to give a percentage of revenue. So the question was, these payments which were made, whether they were for purchase of goodwill or whether they were for the right to use the goodwill. So whether payment which I made, what B made to A or the partnership firm made to A, whether that was a purchase of goodwill, have you purchased the goodwill of that Devidas Vittaldas, or have you really used the goodwill? After discussing various aspects, the Supreme Court held that it is only a right to use the goodwill. It is not a purchase. The goodwill is not assigned or transferred from A to B, and what really B gets is right to make the payment to B, a right to use the goodwill, and for that he has to make a payment to B, and that payment has to be as long as he uses the name. Right? Tomorrow if he says that he does not want to use the name, the goodwill of that name goes back to A, and therefore it is not a deductible expenditure. Therefore it is not a deductible expenditure. So this brings out the aspects of really purchasing an asset vis-a-vis right to use an asset. And if it is a right to use an asset, it will be a revenue expenditure. If you are purchasing an asset, it will be a capital expenditure. Another decision that one has to keep it in mind is Empire Jute case. So here, this was a case where there was a cartel of jute manufacturers. The cartel had an agreement that every jute manufacturer will manufacture or run the mills only for a certain number of years, a certain number of hours. So you can run the mill only for a certain number of hours. You can't run the mill beyond that based on the association's agreement. And because of this condition, there was trading of loom hours. They called purchase and sale of loom hours. So if someone is having a lesser number of loom hours, I could have bought it from him. Suppose someone has a quota of 100 and he uses 90, I could have purchased the 10 loom hours from him. So the question was, and I am purchasing this loom hours and making a payment for purchase of loom hours, whether that is a capital expenditure or revenue expenditure. Supreme Court discussed laid down various tests. They says in this case there is no impact on fixed capital. It is a circulating capital. Fixed capital versus circulating capital. They brought out that test. There is no new asset that comes into existence, no enduring benefit, because next time I have to use the loom hours, again I have to buy the new loom hours. So there is no enduring benefit that comes into the picture, and the income earning apparatus of the assessee is not impacted. The same machinery remains, everything remains same. Right? So keeping those aspects in mind, the Supreme Court held that because it is not affecting the fixed capital, it is affecting only the circulating capital. It is only a purchase of loom hours. It is not enduring benefit. Therefore, it is deductible as revenue expenditure. And in that process, they discuss various important principles. One can also read this decision, read the decision of coal shipments. So all these decisions lay down certain guidelines for us to apply and understand in the real life. Then we come to the test of wholly and exclusively. Wholly and exclusively. What does, because you see 37, the expenditure should be expended laid out or expended wholly and exclusively for the purpose of business. Wholly and exclusively for the purpose of business. And this is where most of the expenses can get struck, because they will say it is not incurred wholly and exclusively for the purpose of business. This and the next limb for the purpose of business. And this is the place where certain challenge will arise. And this is where we again can discuss two important decisions, Sassoon J. David's case and the Supreme Court and SA Builders, which bring out the concept of commercial expediency. And when you look at for the purpose of business, next slide also will see that. What do you mean by for the purpose of business, and the aspects of commercial expediency should be factored in for the purpose of business. You have to look at from the businessman point of view, not taxman's point of view. So Sassoon J. David's case said that wholly and exclusively doesn't mean necessity. It is not necessarily. You may incur an expense voluntarily. You may incur even if there is no necessity for the purpose of business, then it is still fine. The question is, it should be wholly and exclusive for the purpose of business, not necessarily for the purpose of business. So necessity is not a test as laid down by Supreme Court in Sassoon J. David's case. Commercial expediency is something which is the most important aspect when we discuss these phrases wholly and exclusively for the purpose of business. And there should be nexus. Which is Sultan Tobacco's case, there should be nexus between the expenditure and the business. If there is a nexus between the expenditure and the business, and that expenditure, that purpose, that nexus is real, not remote and illusionary, it will sufficient. And another decision that should be looked at is Madhav Prasad Jatia's case. For the purpose of business is wider than the scope than for the purpose of earning profits. As I said in the beginning, the section 37, today it doesn't say that there has to be necessarily an income on the income side. If you have incurred an expenditure which is wholly exclusively for the purpose of business, it is not necessary that there should be income on the income side. It is not for the purpose of earning profits. It is for the purpose of business. If it is for the purpose of business, Supreme Court in Madhav Prasad Jatia's case, it is held that it is allowable deduction. Though this case is a very bad fact pattern and the expense was finally not allowed, here was a case where the lady said that she is going to contribute donation of 10 lakh rupees for a hospital in memory of her husband. And she took a loan for making that contribution. And interest on that loan was claimed as a deductible expenditure. So question was whether 3613, which says again there also, and 3613 and 37 the words are same. This is under context of 1922 Act. In 1922 Act the sections were 10 to 5 and 10 to 15. So there the question was whether it is for the purpose of business or for the purpose of business for the purpose of interest also, for the purpose of business for the purpose of 37 also. Both the words, both the sections 3613 and 37 used for the same words. Now here the Supreme Court held that this is for the personal purposes. The donation has to be made in the memory of husband. That doesn't doing any value addition to the business. The business was money lending business. It has no connection with running a school or hospital for that matter, and therefore it is not a deductible expenditure. Interest taken was held to be not deductible expenditure. Same way you will find in cases where, say I have taken loan for the purpose of paying advance tax, loan for the purpose of paying income tax, or loan for the purpose of doing donations. In those cases also, consistently it has been held that those cannot be deductible expenditure. So the nexus between the expenditure and the business should be there, and that nexus should be, there has to be some nexus. When we look at that principle, if you see for the purpose of business, the question will be what kind of expenditure will get covered and what kind of expenditure will get excluded. There have been decisions before the CSR came into effect, where say for Infosys' case, they gave certain payments for better traffic movement, and the question was that becomes a deductible expenditure, because the assessee argued that this better traffic movement helps its employees to reach the office on time, that increases productivity, and therefore it is a deductible expenditure. No payment was made to traffic police for better traffic management, and certain expenses were incurred for that. The Karnataka High Court in Infosys held that it is deductible expenditure. It is a deductible expenditure because it is for the purpose of business, though certain third parties also may be benefited because of it, but that is not relevant. The question is whether the assessee is having a nexus with that expenditure, and if the assessee is having a nexus with that expenditure, it becomes a deductible expenditure. There are cases where colleges or schools or drinking water facilities were constructed in the village where the assessee operates. Naturally, they may not be directly benefited to the assessee. These are all before the CSR thing came, the explanation 2 to 37 coming into picture. But these were held that these are ultimately for the purpose of business, because the assessee is operating in that village. It creates a goodwill in that place. Employees of the assessee come from those villages. And the good health of employees may be relevant, good education for the children of the employees may be relevant, and therefore these are deductible expenditure. The point is, how am I able to create a reason that an expense is having some link for the purpose of the business, and that purpose of the business may be wider. Commercial expediency, we say, as the SE builders have said, is much wider, and it is not a direct connection, it is a wider connection that is good enough for me to claim a deduction for an expenditure. This has to be kept in mind while we claim section 30, reduction under 37. We'll just look at some quick examples, some recent examples, some recent decisions to help us understand this in a better way. Then we'll move to explanations and other sections because we're running short of time. So question in these decisions was interest paid on TDS. This is again a very common thing. Can I claim interest paid on TDS? Sometimes I'm bearing the TDS myself. Can I claim it as a deduction? TDS receivable doesn't come and I write it off as a bad debt. Can I claim this as a deduction? So many times it will happen. You have billed 100 rupees. He gives you 90 and 10% TDS. TDS doesn't reflect in form 26 years. He doesn't give a certificate. That 10 rupees is lost. So can I claim that as a reduction of expenditure? Is it a deductible expenditure? So when it comes to these kinds of payments, look at interest on TDS. So interest paid on TDS, the question that under 37 the tribunal dealt with was whether it is wholly and exclusively incurred for the purpose of business. Is it a statutory obligation or is there a linkage for the business? It is arising because of business. Because I am doing business, I have to make a payment. It is arising because of the business. But it is not for the purpose of business. It is arising because of the business but not for the purpose of the business. So the Kolkata tribunal, when it comes to interest paid on TDS, disallowed the expenditure, saying that it is a statutory liability and has no connection with section, the test of section 37 will not be satisfied, therefore it is not a deductible expenditure. Same views were there in case of expat engineering, Chennai properties, where they said that the interest will take color from the principal amount. Principal amount being income tax, interest will also is in the nature of direct tax and would not be regarded as compensatory payment, or was therefore not allowed as a business expenditure. One interesting decision again is there, which is allowed this as a deduction. They said that TDS is the payer's liability, it is not payer's liability, it is not payer's income tax, it is payer's liability, it is payer's income tax. And it is compensatory in nature, therefore we will allow this as a deduction. Though the first view appears more relevant because this decision doesn't discuss whether under 37 it is still the test of for the purpose of business, wholly exclusively incurred for the purpose of the business will satisfy or not. But when it comes to TDS, assessee's income and TDS is deducted and assessee doesn't get the credit of this because it is not appearing in 26 AS. Can I claim that it has a deductible expenditure either under 3617, which is the bad debt, or under income tax, under tax section 37 residual sections? These set of decisions said that when that TDS is not recovered, it will become a deductible expenditures. Yahoo Web Services, Shreyans Industries, even certain other decisions. The logic is very simple. I have to have a receivable of 100 rupees. He has given me 90, 10 is receivable from him. That 10 he has to give me in the form of either TDS or he has to give me the cash or check, whatever. So that 10 which has not been received, which has been deducted as TDS, the courts held that this is a nomenclature of this is a receivable debt. It is a debt in nature. It is not an income tax. It is not in the nature of income tax or TDS. It is debt in nature. And that becomes a deductible expenditure either under 37 or under 3617 dealing with the bad debts. So when it comes to TDS which is deducted from your income and you are not able to recover, which you have shown as receivable in your books of account, the assessors might have shown receivable in their books of account, that becomes a deductible expenditure. One can claim either under 3617 or under 37. Certain times we do cross up of TDS. So I have to remit 100, but because I have to bear the TDS in non-resident payment cases, I will be remitting 100 and maybe 11 rupees, whatever that odd amount comes to, I will pay the TDS from my side. So the question is, what becomes deductible expenditure, 100 or that additional TDS which is grossed up from my pocket itself and which I have been paying, whether that also becomes a deductible expenditure. In the case of Light on Mobile, the facts were slightly bad. The agreement was that I will recover the TDS, but the associate did not recover the TDS and instead paid from its own pocket. So the tribunal held that it is a related party transaction. It was a related party transaction in that case, and therefore they did not allow the deduction. But when it came to Bob cards and the other two decisions, Standard Polygraphy and Man Industries, in case of Bob cards, the payment was made to MasterCard and Visa card, and the TDS on that payment was taken care by the assessee. Agreement also provided that the payer will bear the TDS. The deduction for expenditure was allowed. When it came to the case of Standard Polygraphy and Man Industries case, there was technical know-how, and on that technical know-how, TDS was borne by the assessee. That TDS which was borne by the assessee was permitted to be capitalized along with the asset as an actual cost, and depreciation was given on that enhanced TDS amount which was allowed, permitted to be capitalized, because the technical know-how itself was capitalized in that particular case. So that way the assessee got a deduction for expenditure. Now we come to two important amendments which are made in section 37. So we all know explanation 1 said that the expenditure which is incurred for an offence or which is prohibited by law shall not be an allowable expenditure, shall be deemed to be not incurred for the purpose of business. This was there from long time, and an explanation 3 has been added, and this is something which we should be aware of. Explanation 3 has been added, which we need to look into both from applicable from 22-23 onwards and applicable for current years, which makes a very interesting read. So when the old explanation 1 was there, certain issues arose that when we are talking of an offence or something which is prohibited by law, whether the law should be Indian law or a foreign law also. So what if I commit an offence under foreign law and incur an expenditure for that, whether it is a deductible expenditure? The words in India or outside India were not used in explanation 1. That was one issue. Second issue, so if you see the first clause here, for the purpose of which an offence under or which is prohibited by or under law timing in India or outside India has been now inserted. That means the offence could be in India or could be outside India, right? So any offence under the earth is covered now under the explanation. So even if you incur, the Milan Laboratories case was there, Hyderabad Tribunal, which says outside India offences are not covered under 37. The law means law of India and not law something which is there outside India. The challenge is how do you implement this? Suppose as a tax auditor I have to comment on this, whether there is an expense incurred for any offence. The clause has there in which I have to comment. Now how do I know under which offences are there under outside India? Whether the assessee has committed any offences outside India. Second, what do you mean by offence? Offence is something which is finally determined. Who will determine an offence? Just because some allegation is there, FIR has been filed, is it that it is offence has been done, or is it something which is prohibited by law? Because ultimately after a few years the court may acquit the assessee and say that there is no offence. So what then happens to the expenditure incurred in such offence? Then further problem will arise where you have incurred an expenditure to defend the offence. It only covers the cases where for the purpose of offence, but will it also cover the cases where the offence expenditure is incurred for the purpose of offence? You see the Supreme Court's decision in the case of highlight the decision. So in that decision, Supreme Court held that income which is Meenakshi Mills case 6388-207, expenses incurred to defend in an offence is a deductible expenditure. So now it covers expenditure incurred for the purpose of an offence. So it could, the purpose of clause 1, if you see the old circular in 1998, say that this amendment will result in disallowance of claims made by certain assessees in respect of payment or on account of protection money, extortion, hafta, bribes, etc. as business expenditure. It is well declared that unlawful expenditure is not an allowable deduction in computation of income. So the purpose was to try and curb these kind of expenses. The assessee makes a payment of bribe and that cannot be a deductible expenditure. That was a kind of a purpose which was there when it was originally inserted in 98. The expansion of this by explanation 3 will really make it difficult, because now it not just covers law in India, it covers law outside India. In many a times you will just be paying certain fines etc. for compounding also, which is now covered in clause 3 here. that also will get hit, because if you see the clause 3 here, to compound an offence under any law for the time being enforced in India or outside India. Suppose I have made a security law violation in India or outside India, and then that fine made for security law violation becomes a disallowed expenditure. Traffic violations, lot of transport companies incur a huge amount of traffic violation penalties and fines. So is it something which can fall in this? So there violations by builders for deviation from BBMP guidelines or relevant municipal corporation guidelines. All these decisions earlier had held that these kind of fines or compounding payments are allowable expenditure. Now by virtue of clause 3 here, it will become disallowed expenditure. It will be disallowed. So the ambit of disallowance becomes very wide. But these disallowance should be restricted to only statutory disallowances. If there is a violation of a private right, suppose I violate an IP of someone and then I made a payment to him, that is not something which is covered under this. It should be an offence. It has to be a statutory offence, not a private offence. If it is a private infringement which is happening with someone, that doesn't get covered under explanation 1 or explanation 3 for that matter. So one has to be mindful of this. Expenditures incurred for these items can be got covered in this. Then it comes is the clause 2. This has become a double whammy. Earlier, when pharma companies paid to medical companies, pharma companies paid to doctors rather, the benefit was deductible expenditure in the hands of pharma company. There was no way to track it in the hands of doctors, right? There was no way that you know that whether doctor has got a benefit. It not just for doctors, it could be any other person also. But for doctors specifically, it becomes double whammy now. Then an amendment has been made that on such perquisite and benefits which are falling in section 28, TDS will be deducted. So today if a pharma company takes doctor for a foreign tour, he will deduct TDS on that foreign tour. But for the pharma company, will it be a deductible expenditure? Earlier, it was a deductible expenditure. The old board circular said that because this becomes in violation of MCI guidelines, the Medical Council of India says that you cannot give benefit to doctors above 1,000 rupees. If you are giving gifts and other benefits to above 1,000 rupees, then it is a violation of MCA guidelines and it is not a deductible, it is a violation of MCA guidelines. The circular said that violation of MCA guidelines should not be a deductible expenditure. The argument which was placed before the tribunal is the MCA guidelines are binding the doctors. MCA guidelines do not bind the pharma companies. They do not bind the pharma companies. Pharma companies have independent thing. The MCA guidelines only cover the doctors, like ICA guidelines can only cover the CS. If a company makes a payment to me which is against my professional ethics, I am under the problem, company still can claim a deductible expenditure. Right? Same way, the argument was taken that, see, it is not violating the MCA guidelines, doesn't bind the pharma company, so it cannot be violation by the pharma company. Tribunal allowed those expenditure. Subsequently, the Apex Laboratory, Supreme Court's decision, said that these expenditure cannot be allowed. Then a specific insertion has been made in explanation 3 clause 2, saying that such payments are not a disallowed expense, to be disallowed. So now the expenditure will be disallowed, but it will be taxable in the hands of doctors. Earlier, expenditure was claimed as deduction. No one knew whether it was taxable in the hands of doctors because there was no tracking mechanism. So we enjoyed double benefit for all these years. Now double whammy going forward. Right? So this is the impact of amendment to clause 2, more so for doctors, MCA guidelines, but it will also impact any other professional, any other cases where a benefit or perquisite is given. If it is in violation of any specific rules, regulations which are there, then it will be impacted for others also. In terms of taxability, naturally it will be taxable for everyone. So this is clause explanation 3 which has been inserted. Then, earlier compensatory payments were allowed. Now you will have to see if compensatory falling compounding, then clause 3 will be hit. If it is not falling in compounding, then still you can claim it a reduction. Explanation 2 which deals with CSR, which is now one important part I will highlight. One, the amendment is prospective, and we have to make a distinction between voluntary CSR and mandatory CSR. So if my mandatory CSR is say 100 and I incur 120, can that excess 20 I can claim? Right? The Gujarat High Court, while dealing with the issue in Gujarat Narmada Valley Fertilizers case, 422 ITR 164, a recent decision, was dealing with these aspects. The question is, what about this excess? This excess, or there could be a situation where I am really not liable for CSR, individual partnership firms, LLPs, not liable for any CSR obligations, right? In those cases, can I claim this expenditure for the under section 37? So I'll have to still go back to section 37. See, can I prove that it is incurred wholly, exclusively for the purpose of business? Can I draw a nexus between the expenditure and my business? If I can draw a nexus, then it becomes a deductible expenditure. So even if it is a CSR in character, but if it is not a mandatory CSR under the Companies Act, this decision saves me, saying that if it is a voluntary CSR, I still have to apply the test of 37 and then see whether it is deductible or not. Naturally, which have to be done in facts of each case, but there is a possibility that it will fall under section 37.
And one doubt, sir. CSR, it is not related to business. If I am doing voluntarily, the relation of business will not.
So that's why, suppose I do CSR.
Yes.
In a village, I do a drinking water.
Yes,
my all employees come from that village. Right? I am going to say that good drinking water for my village is my employees and their family members is very important. If they drink bad water or contaminated water, they are not going to come for job. Right? So you have to build that nexus. It's not that every CSR will be allowable, but if I am able to demonstrate, that's why I am saying for the purpose of business is wide enough. And commercial expediency, it's a commercial expediency for me if they are not coming to office and there is a situation where their family members are not well or the employee himself is not well, then there is going to be there. So I am going to say that there is a contaminated area in the water and this, my plant of safe drinking water, it helps me in my business. And there are n number of decisions where these kind of expenditures have been allowed, including Karnataka High Court in Infosys and certain other cases. But you will have to surely build a theory of a nexus. If you are not able to build a theory of nexus, it is going to be a problem. Come to 32. Very little time is left, but I'll try and cover certain important aspects at least. Right? So, as we all know, 32 today provides for deduction of depreciation on block of assets. No doubt for actual cost of asset for power generation, but we'll just focus on the normal assets. And that block could be tangible assets, intangible assets, excluding goodwill. In case of intangible asset, the amendment which is made 2 years back. So effectively goodwill goes out of the intangible assets. So the aspects that really come out for us that one has to be mindful of is that depreciation is on a specified asset. That means the asset should fall in the category of asset what we are talking of. Today goodwill like is an excluded asset, so it doesn't fall in the specified assets. It is in the block of assets. The assessee should be owner of the asset. Ownership could be wholly or partly, need not be entire ownership. And the user test is very critical. So block of asset, user test, ownership and specified asset. So these are certain important aspects that we have to keep it in mind. In this, what really comes into nature is that if I have satisfied the test of capital expenditure, then I come into the block of assets, either tangible asset or intangible assets. One dispute that came up was whether when you are talking of tangible asset, is it all tangible assets one block? Say for example, furniture 10% depreciation, building 10%. Because the definition of block of assets is such that if you see the definition of block assets, it says asset falling within class of assets comprising of tangible assets, intangible assets, in respect of which same percentage of depreciation is prescribed. So depreciation is 10% for furniture and depreciation is 10% for building. Is it same block? Account that today we have all taken for granted because even the forms give it different. But when it comes to intangible, it don't give a different block. It is a single block that's coming there, right? So because it says class of asset, so building is a class of asset, furniture is a class of asset, machinery is a class of asset, plant is a class of asset, right? So all become a different class of assets. When I look at a block, I look at the assessee level. Today there is no mechanism to look at business levels because the assessee may be running 2 to 3 businesses. Even if you look at the forms today, they are all single block. There is no possibility to give 2 different blocks. There could be say a business 1 which has a block, business 2 which has a block. But we are today looking at an assessee level. That assessee level you look at the class of assets and same rate of tax. Then that becomes a block. Right? Ownership. And ownership has to be again viewed in a wider terminology, wider context. It is not just the legal ownership that we have to do. 2 Supreme Court decision, Mysore Minerals, Pothas Cements. So Mysore Minerals case was a case where the asset, certain homes were taken for the benefit of employees. So employees were given homes, low income employees were given the home. to stay in those homes. 7 homes were purchased from certain housing board. The houses were not registered in the name of the company for whatever reason. The AO disallowed the expenditure on the depreciation on the ground that you are not the owner of the asset. The Supreme Court in Mysore Mineral says the dominion is there, possession of the houses are there, usage of the house is there. What more you want, right? So you are not just looking at the legal ownership, you are looking at the beneficial ownership, and a wider context has to be seen while determining whether the assessor is owner of that. So this is one important principle that we have to keep in mind. Then comes the question of usage. You should use, the asset should be used. If you see the section 32, it says owned wholly or partly by the assessee and used for the purpose of business. For the purpose of business or profession. Again, for the purpose of business or profession we have discussed, right? But used, what do you mean? Does it mean active user? Does it mean user of a block? Will it also cover passive user? Many a times circumstances may happen that asset is ready to use but not used during the previous year. Can I then say that it is still eligible for depreciation? Karnataka High Court in a decision of Yellappa Dasappa Hospital, there the question was whether used, because the word used is used, it will only mean active use and it will not cover passive use. Ready to use concept is not applicable. The Karnataka High Court held that ready to use concept is not applicable in 32. Only the active use is used because the word used is used. This is a decision which is contrary, which is bad decision from the assessor's point of view. Whatever, it's a decision which is there, right? Now they said that used has to be interpreted to mean an active use and it cannot cover ready to use cases. In a subsequent decision, Chamundeshwari Sugar 183 taxman 285. There was a circumstances where machinery was installed, but it turned out to be defective and assessee could not use it. It turned out to be defective and not a single item could be produced out of that machinery. The same Karnataka High Court distinguished Yellappa Dasappa's case and said in Yellappa Dasappa's case the situation was there was no evidence that asset has been used. Here is a case where machinery is installed and it is beyond assessor's control that he could use it because it turns out to be defective and they allow the depreciation. Now if you see both the cases, even in second case technically there is no use because it turned out to be defective, right? Assessor might have tried to use it but there is some problem and it has never been used. But the point that I would like to draw is the concept, if you see many tribunal decisions, they said what is depreciation? Depreciation is an allowance for wear and tear of machinery. We all know that after a certain number of years, the machinery may not, or computer or machinery or building, everything has a life and there is a wear and tear happening on a regular basis. Whether because of use, even if it is not used, there is some amount of wear and tear still happens. If I go by that fundamental understanding of depreciation, when the asset is ready to use, post that, right, I should be able to claim depreciation. There are decisions of various other high courts which have accepted the concept of ready to use vis-a-vis the Karnataka High Court Yellappa Dasappa's case. No doubt it is a binding jurisdictional high court for us, so it will create a problem. But there are other high courts which accepted this principle that when the asset is ready to use and for some reason it could not be used. There was a case of Chennai case, Madras High Court case, where asset was ready but there was no raw material available because of XYZ reason, which was demonstrated that for entire year raw materials was not available. Right? Assessor said what? It is a situation which is beyond my control and therefore the deduction for depreciation should be granted and it was granted. Third, the block of asset concept, once the asset forms part of block of asset, then the user test is for the block of assets. In the second year again you don't go and say whether each asset is used or not. That is not relevant. What you really, because once the asset is part of a block, it loses its identity, it loses its value, individual value. So it becomes a block which is relevant and to the extent the block is used, it is good enough for the assessee to say that I am going to get the depreciation of the asset. I am going to get the depreciation for the asset. So so first question that, or the issue that majorly that has to be, which will come up is because in the first year, the asset becomes part of a block when it is, because the provision 132.1 would say that it should be put to use for more than 180 days to get you full depreciation. That means for first year, I will have to at least demonstrate that asset has been put to use. And whether put to use could be passive use or should be active use, If you go by Ellermann Dasarpas principles, because the word used is used in the main limb, it will be active use, but there are other courts which have held that it could be ready to use. My view would be that it is a ready to use where everything is ready, but there are circumstances which are beyond the control of the assessee. One should still be able to claim depreciation on that. Right? So I look at the block of assets, I look at the usage of the block and claim the depreciation. Depreciation on goodwill, as I said, cover under 36(1)(3). If it is interest paid on something else, then one could still claim under 37. Right? That is one which is Bombay Steam Company's decision. Tapari Tools decision vis-a-vis Madras Industrial Investment Corporation. So, in case of Madras Industrial Investment Corporation, interest was allowed to be deferred, so that it was treated as a deferred revenue expenditure. Tapari Tools case was where I issued a debenture. When I issued the debenture of 100, I got only 45. 55 was taken as interest and upfront payment was made in year 1, though it had to be over the spread of the life of the debentures. The assessee claimed 55 in the year 1 itself. The Supreme Court allowed the entire expenditure because it is incurred in year 1 itself. Though for accounting purpose I may defer it, but for the purpose of tax purposes you have incurred in year 1 itself, it will be allowed at deductions. So in the context of interest, this is a very interesting decision one should be aware of. Capital borrowed. Just cover the borrowing sister concerns and that, and then we wind up. There are many more issues to discuss, but again limited time. So when we take borrowers and then divert it to sister concerns, the question is many a times I give interest-free loan to subsidiaries, I give interest-free loan to sister concerns, I might have given interest-free loan to directors, right? So that whether it becomes a deductible expenditure. Two beautiful decisions, one SA Builder Supreme Court. So the Supreme Court in SA Builder says that depending on the facts and circumstances, money is said to be advanced to a sister concern for commercial expediency. So here the principle of commercial expediency really comes from the decision of SA Builders. Though in the context of 36(1)(3), it is equally applicable to 37 and has been applied in many cases in 37 because of the same word language for the purpose of business or profession. Where holding company has a deep interest in its subsidiary and holding company advances borrowed money to a subsidiary and same is used by the subsidiary for some business purpose, the holding company would ordinarily be entitled to deduction of interest on its borrowed capital. So what I really need to demonstrate is that there is a nexus of business or interest, deep interest of holding company into the business of the subsidiary, right? So in those cases, I will be able to claim deduction of this expenditure. Another important decision is Reliance. You can see Reliance, it borrows huge amount of money at the holding company level and then funds its subsidiaries. So if you see Reliance Industry will borrow, it will fund Jio, it will fund the retail, everything it will fund, and the borrowings are in numerous numbers. The Supreme Court in Reliance Industry also has discussed this aspect, and also what it has brought down that if the money advanced to the subsidiaries is lesser than the own funds, that means if I am having my own capital and reserves and what money is advanced to subsidiary is lesser, then in that cases it can be presumed that the money is given from the own funds, not from the borrowed funds. Right? So it's kind of mixed funds where my fund is both mixed from capital borrowed and my own capital, and I have given loan to third party, my sister concern. In those cases, applying Reliance Capital and also the Supreme Court is recent in South Indian Bank case, which is in the context of 14A, the assessee can argue that it is out of my own fund, not out of borrowed fund, and my own funds are more than the amount which has been lent to my subsidiary, therefore it becomes deductible expenditure. With this, I will try and wind up because the next session will get delayed. So, but there are, as I said, many more important and interesting issues, and at least these cases at least have the benefit of some good Supreme Court decisions which are there in most of the sections. One could always fall back on this decision. Interesting principles are discussed in these decisions. One could take the benefit of those decisions. Then there are also other proviso to 36(1)(3). I think it's taken a couple of minutes till he comes. Proviso to 36(1)(3). There's an amendment 3 years back, 2015, not 3 years back. So earlier the question was, if I borrow for capital purposes and then say I borrow for purchasing capital asset, interest on that borrowed capital, whether it become deductible expenditure. So proviso was not there earlier and proviso came in 2003. Prior to that it was a deductible expenditure. the proviso originally used the words extension of existing business or profession. Those words got omitted in 2015. So earlier it read, provided that any amount of interest paid in respect of capital borrowed for acquisition of an asset, and the star words, asterisk words there, words were for the extension of existing business or profession. Those words got omitted. So after the omission of these words, if you are taking any money directly for acquisition of an asset, will directly hit by this proviso as well as ICTS. You will get disallowed. You have to capitalize that interest to the date when the asset is put to use. Once the date is asset is put to use, it becomes revenue expenditure. Up to the date the asset is put to use, it becomes disallowed here, and you will have to capitalize because 43(1) right with ICTS permits me to capitalize that interest. The problem earlier was because of the words extension of existing business or profession, there could have been confusion whether it will fall in proviso or not. Like one interesting case which we handled was the associate into software development purchased a land, took an ECB loan, purchased a land, and interest was paid on that ECB loan for the purchase of land. Question was, is it an extension of business or is it an expansion of business? The words used in the statute were extension of business, whereas I am only expanding my existing business. There is no extension of business, there is no new business I am preparing because I am just shifting my existing employees to the new premises. So it was that expansion. But given that words are anyway omitted now, any direct borrowing for acquisition of capital asset will be disallowed by applying proviso to 36.3. This again has been troubling all of us. Of PF payments, ESI payments, amendment has been made, Supreme Court is against us. Very unfortunate situation where even a single day's delay for a bona fide reason also gets disallowed. But this now becomes difficult to debate in a judicial forum. It requires a policy intervention by amendment in the statute saying that at least some leeway or grace period should be granted. One. Second, there could be bona fide reasons for various reasons. Say the proprietor in the hospital is fighting with life and death. Where will he worry about paying about ESI PF? Right? So there could be genuine cases which are also getting hit. Second, I am already being penalized under those laws by paying interest or something else. Should income tax enforce moral issues, or it should just look at taxing income? Today we are using income tax to enforce moral issues. Whatever the government doesn't like, it may not like cryptocurrencies, they make it taxable such that it is not workable in real life. So such things, whether we should enforce those things through income tax is an issue which is a policy issue. Amendment to the statute only can solve this problem, otherwise everyone will have to be very vigilant in terms of these payments, and early payment only can help a proper timely payment only can help your deduction for expenses. Similar interesting issues arise in bad debts. And how do you say bad debt is allowable? How do you say bad debt is written off? So, very interesting case are there on this aspect also. When one makes a provision for bad debts, whether it is sufficient to limit deduction. So earlier to post 2004. Prior to that, it was necessary for the assessee to demonstrate the debt has really gone bad. You have to demonstrate that debt has really gone bad. The amendment was made and Supreme Court's decision in TRF very clearly brought out that if you write off the debt, it is sufficient to claim a deduction. Now you don't have, there is no burden on the assessee. Please keep it in mind. There is no burden on the assessee to demonstrate the debt has become bad. That is not there. Only task the assessee has to do is to actually write off the debt. Once he has done that, it is good enough for him to claim a deduction. In Vijay Bank's case, the circumstances, the write-off was done in a different manner, which we generally do in the financial statements. Provision for doubtful debts debited to P&L account, and the debtors balance reduced from the balance sheet, which is a natural thing we do in our financial statements. The Supreme Court in Vijay Bank's case said, reducing that amount even in balance sheet, reducing from the debtors balance is as good as a bad debt, writing of bad debt, and that is an allowable expenditure. So, though again this decision may be used more if you are by mistake not disallowed and not a cost of a planning, ideally the ledger balances of the receivables or for the debtor should be nullified, and that written off should be done. Many times we see cases where based on the statutory auditor's advice, a bad debt provision is made because it might not rescind, and when you are doing the audit you realize that this has to be provided for. But the entry to nullify that bad debt is made subsequently say in September. Instead of doing it on 31/3, you do it on September when the audit is going on. Maybe because of accounting controls or because of some other reasons. So I've actually not written off the bad debt on 31/3. In the balance sheet I've written as bad debt, but actually if you see the ledger, the write-off might have been subsequently much later. Right? So these kind of circumstances also do arise. There are decisions which have held that even this kind of claims which are there, the write-off is for the year and it is good enough even if it is written off subsequently. As I said, these are all cases which should be used more as a defense. If you are really want to claim a deduction for bad debt, it is appropriate and advisable to do it from the at the time of in the financial years, nullify that ledgers on before 31/3 or on 31/3 so that you get a proper deduction for this thing. Once you have done that, the assessing officer cannot ask you to demonstrate whether the debt has become bad. That is none of his business, because the law today and Supreme Court's decision in TRF is very clear that if the assessee has written off and the income has been considered in earlier years, it is good enough for the assessee to claim the deduction for bad debts. So this is on bad debts. Any questions we have? Any questions on what we have discussed or any other points? Yeah.
The depreciation part, when we say on wheels, what if it's on rent?
Come again?
Depreciation on capital expenditure. We've taken in a place on rent and not on lease. Will that also cover?
It will cover. If you have done a structural change, suppose I have taken a lease. So see, question will be many times the lease agreements or rental agreement may be for a short duration. Some cases that duration may be 5 years, 7 years. So where?
It's 11 months. Usually rent.
I'll come to that. Yeah. So if it's only for 11 months and I do a huge structural change, right? I do a huge structural change. So the question is, what happens to that expenditure? What happens to that expenditure, right? Suppose this is the premises I have taken. I have incurred certain expenditure, which is a structural expenditure, which is having an enduring benefit. Now, if I do not have the right, so if you look at my position as a tenant, I am getting that premises for 11 months. Assuming it is renewed, it's a different issue, but we'll assume it is not renewed, right? If you're assuming it is not renewed, can I claim this expenditure? Will it become a capital expenditure? Will it become a revenue expenditure? From my point of view, it is a expenditure which I am not getting an enduring benefit, because after 1 year, naturally I will have to vacate the premises. I am not getting an enduring benefit. So the expenditure, the test of 37 will be satisfied. The test of 37 will be satisfied. Is it incurred for the purpose of business? It is not a personal expenditure. It is not covered under 30 to 36, because a huge amount of repair will not fall in 30 or 31. It will come to 37, or it will be a capital expenditure. So I should be, if it is a very small period of lease, in those cases, because I am not getting, as a tenant I am not getting an enduring benefit, I should be able to claim under 37(1) itself. Okay. Now look at a situation where the lease is long period. It's a lease for 5 years, 10 years, right? And most of these cases, if someone is incurring a huge expenditure on a structural changes of the building, naturally one will want, from a prudent point of view, will have a long lease in control. In such cases, the expenses which are structural in nature, which are giving enduring benefit, should be capitalized. One which are revenue in nature can be claimed as a deduction under the additional one.
When the machinery purchased and it is not used, the huge amount, say 50 lakhs, after 6 months we have purchased one vehicle. Both falls under the same class of asset. So that vehicle is used for the business. So since that vehicle is used, can we claim the entire expenditure?
So this is an interesting point which comes up many times. Now what will happen is, say in 1st of April I purchased a machinery, right? On say 15th August I purchased a car, right? So this is the fact pattern. On say 1st of April I purchased a machinery. If the machinery is purchased in earlier, then the facts will automatically change, because there is a closing block and then you are adding something to that. Now if both the assets are purchased in the same year and part of the block is used, right? The Karnataka High Court and also certain other decisions, especially the Karnataka High Court in Yellamma Dasapa's case, and I don't remember another decision of Supreme Court, says when the machinery is not used at all, the question of it claiming, you claiming a depreciation on that will not arise. Okay. Now the question what we would like to differently argue is it a part of a block? The right question that we should ask here is, when does an asset become part of a block? Does it become part of a block when you purchase it, or does it become part of a block when you put to use? In the first year. Because the proviso to 32(1) will say that in the first year, if you are put to use less than 180 days, then you get only 50% depreciation. Okay, the usage today is settled principle that has to be looked at at a block level, not at the individual asset level, but at the block level. Right? So when we look at the block usage, if an asset in the year of purchase, it will become part of the block only when you put to use. Right? Only put to use. If it is not put to use, it is not part of a block. So then, just saying that a small machinery or a small part of the entire thing is used and it is as good as a usage may therefore become difficult. But once it is a part of a block, then I don't have to individually look at in any of the assets, because the block of concept itself is such that individual assets lose its identity. Individual assets, there is no value. There is no separate value for each of the assets.
So, in case this vehicle is used after October, so shall I claim only 50% of the entire block?
No, see, not just because if the machinery is not used for the entire year, you are saying. If the machinery is not used for the entire year, and it is very clear that machinery is not used for the entire year. Now, if I can then say that the non-usage of machinery is for ABCD reason. If there is a specific reason that I have not used for this, like the Chamundeshwari Sugars case was saying that machine was defective and I couldn't use it, right? And if I apply the ready-to-use principle, then I should be able to claim the depreciation on this particular machinery. But if I have just purchased it and there is no action taken on this, it is packed and kept it aside, right? It is packed and kept it as it is, then I am not going to get depreciation on the machinery. So you purchase the machine, it didn't even open its packaging, right? It is just laying aside at this thing, and you purchase a car, right? Now here it is not even in a circumstances where it could be used. In those cases, there is no evidence that it is used or ready to use also. The Eloma Dasappa's case or other decisions also are there, which says that there is no evidence of any use, and therefore depreciation will not be available. But if there is situation where it is ready to use, at least if you don't, if you see other decisions, I mean now Karnataka will have a difficulty because Eloma Dasappa's decisions will be against you, right? But if you go to say other states where there are favorable views, in those cases it is possible to take a view that it is ready to use, therefore it forms part of a law. But given that Eloma Dasappa is against us in Karnataka, and if you do not have a valid reason for not using it, in a case of a litigation it is going to be difficult.
And the car, whether it's same which you got it with us. What about the car which is put to use?
Car, you will get the depreciation. And then it is put to use. There is no problem with the car. The problem will be the machinery which is kept aside packed, though it is part of the same block, but on the machinery which is even not opened, that we will not get a depreciation.
Sir, section 37 talks about personal nature, will not be disallowed, will not be allowed. I got an employee from outside India, specifically for some work. I mean, he is a regular employee. So because he is outside India, I offered him a rental, I mean with including accommodation also. So whether that accommodation expenditure is allowed or not, sir?
See, the question is, when you come to a company, can company have a personal expenditure? That's the first question we should ask. Can a company have a personal expenditure? Does company have a personality of itself? Right? Gujarat High Court in Sayaji Irons case, company cannot have a personal expenditure. You have given a benefit to an employee. It becomes perquisite / salary in the hands of employee. So from your purpose, as per the terms of agreement, you have paid him salary. You take it as a perquisite in his hands, accordingly do whatever TDS and other compliances it is, and then it is fine. So company, if you look at the company per se, it is not in personal. When we say personal can attach only to an individual, it can attach to a nature. Personal can attach to a partnership form because there is a partner who is an identifier. But when it comes to a company, the relationship is employee and employer there, right? They are two different persons, right? In those circumstances, you can give a house to say an employee. It could be a director, it could be a normal employee. It becomes perquisites in the hands of employee. Perquisite is salary for him, becomes a deductible expenditure for him. That's all.
Same reference can be drawn to 17.5 of GST, where it says that employee personal expenditure is disallowed. I mean,
So that is blocked.
Blocked
Credit. That's a different thing. So that principle will be for GST purposes, which they have brought in to say that this is any credit which is for personal consumption, we don't want to give credit.
Okay.
Right? But there they have widened it, covering the employee of the company. We do not have any such fiction in the act to say that personal expenditure of an employee will be disallowed in the hands of the company. 37 say personal expenditure. Personal expenditure of associate. We are talking of associate in 37.1. We are not talking of employee of the associate. Right? We are talking of associate. Plus, these kind of expenditure are specifically covered as perquisite in Rule 3 rate with 70. So it becomes in salary. I am paying salary. I am discharging the obligation. Right? So therefore, it becomes deductible expenditure for me. But for employee, it may be taxable as perquisite.
Yes.
Yeah. So, you said interest paid on late payment of TDS is disallowed. Interest paid on GST is allowed.
Either that is compensatory.
Both are statutory.
Both are statutory. Income tax becomes a problem because of 48(2).
Income tax is a disallowed expenditure.
Is a disallowed expenditure.
No, I'm saying both are statutory.
It's a statutory. See, GST is something which will incur for the purpose of business. You run. You have. That is a. I mean, it is part and parcel of your business. Income tax is something which is you are discharged on the profits earned of the business, right? 48(2), any taxes gets disallowed, and income tax is covered, gets covered in 48(2), and anything which is connected to that, interest on income tax, for example, gets covered there. But when it comes to other rates and taxes, other statutory obligations, that is not. It is not application of your income. It is connected to your income earning apparatus. It's connected to your business itself. That becomes allowed expenditure.
Loss, you said loss can be claimed under section 28. Can it be part of the profit and loss account, or it should be deducted after the profit in the computation itself?
Wherever you deduct, from tax purpose it is deductible. It could be a situation where you are debited to P&L balance sheet directly in your financial statements. The question is, for tax purposes, it is a deductible expenditure. Your accounting treatment, correct or wrong accounting treatment, will not determine the deductibility under the tax laws. Okay. So loss I might have treated separately in my books, but if it is a loss, then I can claim it as a deductible expenditure. If I debited to P&L, I did not give any separate treatment in that my STI, statement of total income. Suppose I have not done that in my P&L, I have taken it to balance sheet, then I will still claim it as an allowable expenditure in my statement of total income. So, thank you everyone for very patient hearing. Thank you. Thank you, C. Narendra Jain, for this exhaustive session on deductions under income tax between 30 to 36. We thank you on behalf of Bengaluru branch. I request our chairman to hand over a memento to the speaker. We'll break for tea now, half an hour, and then we will assemble at 10:30. 12:15, 12:15.